All right, thanks so much everyone for joining us today for the live online Australian Traders Summit. My name is Greg Lewis. I'm the marketing manager for Metastock, and with me here is Bobby Hiller, who is on our business development team. I am coming at you from Texas, where it's currently 5 in the evening. Bobby's coming at you from Utah, where it's currently 4 in the afternoon. And I assume all of our speakers, I think, are going to be coming at you from Australia, with the possible exception of Mr. Sinnig, who's first up. We really appreciate you joining us today. I will be running things kind of in the background. This is really the last time you're going to hear me or see me. From now on, Bobby Hiller is going to be running the show. I'll say really quick, Bobby Hiller is our business development team member. He is in charge of a lot of stuff at our company, including this sort of thing and organizing this sort of thing, and also working with our partners and finding new partners and more business development. If you'd like to talk to Bobby about possible partnership and development opportunities with Metastock, you can reach out to him. If you have any questions at all during this event, go ahead and reach out to us either in the chat on YouTube or in the questions box on GoToWebinar. And again, if you're on YouTube, please do go ahead and give us a like and click that bell. And Bobby, unless there's anything else, I think you can take away. Don't forget that disclosure.
All right, Greg. Yeah, thank you so much. It's always great having him here as backup. He's the man. Kind of really puts a lot of effort into all of these. He says I put these together, but half of me putting this together is asking him to do things for me. So thank you so much, Greg, for all the help that you put into this event as well. We're really excited to be doing this today. I know for most of you, it's going to be a good morning, but I know it's also good evening to many of you as well. We have a wonderful lineup. You can see them all here on your screen. Lots of speakers. Most of them are based in Australia. We do have some that travel quite frequently and some that are based outside of it, but everyone's going to have some really exciting information for you. I think this is going to be a wonderful learning event for all of us. So really excited about this today. Oh, I might not be at the start of my PowerPoint, so let's actually start that back over to here. Before I go too far, so that Greg doesn't bite at me here, I'll go ahead and go through our disclaimer. So this demonstration is designed to instruct you on using Metastock and the accompanying software plugins, and is not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock does not endorse the purchase of any security, nor is it paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or a solicitation to buy any security. Now that that's kind of out of the way, I'm sure a lot of you are kind of familiar with the lineup. For everyone that's kind of registered for the event, just in case you haven't registered, I see there's a number of users that are watching over on YouTube. You can go to metastock.com/international-summit, and that's going to allow you to register for the event, which also lets you opt in to several bonus offers from all of the speakers and from our sponsors. All of the bonus offers are free. They don't cost you anything. So if you want to be able to get access to those, I recommend jumping into the website. There's still time to register for this event today, even though it's already started, and then you can get access to those gifts. With that being said, I do want to just say hello to a couple of our sponsors, or thank you, I should say, to a couple of our sponsors. We have been rated as the best analysis software for over 30 years in a row now, according to the readers of Stocks and Commodities magazine, and they helped kind of like sponsor some of these events, and we really appreciate that from them. They also have an offer for those of you that have registered if you're interested in getting subscribed for a little bit of free time. I also want to give a real big thank you to the ATAA, the Australian Technical Analysis Association. We've been partnered with them for quite a long time now as well, and done many events with them, both in person and online. And so we're always thankful for their support, and we're always happy to kind of be working with them. I think it's a great association. If you guys are interested in joining, they do have a special offer that's available. You'll be seeing this slide kind of throughout the day here, but you are able to go to their website at this link listed down below. And I'll go ahead and get this posted in the chat too at some point a little later.
Thanks, Bobby. I was just going to ask you to do that. I didn't have that to share with the people on YouTube. So when you get a second, please put that in chat.
Yep, will do. And yeah, those are the two main sponsors for the event, along with, of course, all the speakers have helped invite their crowds as well. So we're really thankful for that. For those of you that are watching, and if you're not really familiar with Metastock, or if you are interested in like a trial of the Metastock software, which you'll notice throughout kind of the event, all the speakers today have utilized Metastock for some of their analysis in the markets, and we're the ones kind of hosting this event, helping to bring all these traders together, even though they'll all be speaking about all sorts of different topics. Well, if you're interested in a trial of Metastock, or want to ask some questions about your account, anything like that, we do have people monitoring our sales chat all throughout the day, and we also have like a trial and different offers available. So you can visit one of these links, either metastock.com/summit-savings, or just our chat room, metastock.com/sales chat. Happy to answer any of your questions there. With all that said, I don't want to dive too much deeper into Daniel's time. Daniel Sinnig is going to be the first speaker today. We've been partnered with Daniel for a number of years. I've had the chance to meet up with him, go out for a beer. He's a fantastic guy. He always has some of the best presentations, so I always try to get him to come along whenever I can. And thankfully, he was able to carve some time out of his busy schedule to be with us today. So hey, Daniel, great to see you, looking fantastic. And yeah, as always, thanks again for coming on. I know that you kind of know the routine here. You know what you're doing. So I think I'll probably just get out of your hair and let you take it from here. But myself and Greg will be in the background if you need us.
Yeah, perfect. Thanks, Bobby. Thanks, everyone at Metastock, for putting this great event together. And hello to everyone in Down Under in Australia. So as Bobby said, I'm probably the only one here, the only presenter who is not, I guess besides Bobby, who is not from Australia today. But nonetheless, I should say I've been to Brisbane. I heard the name before. I was back in the day when I was still pursuing a different career in my life. I was in academia trying to become a professor. I attended a software conference in Brisbane, I don't know, maybe 15 years ago. And then a second time, I was also in Australia, that time in Sydney, at a trading conference. And then at that point, I already made the shift from academia to full-on trading. So, and one last thing on that topic, and then I'm going to continue with my presentation. I will be, in fact, in Melbourne later on this year, November, also at a trading event. So exciting. So there's a connection to Australia there for sure. All right, so let me go ahead and share my screen. All right. Oops, that's the wrong one. Just a second. Okay. Oh, not now. Bobby, are you there? Did I close the presentation? No,
I can see, but it's like your overview of the SuperTrend on steroids.
Oh, so I'm sharing. Okay, sorry. People can see the screen. Let me click here. Oh boy, sharing. 1 second, it's gonna come. So you said I've done this before. Now it seems like I have not done it before.
So sometimes it'll like remember a monitor and you want to use a different one, so you have to change it.
It should be good now. Should it be?
Yeah. Yep. Looks perfect.
All right, awesome. Well, thank you so much once again. Okay, so my name is Darryl Sinnig, and today we're going to talk about something super exciting, something I personally trade a lot, and this tool is called SuperTrend. So SuperTrend is one of the classic indicators out there. It's built into many platforms. I believe Metastock also has the classic version of SuperTrend built in, but it's been part of trading platforms for years, almost decades now. Now, having this said, this indicator is a bit dated, and with today's technology, there's so much that could be done and can be done, in fact, to improve on this indicator. And this was exactly our mission a couple of years back, where we took a very close look at SuperTrend and see, hey, what could we do to bring it up to date with the latest technology, with auto optimization, with win rate prediction and stuff like this. And the result of that development effort, I'm going to show today, and how it works with Metastock as well. As you will see, this is quite a game changer when it comes to finding high probability entries, in the particular trend entries. All right, so with this, a quick preview of what you are going to see today, but later in this presentation, is exactly this. So this is my trade of today. This is not a recommendation, but it's my personal trade of today. So we're always putting our money where our mouth is, so to say. And for today, we have selected this particular symbol here. This is Arthur J. Gallagher, one of our favorite symbols to trade. It's been a monster throughout the years, despite all the downtrends in the markets. This is one of the symbols which held up, one of the best, or the best among the many ones which dropped a lot lately. And why that is, I don't know, but it's from a technical point of view, so you can see here, most of the signals that came along the way, especially the long entry signals, they worked out beautifully. And in fact, these long entry signals, these are signals produced by our SuperTrend Bullseye indicator, the indicator which we have designed with all the latest features, such as auto optimization. So, and as it turned out, SuperTrend gave us a nice long entry signal a couple of days ago, but we didn't act on it quite yet because, and there's some reasons for this, which I'm going to get into a bit later on today. But today, with today's downwards move, the markets were quite bearish today across the board. This brought this particular symbol into a very interesting entry area. You can see down here, there was confirmation with one of our other indicators, which I'm also going to get into it today. So my idea was, hey, to get long this particular symbol, Arthur J. Gallagher, at price level 319. That's where the market closed today, give or take. Our target is, this is a typo, this is reversed. Our target, my apologies, is at 375. I will reverse these two numbers, and our stop loss is at 295, just below the swing low. So I apologize for this. And if you would trade this, and if we have these targets and stops in place, this would give us a reward to risk ratio of 2.6. And this is once again this particular trade which I picked for myself today. Now the cool thing is that in this presentation, I'm going to share with you how and why I picked this trade. And perhaps the best of all is that at the end, you will be able to follow along exactly these steps, because as it turns out, these are quite mechanical, and especially with Metastock, actually quite simple to reproduce, because Metastock has, as you may know, one of the most powerful scanners in the market. It allows you to scan through thousands of symbols very quickly. Okay, now, before we get to this, a quick introduction of who I am. So my name is Daniel Sinnig. Bobby already mentioned it, and I am one of the founders of a company called tradingindicators.com. And as the name suggests, it's a company based on creating interesting, powerful trading indicators. And all of what we do, as one particular goal of mine, is to help you, the trader, make better trading decisions. Now, I should say, I didn't start off with trading in my career. In fact, back in the day, my career objective, or my main objective in life, was to become a professor in software engineering. So I went through all the levels. I did my master's, I did my PhD, I even did a postdoc. I wrote papers in software engineering. I started teaching at various universities in and around Montreal, which is where our headquarters is. But you know what? During all these days and years, I was always fascinated by the world of trading and finance and how you can make money in the market. So I started trading on the side. But you know what? As you start out, and maybe some of you have shared the similar history, as you start out, you tend to make all kinds of mistakes. So so did I. So I overtraded, for example. I took too much risk. I traded when market conditions were not right. I revenge traded. And after donating quite a bit of money to the markets, I came to the hard realization, oh boy, trading is not as straightforward as I thought it would be, and I need help. And for me, as a software engineer, needing help meant I need better tools which allow me to make better trading decisions. So what did I do? I rolled up my sleeves and I started coding. And the very first tools and the very first trading indicators which I have written, they were meant only for my own purpose. But once I realized, hey, these are actually helping me. These are actually helping me make better trading decisions. Then I thought, hey, perhaps others will benefit from these indicators as well. And this is really how the story and the history behind tradingindicators.com started. Now, I don't want to talk too much about the history. Let's talk about what is going on in the future. But before we do, I need to remind you, also from my side, that trading does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to hypothetical performance and backtest performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so with this out of the way, let's get into it. Just one last remark before we really get started. If you have any questions, please don't be shy, don't hold back. Put your questions into the Q&A box or the chat window of your webinar tool, or the comments section of your YouTube window, if that's possible. And Nicholas, he's going to look out for these questions and bring them to my attention as I go through this presentation. So please don't hold back, don't be shy. Okay, so let me start off with a quote, which Winston Churchill back in the day, and not in the context of trading, said. He said, "Never let a good crisis go to waste." And I thought, hey, perhaps this is a quote which could resonate with us traders as well nowadays. Well, the markets have turned. The bull market in which we were for a long time turned around a little bit. We are in a major correction, to say the least. But of course, these corrections, these can also be opportunities to us. Why? Because many of the symbols, many of the big stocks out there, they are now available at a steep discount. Wow. And some are better than others, but of course, every crisis, every downtrend also gives us an opportunity when it comes to trading. All right, so let's have a look at the markets. What's going on right now in the market? What is my view on current markets? And for this, I'm going to switch over to MetaStock. I'm just go to my MetaStock window here. There we go. And what do we see here? So we see, and don't pay attention too much on these indicators on my chart. Let me just minimize this a little bit. Let's just have a look at the price action here. So this is the SPY, the S&P 500 ETF on the daily time frame. You can see it here. So what is happening? Well, as you can see here, price went up for a long time. Every bull entry signal was very well followed through by price. Price moved up and up and up. But recently, when I say recently, a couple of months back, starting at the end of February, things start to turn around. And we can see here this big red arrow. In fact, this is an arrow of our SuperTrend bullseye indicator. It started pointing downwards on March 10th. So what's happening right now in the markets? Where do I see where things may be going? Well, I'll just drag this over just a little bit if I can. It's freezing up a little bit. There we go. Okay, perfect. So yeah, prices broke basically this upward channel in which we're in for so many years. So that is always a first sign that, hey, perhaps this correction is either going to be deeper, to say the least, or perhaps we are going to reverse into a full-blown trend reversion. Well, where do I see us right now? Well, we broke our trend channel. We see this big downwards facing arrow. Prices went down initially, but then they retraced back up. And this is a very common phenomenon when it comes to the market. After an initial break, the market tries to fake you out a little bit. It initially goes up a little bit, only then to reverse to the downside. And this is often caused by the fact, and you may have heard it before, that when support is broken, it can become resistance. So what happened here? Prices went down, went back up, and then bounced off this former support level, which is now acting as resistance. And then the real move commences afterwards. So down, up again, and then a real move further to the downside, all the way to this low point on April 7th. So what happened then? Well, prices bounced up. We had this biggest day in NASDAQ history, and the S&P 500, had a similar big move up again. But since then, markets are fading again. So this is concerning to me because if we were to revert all the way back into a bullish trend, I would have expected price action after this big move to continue or at least test this high bar here, which was not the case. In fact, prices are fading again to the downside. So what is this reminding me of? Well, this reminds me, let me just get my drawing tool here. This reminds me of this is wave 1. Okay, 1 second. Let me just take this real quick. This is wave 2 up. So every wave has a counter wave. So up, then back to my drawing tool, wave 3 down, all the way down to this low point. All right. And my mouse is freezing up just a little bit. Not sure why that is. 1 second. All right. And so this is wave 3. Wave 4 back up to this point. All right. And then what? One wave is still missing. And if this were wave 5 to commence right now, and it kind of almost seems like it, well, this would mean that this low point that we've seen on, when was it? April 7th is not yet the low point of this really steep correction. So I don't want to call out doomsday here, but at least right now, as it feels like, of course, we don't know what the future will bring, but as it feels like, this may not be the end of this steep correction. There may be one leg missing to the downside. Of course, we will see how this week will end. It started off quite bearish. If we, however, are testing these low points here and we break it, I believe there will be another fairly substantial move further to the downside. So that's my take on the SPY. But what's interesting, and we're going to get to this in just a bit, is that these signals that came along, at least for the most part, this long entry signal here, this short entry signal, these have been worked out quite nicely across the board. Meaning that what I'm going to show you will work whether prices are trending upwards or prices are trending to the downside. Okay, so that was the SPY, but let's see what's happening in the QQQs, the NASDAQ 100 ETF. Yeah, big surprise here. Things look very similar. These two symbols have been trading in tandem for the most part. Also here we see evidence at least that, hey, a wave 5 may be starting. So wave 1 down, wave 2 up, wave 3 down all the way to here, wave 4 up again. We didn't break the high point, and then wave 5 may be in place right now. And if it is, we will see also lower lows here on the QQQs. All right, so that's a very similar picture. Let's change it up a bit. What is going on with crypto? I know many of you may trade cryptos and in particular Bitcoin. So let's have a look at what is going on Bitcoin. All right, so let me drag this over just a little bit here. There we go. Okay, so Bitcoin, of course, from a macro trend perspective, has been in an uptrend. Yeah, you can see it here. We had this beautiful long entry signal. Prices really shut up, but then also, when the whole stock market started to decline, also Bitcoin started its declining move. And what surprised me then is, and actually a bit before even, is that Bitcoin and the major indices, SPY and QQQ, they kind of traded somewhat in tandem. And when the SPY or the QQQs were going up, Bitcoin followed suit, and vice versa when things were going down. However, and this is interesting, this correlation seems to break a little bit right now. So we had a bit of an uptrend in Bitcoin. Look at these latest price action here. Things are going up, while on the SPY and the QQQ, things were actually going down. So this is perhaps the sign that maybe Bitcoin is, uncorrelating itself, if that's the word, from the major indices. And perhaps this could be an interesting opportunity to think about a long position, especially should we break these and these swing highs here, and perhaps this would be a resistance that is broken, then acting as support, and we may see a higher move in Bitcoin. But of course, right now, this remains to be seen. This very much looks to me like a consolidation phase here in Bitcoin. And, as long as we are consolidating, means that prices will be sideways to some extent. If we break out above this these highs here, or perhaps below these lows, well, then we have more clarity as to where prices will go next. Okay, so this was my market overview. And once again, the reminder to you guys, if you have questions, please don't be shy. Put them into the Q&A box. All right, but you may now wonder, hey, Daniel, okay, this is the market overview. This is all nice and dandy, but what about this trade of the day that you picked for yourself? How did you get to this particular symbol? Good question. If you had this question in your head, let me explain to you how I found this particular symbol as my long trade of today. Well, before we get into this, let me go back a little bit and talk about the classic indicator, which I mentioned at the very beginning. And this classic indicator is called SuperTrend. You probably have heard about it. As I mentioned before, it's built into most trading platforms. It's one of the classic indicators. And in fact, this indicator was developed by a French trader called Olivier Seban. He even wrote a book about this indicator, meaning so much that, hey, everybody deserves to be rich. Wow. And this indicator has turned out to become one of the most influential trend trading indicators. And back then, it had quite some unique features which were unprecedented. Let me give you an example. For example, it specialized in the early detection of trend reversals. So it was a trend indicator which was quite popular, but also specialized in finding signs that, hey, this trend has come to an end and it may reverse to the opposite side. So that was quite cool. Secondly, it came with a trailing stop. You can see it here, which would lock in profits as the trend unfolds. So you can see a classic trailing stop, for example, for the short signal here, would only go down, never go up. Or for a long signal, it would only go up, but never go down, locking in profits along the way. And thirdly, what was really cool back in the day about this indicator was that it strategically placed its trading stop based on the current market's volatility. Meaning, if markets were really volatile, the trading stop would be further away, giving this trade more room. And if markets were calm, the trading stop would be tighter, meaning we have less risk on the table. So that was quite unique back then. But let me quickly give you an overview of what was this indicator all about. First off, we get these long entry signals, these little triangles to the upwards facing, these green ones here, and short entry signals. What was interesting is that these signals, they were always alternating, meaning a buy entry signal would be replaced eventually by a short entry signal, which would be replaced down the road by a buy entry signal, and so forth and so forth. So these were always alternating. Once we are in a trade, of course, entering into a trade is one thing, but once we are in a trade, we need to manage our trade. And also decide when do we get out. And this is where the trading stop comes in. So this green line here for the long entry signal, that's a trailing stop. As you can see here, it's always going upwards. It would never go down. A trading stop always locks in profits, never gives away profits. Okay, and basically the way it works is we are going to stay within this trade until this trading stop is broken, which happens at exactly this bar. You can see this bar here. It actually closes below this trading stop. And guess what happens when this trading stop is broken? We reverse our position. So we exit our long position and we go into a short position. And then the whole thing starts from the beginning. We go short and the trading stop tells us how long are we going to be in this trade. And you may perhaps say, hey, Daniel, didn't we hit this trading stop here? Well, I'm going to talk about this in a second. All right, so this is how the classic version of this indicator works. But what was great perhaps 25 years ago, it is a little bit outdated nowadays. Why do I say this? Well, for this, you have to understand that the trading stop is one of the most important part of this indicator, and it can be controlled by two parameters that come with the SuperTrend indicator, the ATAA period and the multiplier parameter. And it was up to the trader kind of to figure out what is the best mix of these parameters, because this mix will determine how far or how close your trailing stop will be. But you know what? That's a big ask to any trader. Why? Because these are numbers, and there are two numbers, and the combination of them will determine how well chosen the trading stop is, or how badly chosen it is. But this seems to me kind of like a trial and error approach, leaving it up to the trader to figure out what is the best combination of these two parameters. What are the best parameters for the ATAA period and the multiplier? So that's a big question. And traders were asking themselves this question, hey, how should I pick those? And oftentimes, because this was not easy, this is not a trivial problem, traders ended up just keeping the default parameters. And this one-size-fits-all approach oftentimes is not the best. It works out quite decently, I would say, but it can be better. If something can be better in trading, well, we should do it better. Okay, so that was problem number one. How do we find these best parameters? And problem number two, even if we have chosen, certain settings for our SuperTrend indicator, how do we really know how well it is performing? I guess we could gauge somehow, hey, how well have the long entry signals worked out? How well have the short signals worked out? And then kind of guess the performance. But there was no hard evidence of how well the indicator was actually working on a particular time frame and for a particular symbol. Well, we took these two problems away and we decided to address them in our research lab here in Montreal at tradingindicators.com. And what we have come up with is a brand new version of SuperTrend, an improved version of SuperTrend, an intelligent version of SuperTrend. And we call this version SuperTrend Bullseye. Well, this is a marketing name, but most importantly, this new version addresses exactly these two problems, which we just talked about. Finding the best parameters automatically for you and also telling you, the trader, how well the signals are actually performing. Now, this may all sound very theoretically, so let's switch over once again to our charts, and let me introduce to you SuperTrend Bullseye. All right, so once again, back to Metastock. There we go. All right, and we're gonna start with this chart of Bitcoin here. Okay, now what do we see here? Well, first off, we are seeing our short entry signals and long entry signals, and then short entry signals and so forth. So this has not changed. These signals are still alternating from short to long to short, back to long, and so forth. We also see that, hey, we do have our trading stop here. And it's always locking in profits. It's never going to give away profits. You can see this very nicely here too. This also has not changed. But what has changed are two things. First off, the indicator will tell you directly in the expert commentary. So if you're familiar with Metastock, you have this option here to enable the expert commentary, which gives you additional information about the indicator and how well it's performing. So if I drag this open a little bit, just a second, there we go. Let me make this a little bit bigger. You can see it here. Here we are on Bitcoin on the daily time frame. You can see down here, okay, right now, all our win signals have worked out. The short ones, not so much for Bitcoin, with 8 trades in total and a profit factor of 2.87. And guess what? Whenever I change symbols, for example, go back to the QQQs here, these statistics are going to be recalculated, basically showing you directly on your price chart, or in this case, in the expert commentary, how well this indicator has been performing historically speaking. And for you as a trader, and also for me as a trader, this gives me something very important, because it allows me to gauge how well this indicator, how well these signals are working for this particular symbol and time frame. So for example, I can see here, hey, my long trades for the QQQs on the daily time frame, historically speaking, have worked out much better than my short trades. The win rate was 75% for the long ones, for the short ones 33%, and overall the profit factor was 2.71. To me, this is actually the most important metric when it comes to trading. The win rate is one thing, it tells you how many winners that we have, how many losers that we have, but it does not take into account how big my loser was or how big my winners were. And sometimes, even with a lower win rate, like 33%, you could be profitable. How? Well, if my winners are, let's say, 4 times as big as my losers, I will be profitable, even with a win rate around 33%. So that's all possible. This is why the win rate by itself is not such an important metric. Much more important is the profit factor, because this metric takes into account the size of the winners and the size of the losers. And as a rule of thumb, a profit factor above 1 indicates a profitable trading system, and below 1 it would not be profitable. And the higher it is, the better it is when it comes to the profit factor. All right, so that was the first feature. The indicator will tell you directly in the expert commentary how well it is performing in the long direction and the short direction. But there's one more feature, and this feature is called auto optimization. What this feature does, it basically, or the indicator will automatically find the best combination for the ATAA period and the multiplier parameter for you, such that the profit factor is optimal. And this was a game changer, because you as a trader no longer have to fiddle around with these 2 parameters. The indicator will do it automatically for you. Let me show you what's happening here. So here, let me go back to Bitcoin. Okay, here on Bitcoin, the optimal parameters for this daily time frame is 5.5 for the multiplier and 80 for the ATAA period. But watch what happens if I now change time frames, for example. If I go from the daily time frame, let's say, to a 3-minute time frame. So this is now loading, and let's see what happens to our parameters. I go down here, now it's 8 and 40. Was that different? I forgot what the previous one was. 1 second. What did we have previously? I believe it was different. Maybe as a fluke, it's the same. No, it's different. So it's 5.5 and 80, and for the 3-minute was 8 and 40. As you can see here, the parameters are different. And why are they different? Well, because the indicator has determined for this different time frame, this combination of parameters was not optimal anymore, and a new set of parameters was deemed optimal. So this was a game changer, because you can always be assured, hey, that we are always dialed into current market conditions. The indicator will find the best parameters for me. All right, and this works across the board. So let me change it up a little bit. Let's go to this symbol, CHOP. A symbol in the S&P 500, also on the daily time frame. And once again, we can see here, SuperTrend Bullseye is doing its job. Let me just zoom out a little bit. Now we have our long entry signal, our short entry signals. And if we scroll down here, yet another set of parameters which are deemed optimal. And our win rate to the long side and short side is given here, along with the profit factor. One more example, AT&T. AT&T, in fact, had just today a short entry signal. In fact, this was no coincidence. I actually scanned for it. We're going to get to the scanning part in just a bit, because Metastock, no big surprise here, has one of the most powerful scanners in the industry, allowing you to actually scan for signals which currently have entry signals. This is actually how I found this signal here of AT&T. But once again, if I go down here, let's see, if I were to consider this short signal, what would be my decision-making process? Well, first off, I probably would go down all the way here and look at my statistics. What do I see here? Well, I see a long win rate at 71% and short win rate of 42%. All right. Actually, 42% is not so bad for this indicator, because for most trend following indicators, and SuperTrend Bullseye is a trend following indicator, the winner will be much bigger than your loser. It's just the name of the game. So in this case here, even with 42%, this is a decent win rate, even though if it's below 50. However, if you want to play it really safe, and of course there's no guarantees in trading, but if you want to play it perhaps a bit safer, you would wait for a long signal to come along on this particular symbol. Because why? Because here the win rates are overwhelmingly good at 71% across 14 trades. All right, so this is how the indicator works, and I have so many examples here that I could show you. But let me quickly go back to my slides to recap a little bit of what we've seen, because there's two more things which I need to show you too, which will even further improve this amazing indicator. Okay, so back to my slides real quick. So just to recap, what you've seen so far is that SuperTrend Bullseye, this brand new version of SuperTrend, comes with auto optimization, a feature which will find the best parameters for you. It also comes with real-time performance statistics, showing you directly in the expert commentary of how well or perhaps how poorly the indicator is working. And guess what? Sometimes if the indicator tells you, hey, for this trade direction, my win rate is only perhaps like 10%, what would you do? Well, you would simply stay away from this trade. Sometimes not to take a trade is the best trade advice that you can get. Okay, so you've seen these two things. A couple of things which I didn't mention because there was no time. The indicator also comes with two different reversal modes, on close and on touch. Let me quickly explain to you what that means. So let me go back one more time to our slide here and look at this particular example here. Do you see this candle? This one here, wicking below our trading stop. And you may say, hey, Daniel, come on, this trading stop was broken. We should have reversed our trade at this point. Good point. And I agree with you. If you were a purist, then this would be the case. But by default, our SuperTrend Bullseye indicator is configured with a reversal strategy of on close, meaning we need to close below the trading stop to reverse a position. But this can be changed. There's a setting in the parameters where you can tell the indicator, hey, indicator, I don't want this. I want you to reverse on touch. And if this was enabled, and we have a bootcamp about this, so I won't be able to show it to you right now, but you just take my word for it. We have a full bootcamp explain to you every feature. But if this on touch feature was enabled, then the indicator would have reversed the position at this point, because would have touched the trading stop and we would reverse. Okay, so that's a feature which you can use and enable. And the second feature is the trading direction. By default, the indicator is configured to both take trades in the long direction and the short direction. But sometimes this is not what you have in mind. Perhaps because of trading constraints, or perhaps your account doesn't allow you to go short, you only want to consider long trades. Well, in that case, you could select the long only version of the indicator, which has the side effect that the optimizer will then only optimize for long signals. By default, it optimizes for both longs and shorts, so that both together give you the best performance. But if you would never trade short, you can configure, for example, the indicator to only trade long signals, or vice versa, to only trade short signals if you so desire. So that's possible as well. All right, so let me move on and ask you another question. How do we know which symbol currently have interesting setups? Well, we could go through these our symbols one by one, but of course that's not very time effective. It's tedious, and there's a better way to do it. So in Metastock, we can scan for symbols which currently have setups, but not just any scanning. We can do what's called generation 3 scanning. What do I mean by this? Well, let me give you a quick overview. So generation 1 scanning is what you probably know. You know, you use your scanner, you click start, and it will find you all the symbols which currently have signals. That's a plain old signal scanning. That's generation 1, but we can do better. Generation 2 is to scan for signals which have been proven to be profitable. And the way this is possible is by seeing directly in your scan results what is the profit factor and win rate associated with that signal, allowing you to rank your signals, focusing on the ones which have the best win rates or the best profit factor first. I'm basically allowing you to sort your symbols by historical profitability. And there's one more thing we can do. Generation 3 scanning will perform a scan which not only will show you the win rates and the profit factor in your scan results, but will also use optimized parameters on a per symbol basis. Meaning, let's say for IBM, a certain set of parameters will be used which are optimal for IBM. Then for Tesla, a new set of parameters will be used which are optimal for Tesla. Then for Amazon, a new set. For Microsoft, a new set of parameters, and so forth. And this is what we call generation 3 scanning. Now, how does this work? Let me give you a quick taste. So in Metastock, and let me just drag this in real quick here, we can, and in fact, let me just quickly open up my Power Console. There we go. We can run these scans. So let me go to the Explorer here, and with the indicator, various predefined explorations come with it. And if we were to run, I won't have time to do it right now, but if you were to run this particular scan here, which scans for buy and sell signals, I ran this in prior to the presentation, and just pull up the report here. We can, for example, see that right now, there are 3 symbols on the daily time frame in the S&P 500, which currently have entry signals. They happen to be all sell entry signals. You can see it here. Only the sell column has a non-zero value. So AT&T, Marsh & McLennan, and so forth. They all have sell entry signals. So in addition to the sell entry signal, you also see here, hey, what is the profit factor associated with that signal, allowing you to rank and sort your signals. Now just imagine for a second you had like, I don't know, 20 signals or 30. If you scan through a bigger search universe, you could easily sort from highest to lowest, allowing you to focus on the symbol with the highest profit factor. And best of all, an optimized set of parameters was used on a per symbol basis, meaning that you can be assured that you are always dialed in with the best parameters for a particular symbol. So this is no longer one size fits all. This is a tailored set of parameters on a per symbol basis. All right, so this is how the scanner works, and just take my word for it. I told you already prior to this that AT&T had a short entry signal, and I was able to find it by simply running this scan. If I open up my results, you can see that AT&T will open up in the background, showing you that on the last bar, there is indeed a short entry signal right there on AT&T. Okay, all right, so this is scanning, and I have to go quickly a little bit now because I'm running a little bit out of time, but let me quickly say one more thing about SuperTrend Bullseye, because there's one last thing that we can do. We can further optimize the indicator. But then you may say, hey, Daniel, how can you optimize an auto-optimizing indicator? Isn't that a contradiction? Well, not really, because there's still some stuff that we can do to further improve it. For example, we can define in the parameters of the indicator how exhaustive the optimization should work, which takes more time, but perhaps that's what we want because we have no time constraints, or how loose, for the lack of a better term, the optimizer should operate. Meaning, in layman's terms, how many different combinations of our ATR period parameter and our multiplier parameter should be tried out by the optimizer. So that's one thing we can do. We can control this by the settings of the indicator. The second thing, and I already mentioned this in earlier on, is we can adjust the trade direction. Basically telling the optimizer, hey, only optimize for the long direction or only optimize for the short direction, if you already know which direction you want to trade. That's one way to do it to further improve our results. And thirdly, we can combine SuperTrend Bullseye with another indicator, which we call Trend Radar. And you'll see in just 5 minutes from now, maybe even less, you'll see how I used this last approach here to find our trade of today. So what is Trend Radar? Well, Trend Radar is a utility indicator, which we use every day in our own trading. You can see it here, this little heat map below the price chart with these green areas and these reddish areas. And basically tells you at a glance, what are the current market conditions all about? Let me quickly explain to you how it works. So every row of this indicator can either be greenish or reddish. And we have 5 different rows. Each row represents a particular trend. The top row is the short-term trend, the middle rows are the medium-term trend, and the last rows are the long-term trend. Okay, so far so good. So what can we, for example, infer from this little patch here, which we see right here? Well, we can see that long-term, we are bullish. The last row is all green. Long-term trend is bullish. But every once in a while, we have these little red patches here affecting the short-term trend and the medium-term trend. These are what we call healthy pullbacks, for example, within a long-term trend. As a trend trader, these are great opportunities to enter into a trend trade. Because as a trend trader, you don't want to enter when things are overextended. That's too expensive. You want to wait until things come down a little bit and then enter into the trend direction. And exactly these kind of scenarios let this indicator show. The indicator will show to you just by analyzing this heat map below the price chart. And there are other scenarios as well, which I don't want to get into right now. But what I want to talk about is how can we use Trend Radar together with SuperTrend Bullseye? Well, here's one idea. First off, we can use SuperTrend Bullseye to tell us, hey, what is the trend direction we should be considering? We're looking at the entry signals of SuperTrend. Is it either bullish or bearish? And then we will use Trend Radar to find healthy pullbacks. And thirdly, we will use the scanner to find exactly these scenarios. Let me give you an example. Okay, so let me go quickly back to our Metastock scanner. Just give me 1 second if I can find, not this one, find my power console. There we go. Okay, so, and in fact, before I do this, give me like 1 second because I want to explain to you one last thing. Let me go to gold. GLD. We all know gold is on fire. Gold has been going up for a long time. It's in a very strong uptrend. Okay, so what do I mean by this trading idea, which I just explained to you, that SuperTrend Bullseye will give us our overall trend direction. In this case, for example, here, after a long signal, the trend direction would be bullish, and SuperTrend and Trend Radar will give us our actual entry. So here's an idea. So let's say, let me just make this a little bit bigger if I can. Drag this over. Just a second. In fact, let me quickly disable my expert commentary. There we go. Okay. All right. So, in fact, let's use this signal here. Let's use this long entry signal here. So this is a long entry signal of SuperTrend Bullseye. And okay, yes, we could have, of course, entered at this point. It would have worked out perfectly. No problem there. But do you see one thing? Look how far, at least initially, our stop loss is away. And by the nature of things, you know, whenever SuperTrend Bullseye will give us a signal, we are a little bit extended because we're reversing from, you know, in this case, a short trend to a long trend. So prices need to move quite a bit for this reversal to take place. Wouldn't it be even better if we were to wait for a pullback of price and then enter in the direction of this original signal? And this is exactly the idea which I have in mind when it comes to combining these two indicators. So SuperTrend Bullseye will give us a trend direction, in this case, bullish, and then we enter on a pullback. And guess what? Trend Radar down here, you see this heat map, will tell us, hey, where's this pullback? Right here, this little patch downwards. This is a level 3 pullback. This here, another level 3 pullback, and so forth and so forth. So these are great opportunities to enter into this long trade, in this, for example, at a much better price, and this is very important, with much less risk on the table. And it's exactly what I've done to find our trade of today. So what I ran, and I probably won't have enough time to fully get into it, I ran a scan where I first asked Trend Radar, hey, Trend Radar, find me all the stocks which currently have a level 4 pullback within an uptrend, and then of those, show me the ones which currently are long as per trend, SuperTrend. And guess what comes here? The second one that I found here, with a profit factor of 1.53 and 28 trades taken in that look back period, was Arthur J. Gallagher. And if I open this one up, just for 1 second, you can see that this is exactly the stock which I picked for my trade of the day. It's a long-term uptrending stock. We've traded a lot in our trading room, but right now it's at a very interesting state. SuperTrend Bullseye, you can see it here, is bullish. We have this long entry signal, but we have this pullback all the way to here. We're still bullish. The trading stop was not broken, and it's a level 4 pullback. You can see this little 4 rows here, 1, 2, 3, 4. So the last line is a little bit hard to see. It's a level 4 pullback within a long-term uptrend. So this to me is a very interesting long entry opportunity with very little risk on the table because our stop loss is so close away. And on top of all this, if I look at the expert commentary, I can see that for the long direction of Arthur J. Gallagher, yeah, for SuperTrend Bullseye, our win rate is at 85%. And overall the profit factor is 1.54.
Daniel, this is actually a good segue for a question.
Yeah.
Got a couple ones here. So how can you know if the indicator is working correctly, or I guess, if it's working well on a symbol?
Yeah, we look at the win rates, the predicted statistics, or the actually measured statistics over time. So they tell you right here, hey, the long direction has worked out exceptionally well at 85% win rate. Short, not so much. And in fact, for this one, I probably would never trade it short. It's too low of a win rate. I would wait for a long signal come along. And if I combine this with a pullback of trend radar, I can really get interesting entry opportunities with very little risk on the table and a very promising win rate. Now, as mentioned, put all this together. This is exactly how we found our trade of today. Now, I can see I'm running a little bit out of time, so let me explain to you how can you get hold of this great combination of indicators. Well, first off, who are these indicators for? Well, it doesn't matter whether you are a day trader, a scalper, a swing trader, or an investor. These two indicators, they will work on all time frames and chart types, period. We focus mainly on daily charts today, but they work just as well on the intraday timeframes. Also, it doesn't really matter what you trade, whether stocks or FX or futures or cryptos or something else. These two indicators will work on all asset classes and symbols. And they work great on Metastock, fully compatible with Metastock 19. But if you don't have Metastock or perhaps use a second platform, don't worry. We also support these two indicators on MetaTrader, NinjaTrader, TradingView, of course, Thinkorswim, MorphiWave, and so forth. And if you are a bit of an engineer like me, I'm a software engineer, and you believe that tools can make your life easier and good trading tools can make your trading life easier, then these indicators or these two indicators are definitely for you because they will do most of the heavy lifting for you. So that you as a trader, you can focus on what really matters, which is making that final trading decision, because the indicators will do everything else for you. They will tell you how well they are performing. They will pick the best parameters for you, and they let you scan for signals. Now, all these time-consuming things are taken away from you. Now, to celebrate the arrival of SuperTrend Bullseye with Metastock, we have put together a very special offer for you, which you can get at tradingindicators.com/597. Why 597? You're going to see in a second. So Niklas, perhaps you can put this link into the chat box as well. Now, what does this bundle include? Well, first off, you're going to get our SuperTrend Bullseye indicator for life. So everything I'm going to tell you right now is for life. So you get this indicator with auto optimization and with win rate prediction. Secondly, you will get a whole bunch of bonus offers. The first one is you will be invited to our exclusive members only trading sessions, which take place every single Tuesday at 12 p.m. Eastern. We don't believe that you should be left alone with these indicators, at least not in the beginning. We're going to take care of you. We're going to tell you tips and tricks. We're going to use them to analyze the market. I'm going to share with you what we consider as important, how we look at things and so forth in these weekly trading sessions to which you will be invited. Secondly, you will get our trend radar indicator, which we see as the perfect complement to SuperTrend Bullseye, also for life. And thirdly, you will get our ebook on how to use these two indicators. Now, but it doesn't stop there, because there's one more thing. We're also going to slash the price to only $597. That's exactly why this URL is like this. It's tradingindicators.com/597 to take advantage of this special bundle offer. As a big thank you for taking time out of your mornings if you're in Australia and to listen to me speak. So tradingindicators.com/597. All right. With this, we do have time, I guess, for one or two symbols. Niklas, are there any symbol requests?
Yeah, there was a couple. Could we please have a look at Apple? And then the other ones were Google, Amazon, and Tesla, but whatever we have time for.
Yeah, maybe just one or two of those. Let me go to Apple real quick. And I guess that's probably the daily time frame. All right, so back to the chart. All right, Apple, which is apple.o. On Metastock, open chart. Okay. Okay, it's loading, just a second. All right, okay, with Apple, you can see here, classic super trend here as well. Stop and reverse, every long entry signal goes to a short one, then long one, short, and so forth and so forth. And currently we are long, so Apple switched over on this retracement from this low point here to a long trade. If you go down here, what do we see? Win rate 50% to the long side, 33% to the short side. But as mentioned before, this doesn't have to be a bad sign, especially for the long trades. 50% is not bad because the overall profit factor is 1.47, meaning this is a profitable trading system, at least historically speaking. And once again, look at the size of the winners as compared to potential losers that we have. Like losers are really cut very short. We let winners run for a long time. This is why even a 50% win rate, and with bigger winners than losers, you can still be quite profitable. And I think we are running out of time. So perhaps just one reminder, if you want to take advantage of the specials, tradingindicators.com/597, and 597 is the special bundle offer which we have prepared for you. You will not be left alone. You will be invited to our exclusive trading sessions. Next one is tomorrow, actually, at 12 p.m. Eastern time. And they're all recorded. So if that is outside your time zone and you're sleeping at the time, don't worry. You can watch the recording afterwards. And you'll also be invited to our Discord channel. I forgot to mention this one, where you can ask questions, learn about tips and tricks, and you will get our trend radar indicator for live. So both indicators for live as well as our trading sessions. So tradingindicators.com/597. All right, Bobby, I think that is it for my time, correct?
Yeah, thank you, Daniel. Fantastic job as always. Really happy that we could have you on today. And yeah, you had a great presentation. So thanks for that.
Yeah, thank you guys. Thanks for having me and enjoy the rest of the conference. Sorry for talking so much. I saw that some questions are coming in. I hope Niklas answered most of those questions in the chat. That's it for my part. Have a great evening, guys, or great morning. Bye-bye. Thanks, Bobby.
Cheers.
Bye-bye.
All right, guys. So I'll go ahead and make myself the presenter here. Let me get to the right spot. All right. So yeah, that was Daniel there. He did great, as I knew that he would. He always puts on such a good presentation. I like how he kind of follows the markets. I love what he's been able to do inside of Metastock with his auto optimization. All of his indicators are so well put together inside of the platform. So he has some great systems you guys can check out. Also, so that everyone knows, and this goes with anything, whether you have his trading system or if you just have Metastock on like a trial basis, anything like that, we always offer free white glove setup and installation service to all of our customers. We give free unlimited support to you guys, and we have a ton of recorded training that's available as well. And we also have kind of like a bundled offer put together where you can get Metastock, you can get some of the systems you've seen today, including the SuperTrend Bullseye, and you can get that at metastock.com/summit-savings. And here's kind of the bundle offer for that, but you can use the link that Daniel just shared, and we put it in the chat as well if you're just interested in that SuperTrend Bullseye. I want to say thanks again to the ATAA for sponsoring today's event. They've been a fantastic organization. Our next speaker, actually, Darryl Nagel, he's been a part of them for a really long time. He also helps to run certain parts of it that follow like the Candlestick forum and Steve Bigelow's trading strategy. He's helped us to connect with ATAA and things like that as well. So that's been fantastic for us. And today he's going to be presenting for us all. So I'm really excited for this. We've been talking for years now, and he has presented with us in the past, but it's kind of like a rare occurrence. So I'm really excited to have him on again today to kind of share his knowledge with you all. And I think it's going to be really exciting. So, hey, Darryl, are you with us?
Yes, I am. Yes, I am.
All right, fantastic. Yeah, thanks again for joining today and for helping, to bring in some of the audience that we have. So we're really excited to have you here. So what I'm going to go ahead and do is I'm going to change the presenter, and you should get a pop-up on your screen here in just a moment, asking you if you want to be the presenter, and you'll say yes, and that you want to share your screen. And you should see that pop up now.
Yeah. You have been made the presenter. Please close confidential windows. Oh, I better do that.
Yeah.
Let's see if this works.
Okay. So I see you're connected to GoToWebinar screen.
Now, I need to show my presentation. So let's see if this works.
Perfect. Yep, I can see the psychology behind price action, understanding trader behavior, learning styles, and decision making.
Excellent. Well, good morning or good evening, wherever you are. This is my disclaimer that, whoop, there we go. We've just lost, did we lose?
Oh, I'm still here. I was just taking off my camera to kind of let you take it from here.
Right. Not sure. Can you see my, whoops, there we go.
Yep, you're welcome to share your camera or not, it's up to you. But we can see your screen and you.
Okay, so my disclaimer is that this presentation is for education purposes only, and it doesn't take into account your financial position. And I'll just get rid of, just bear with me. I want to get rid of that. And no part of the presentation is intended to provide financial product advice, and always seek prior financial advice before acting on anything stated in this presentation. And as we all know, all trading involves financial risk. Okay, I want to say some thank yous. Firstly to the people at Metastock. Bobby, thank you so much for organising this. I know there was a lot of work, particularly vis-a-vis the ATAA and of course Jeff Gibby. I'd like to thank our national president, Jim Harold Lambinis, for facilitating ATA's involvement. I want to thank Greg Rowbottom, who I'll come to later on in this presentation. You'll understand why I have a thank you to him. And I want to thank you, the people who have joined us. Thank you for giving up your time, and I'm hoping that this presentation will assist you. Before I just talk about uncertainty, I just wanted to acknowledge Daniel. I really enjoyed Daniel's presentation. It's interesting that he's got an academic background, attaining the status of a professor. I'm doing the reverse. I'm a trader hoping to become an academic, so I'm in the middle of a master's research project with Central Queensland University, and hoping to eventually get my PhD on the thesis of the application of probability theory by retail traders in order to reduce emotions and attain superior decisions. I've always felt that this area, it's good to have some academic rigor around it, and with my bonus that I've offered, I've got some really interesting, I think, tools to assist you with regard to what we're talking about today. So I'm starting off with the concept of uncertainty, and really the financial markets, as we know, are really operating at a very high uncertainty at all levels at this very moment. And the impact of tariffs have actually led well-respected banks such as Goldman Sachs and JP Morgan, that they've raised the odds of a recession due to the tariffs. Now, whether that occurs or not, it doesn't, that's just the odds of a recession. They're not saying they're going into a recession, but I believe that we are able as traders to take advantage of whatever is happening in the markets at any particular moment. Certainty is something I think as a trader we all really want. It's part of our DNA. And of course, the markets themselves are seeking certainty from politicians and institutions such as reserve banks. When there is uncertainty in the financial markets, they certainly let us know. And as I say, traders crave certainty. It is part of our DNA, and we will do everything to attain certainty. But of course, we are looking for certainty in the outcomes of our decisions. We want every trade to be a winner, understandably. And so what many do is to use technical analysis to forecast or predict their trading outcomes. And if that is you, that's fine. What I'm going to be saying today is not to take away anyone's approach to the markets. You're entitled to your approach. I'll be giving you my approach. I'm not saying my approach is superior, but it works for me. And I think that's the important thing of having an approach that really works for you and your own psychology. Now, my mantra at the micro level is that markets are inherently uncertain. And so that's the very opposite of what we want. But to me, if the markets were certain, we would not have markets. So the very thing that we crave would actually, in my mind, kill the markets. But that's at a micro level. At a macro level, and Daniel was touching on some of these aspects, at the macro level, of course, we can look at forecasts. So some traders believe that the certainty they seek is found in risk management, and that's me. I believe that the only certainty I have with my own trading is with my risk management. So before I take a trade, and Daniel showed this with his approach, that I know where I'm getting in because of the nature of my order. It'll be a buy on stop or a buy on sell order. So I know in advance where I'm wanting to get into the market. I will know where my stop loss is, and importantly, where my at least initial profit point is, and that's related to my risk reward ratios. Many traders use skillful responses to market price movements rather than forecasts or predictions. And so that is me. However, I do focus on price action. That's really the nature of this, but indicators do assist. So in a way, I could say that I'm a hybrid trader. I don't ignore indicators, but my primary focus is really on price action, because I believe the market is always telling me something all the time, and I really do need to listen to what the market is telling me. Sometimes it's hard because we have expectations. We'll talk about that in a moment. So why does price action deserve our focus? Well, to me, it's immediate. There is no doubt about price. It's objective, it's not subjective. And that's one of the reasons I got involved with technical analysis. I started trading back in 1986 and I've been trading ever since. And to me, what I really appreciated about technical analysis is the fact that it is objective. Price is objective, volume is objective. And I know we've got an excellent speaker later on talking about fundamental analysis. And in a way, and certainly fundamental analysis can also be part of our analysis. And I will be talking about probably a variation of fundamentals as far as geopolitical issues happening today. So price is immediate. We know exactly what the price is. It reflects supply and demand. And importantly, it's the sentiment. One of the wonderful things I believe that we can take advantage of is the sentiment in the market. So as long as we've got a technical approach, we don't have to be caught up in the emotions. And of course, that's really my focus about psychology, the emotions that and cognitive biases. So what a price does is reflecting the decisions of the market participants now. And so it's being in the now, listening to the market all the time, trying to take away as best I can any expectations I have. We are human after all, but that's the reason why I like price. Now, indicators at its highest level are historical. They are interpreted, so to some extent they can be subjective, and they can be prone to false signals. So please, I'm not saying ignore indicators. You'll see that I do embrace indicators with my own trading that I'll be talking about in this segment. Now, this is not a photograph of me. I have far less hair and I don't do board riding, but living in Sydney, I've lived in Sydney all my life. We're very blessed with some wonderful beaches, and of course around Australia we do have wonderful beaches, and of course there are overseas as well. And the reason for showing this is the fact that for me this reflects my philosophy, the psychology of price action, because for me I want to ride with the wave. So anyone who has ridden a board, you know that you're intuitively experiencing which way the wave is breaking. That is important, because if you try to place the board in an opposite direction, you're going to get dumped, and it's very unpleasant for those of us who have been dumped at the surf. That is, you get sand up your nose and in your mouth. It's very, very unpleasant. And so it is same with trading for me. It is like riding the wave. It's, in other words, for me, technical analysis is less about the analysis and more about the experience of actually trading. So for me, we respond to the market action rather than having expectations. That is one of my approach. Now we're going to look at some examples of price action, and I'm adopting the price action methodology that was taught by the late Steve Bigelow. And what you'll see with all my charts, it embraces a template that comes with the Bigelow method that Metastock has. And so this is the methodology I use. I'm not expecting you to look at all of the indicators, etc., on it, or the interpretation of what's happening in the market. But because I use this template, it's easier for me just to use this template. But I will be actually explaining more about the approach of price action as taught by Steve Bigelow. Now, with his approach, he identifies just 12 major candlestick signals. And I must confess, as I said before, I started trading back in 1986. I studiously avoided candlesticks signals because I thought there were just so many of them. I can't cope with too many signals at all. And even of the 12, I just focus on one or two, which I believe are my favorites. But he has reduced all of the 50, 60 possible candlestick signals that are available for the whole marketplace, not only just his approach, 6 bullish, 6 bearish. But in addition to these signals, he also has 30 candlestick patterns. And I've just got a few there. But if you want to view the recording of the ATAA Bigelow Network meeting that was held on the 7th of February this year, there is Greg Rowbottom provides an overview of all of the 30 candlestick patterns. Now, for those of you who are not current members of the ATAA, I know that Bobby will be telling you about the latest offering by the ATAA, and I will briefly mention it as well. Okay, so this is the site of the ATAA Association. I joined it back in 1996. No, 95, I tell a lie. I joined it back in 1995 in Sydney, and I gave my first presentation to the ATAA on the subject of the psychology of trading, and it is in the, it was published in the newsletter in July of 1996. But anyway, less about me. Let's have a look at some of these resources that I want to talk to you about. So when you go into the resource aspect of the ATAA, and you do have to be a member to get into here, but as Bobby will tell you, it'll be very easy for any of you to be able to access these resources. And we go down to resource library folders, and I'm going to go into the member resource library, and there are various groups there, and the first one is the Bigelow Network Special Interest Group. And if we click on that, you'll see that we started this Bigelow Network Special Interest Group in the ATAA back in September of 2022. Initially, and these are hosted by Romy Baker, who I'll mention in a moment. Initially, they were every fortnight, but eventually we then made them monthly. The March meeting is not up there yet, but it will be very shortly. But the 7th of February 2025, it really is an excellent overview that Greg Rowbottom gives to all of the patterns. And rather than me, I wouldn't have time in this presentation to go through all of the signals and all of the patterns, but it is worthwhile your time spending just a few minutes with looking at that presentation recording. I just do want to also mention, for those who are Forex traders, that Romy Baker also runs the Forex Network Special Interest Group, and there are the recordings of those. And in fact, at the last meeting, which was held on the 9th of this month, I did talk about price action, but I dealt with a different add-on to Metastock called Elasticity 2. And if you're interested in that with regard to inside candles as a price action methodology, I would recommend you have a look at that. There is also the Metastock user group. I started that back in quite a little while ago, back in 2020, and the Vice President, Jerry Bongard, now leads that, and there are some really interesting ones there for Metastock users. And in fact, as you'll see, I did talk about price action at the last meeting. Okay, so there are also forums that we have. And if you go down to the forums, you'll see there's the Bigelow Network SIG, and there are quite a large number of threads and posts there. There's also the forum on the Forex network. So here are some of the things that Greg Rowbottom, who is incredibly excellent with regard to the Bigelow method, he has quite a number of posts that you can look at. Now, the next ATAA Bigelow Network meeting is coming up on the 2nd of May. It is led by Romy Baker. It starts at 7:30 Sydney time, and so you are welcome to come to that. So we're just going to look at some examples of price action. And as I say, I'm using the latest Bigelow add-on developed by Steve Bigelow and by Jeff Kibbe at Metastock. And I don't have to say anything. I think this add-on does speak for itself. So the Bigelow approach is price action, but it is supported by indicators. So I'm a hybrid, you could say. And so the filters are provided by stochastics and by moving averages. So we're not using necessarily getting into a trade or out of the trade by using indicators. We're getting them by those at points by price action itself. But the moving averages are very, very interesting particularly because the way that institutions and professionals, as well as us retail traders, also look at these moving averages from a point of view of support and resistance. So the red line is the 200 simple moving average. The blue line is the 50 simple moving average. There is the 20 simple moving average, which is just part of the template. The important one, in a way, is the 8 exponential moving average, and that is the one that Steve calls his T line, his trigger line, and that 8 exponential moving average provides the level of support and resistance and determines entering the market and actually exiting the market. The 3 exponential moving average can also be used to refine your entry and your exit. So you can see that I've indicated the stochastic oscillator because it operates as a filter for looking at overbought and oversold situations. Excuse me. Now, I'm just looking at the XJO. I just won't be a moment. Looking at the XJO, which is the ASX 200, I'm starting off with a monthly chart and looking at it through the lens of the Bigelow template. And you can see with the last, just bear with me for a moment. I'll just pull up my laser pointer. Yes, so what we've got here is a very interesting doji symbol. You can see that it's quite a dramatic one for this month, and I think it also showed in Daniel's charts how dramatic this has been this current month. So let's move on to the next one, which is the weekly chart of the ASX 200, and you can see here, excuse me, how notwithstanding we had that sudden downturn, and there was a reason for that from a fundamental or geopolitical reason. Some people might say that the markets are overbought, but what is interesting is what is the market doing at the moment on a weekly chart. You can see that we've got an up candle for the last week. Let's have a look at the next one, which is the daily chart. And I just want to stop here for a little moment. What do we see here from a price action point of view? So let's look at a couple of things. First of all, the price is below the 200 moving average and also the 50 moving average. So price is below those 2 significant moving averages. In addition, the 50 moving average has crossed below the 200 moving average, and that is often called the death cross. You have the golden cross when it goes the other way, but here, what is the moving averages, and they are lagging, of course, but what are they saying to us? We cannot ignore these moving averages. Also, we do have a divergence between price and the stochastics. So the price is moving up. You could see that stochastics were moving down. That could be for those people. It's easy in hindsight, but you can see what a dramatic turn of the price action and the trend was when that divergence occurred. So the question, I'm just putting this out as a question. I'm not saying I know what the market's going to do. I've got absolutely no idea what the market's going to do. But for me, I don't have to know what the market's going to do for me to make money. And I just look at, say, casinos. They do not know which marble's going to come up on a roulette table. They don't have to know. Of course, if you did know, there wouldn't be any roulette game. insurance companies do not know which policy is going to be the subject of a claim. But the reason they don't have to know is their methodology, which of course is based on probabilities. And so again, the probabilities is, would the focus now be looking at selling the rallies? So this is a little bit of an opposite view to Daniel's. Mine is not superior to Daniel's, they're just different views. And I'm not saying that the focus would be a profitable one. I'm not interested in that side of it. I'm just looking at it from a technical analysis point of view, that having regard to what the moving averages are telling me, and also there is another factor, we've got lower highs and lower lows. And for those who've been, I started off with GAN, you know that, GAN and other methodologies, the Dow principles, lower highs, lower lows, that means that the trend is down. Okay. Also, I always have this idea of no expectations. And I will be also saying something about what the market is saying to me, so obvious, but we'll get to that in a moment. This is the 4-hour chart of the ASX 200. You can see that price is below both the 50 and the 200. It's interesting where price is with regard to the 50 moving average. It is above the 8 exponential moving average. So at this stage, you could say that is potentially bullish on a 4-hour chart. And on the 1-hour chart, you can see that the price was between the 200 and the 50. Just stopping there, I always take the 200 moving average and the 50 moving average into account if I'm taking a trade, because what I like and prefer is a risk reward ratio of 1 to 3. I am always wanting to have a high reward to risk, and I may not take a trade which could turn out to be a very profitable trade, but I'd rather pass with that. And actually Daniel mentioned this, that sometimes not trading is a good approach to the market. You can see that price on an hourly chart on the ASX 200 has now passed through not only the 50 but also the 200. So one could say on that basis, on an hourly chart, it's bullish. Daniel was mentioning about the scanners in Metastock, and what is amazing to me of all of the add-ons, and I've got quite a few add-ons from Metastock because I really enjoy going through them. You can see there are 1, 2, 3, 4, 5, 6, 7, 9, 11 explorations. Time doesn't permit to go through all of them. I'll just go through a couple, but this is what a wonderful job that Jeff, Gibby and Steve did when they were putting this all together. I'm just going on to this first one, a bearish one, because I probably am a bear. I loved also Elliott Wave, and often they say Elliott Wave theoreticians love being bearish. Excuse me. And there was just one. There was just one, which is Super Retail Group. And let's just have a look at that. And as Daniel mentioned, there is also the commentary window that comes with this add-on, and what it's showing with Super Retail at the moment. Excuse me, and obviously this was from the last trading day of Thursday. We've got something called a downside Tsuki gap, and what is nice about this commentary, it actually explains what this gap is, and you can Google it yourself and you can see that it's a well-known one, and I've just put there what Google is saying about it, that it's saying that it often signifies a continuation of the prevailing trend as the market sentiment aligns with the dominant force. So what are we seeing here? What is the dominant force? What is the trend? If on the daily it's lower highs and lower lows, I would have thought the trend is down. And in fact, the 50 moving average is pointing down. The 200 is starting to move down, but that's getting ahead. Is this going to be a profitable trade? I've got no idea. I'm not putting forward this as something that you should actually trade. You could look at it from an education point of view. It doesn't matter. One of the things I like about this particular one is where the market closed in relation to the 8 exponential moving average, because I like to put my stop above the 8 exponential moving average, because Steve talked about it, is the market closes above the 8 exponential moving average, you should be taking some action. But I then will like to have a risk to reward, or put it around the other way, a reward risk of 3 to 1. And because the moving averages, the 250, are above price, I believe that the odds may be in my favor. I emphasize may, to be able to get a 3 to 1 trade. Okay, let's move on. This is another exploration that I ran, and as you can see, there were 38 results, and where there's a 1, that means that particular pattern or that particular indicator is applicable. And I've just gone in and just had a closer look. I actually like Doji Best Friend. Now, what is the Doji Best Friend? It's just simply a doji, which is indecision, and a gap up or a gap down. And because at the moment, we've got a bit of a bullish approach, you can just select these, as you can see, and I'm just going to, you can see I can click here to look at the charts. And this is the first one. I go from the bottom up. And what is interesting is something, again, that Daniel said. Sometimes the best trade is not taking a trade at all. And this is one of the, I think, important things of looking at filters. So we've got the doji, which is basically indecision. It's interesting, that term, in a way, when you think about it, because the doji is usually the open, well, typically the open and the close are very close together. So in one way, the buyers and the sellers have agreed on what they think is the appropriate price. But the indecision, of course, is with regard to the trend. Is the trend continuing to go down? So we've had a few dojis, as you can see, but here there was a gap up, and so this is what Steve called a doji best friend. So we would not have known. I obviously did this a few days ago because I wanted to be able to show what does happen when you go into one of these trades. And so, yeah, if we went in on this day, another day of the indecision. So Steve always liked to have confirmation. In other words, never get ahead of yourself with price action. It is often good to wait and see if there's confirmation. So here we would say, well, okay, the market is telling me something, there's indecision. I'll wait a day, and what has happened? It's now saying to me, hey, it's closed below the 8 exponential moving average. This is not perhaps a trade I should be looking at. The next day, yes, it did close almost at the 8 exponential moving average. It was really like a level of resistance. But what else is happening here? We've got the 200 pointing down, the 50 certainly moving down, and when we get to the stochastics, it's not in the oversold position, but we can see that there is, the momentum is perhaps changing. Let's have a look at the next one. Very similar again. So we'll find that all of these trades, possible trades that were identified, may be not ones that we would want to take. Now, it's easy in hindsight, but let's have a look. Here's the doji, gap up, but it's still below the 8 exponential moving average. we like to wait until it closes above the exponential moving average for confirmation. We look at the next day. What have we got? Indecision. The market is telling me, Darryl, this may be something that you could pass on. The next one, again, we've got the doji gap up, waiting, and you can see that it barely closed above the 8. Indecision below the 8, closed below the 8. This is not a trade I want to take. Again, the 50 and the 200 moving down, and the stochastics, it looks as though the momentum is changing. This is even more dramatic with Coronado. Enough said. What I've said before applies, and particularly here, because the market never got above the 8 exponential moving average. But you can see with this, the trend is certainly down, not up. And that's fine. This is where these indicators are able to assist with price action. Excuse me. The Breville group, again, exactly the same. No difference at all. And in fact, the sentiment has actually changed there. Okay. I'll just pause for a second. My mantra is the market goes up by the stairs and down by the elevator. Now, you've heard this before, but what does that mean from a price action point of view and for me as a trader? So what it means is this, that I focus on the short side when appropriate. Now, that doesn't mean to say I don't take long trades. Of course I do. But I really love it when I believe the market is telling me that perhaps this is ideal on the balance of probabilities to be short. And so the question is, and it's only a question, it's not advice, is now the appropriate time to focus on trading on the short side? What Daniel showed you with the SuperTrend, you can trade on both the long and the short side. But price action will tell me whether it is appropriate time to focus on trading on the short side. So what we can see, what we saw before this chart of the ASX 200, the market was sort of almost going sideways, but what you can see is the market goes up, it tends to go down quicker, it grinds its way back up again, bang. So to me, I believe this is where I can get a reward risk ratio of 10 to 1 and more. Okay, the market then goes up, grinds its way up, but look what's happened, bang, down again. It's grinding its way up. It could grind up higher. I've got no idea, it doesn't matter. But what I'm wanting to see is there a place where I can take advantage of the next leg down if there is another leg down? I thought I'd just briefly talk about Forex, mainly because it was trading last night. So the Forex market opens up at 5 p.m. on Sunday, which is 7 a.m. Monday our time. And of course, it was a holiday for the equities here in Sydney. But let's have a look at Forex using this template. And this is a weekly chart, which probably not many Forex traders would use, but I like to start at the weekly. And what's interesting is that the Candlestick profit system brought up a pattern called meeting lines. And whilst I say it's a rare indicator or a rare pattern, I think you'll find in Forex it's more common than with equities. I'll just leave you with that thought. So what is the market really telling me at this stage? I believe it's saying to me that it's potentially continued to be bearish, notwithstanding the recent action. This is the weekly chart. It speaks for itself. The price is underneath the 250 moving averages. This is the daily. Often I've found some of the equities that I've been looking at where price, I know this is Forex, but with the same with equities, where price is trapped, if I could use that term, between the 200 and the 50, that is when I take a break because I just they are levels of resistance and support, and it's not where I want to be. It's interesting if you look at this, at not only are they these meeting lines, that is where the last two candles are equal, so to speak, but look where the stochastic is. It's in the oversold position. That's on, of course, a daily chart. And with Forex, typically and of course with equities, you want to go lower. And what's nice about Metastock, the version I've got, is I'm able to drill down below the dailies. So here is the same information on a 4-hourly chart. Again, you can see, yeah, the market's grinding away here, bang, grinding up. What's going to happen? I've got no idea, don't have to know. I can still be profitable without knowing what's going to happen. Here we've got, excuse me, the hourly chart, and you can see that at the moment the market is coming up, and this is what Steve called a cradle pattern, and you can see that in this commentary, which is an excellent add-on. This is the 30-minute chart, and so when you're getting down to this level, this is where a lot of people refine their entries, their exits, and of course scalpers love getting down to this level. And you can see that it's very bullish at the hourly, and both the 200 and the 50 are pointing up. We're getting now down to the 10-minute chart. Again, it speaks for itself. You would think that this would be the case. And this is the 5-minute. This is the 1 minute. We can go to a tick, but you can, and again, just with quickly looking at Steve's approach, where the market is above the 8 exponential moving average, the market is bullish. If it's below the 8, it's potentially bearish. Okay, now there will be an excellent presentation later on today. You're in for a treat with regard to the fundamentals. And it's not that I don't look at the fundamentals, but to me, this is just Darryl's own approach. They are subjective. Do they help? Of course they help. But I like something which is objective. I like the scientific approach. That's why I'm drawn to academia. Whilst Daniel's left academia, I'm wanting to join it. I'm a bit slow in doing that. But I just wanted to talk about some factors that may influence price action, particularly at the moment. I think we are in, I know it's a hyperbole to say we're in a unique position as traders, but let's have a look at some of these factors. First of all, the US bond market. The bond market, I understand, is 4 times the volume of the equity market. And it is it's like almost a canary in the coal mine. We really, I think from here on, have to really address the bond market, what it is doing. Here is a Metastock chart of the 10-year bond rate, excuse me, and you can see what has happened recently. So we did have the bond market coming down. Now, what's this representing is the interest rate that people receive by going into bonds. So at the moment, yeah, on the basis that equities are going down, then you would, and inflation in the US is going down, and I believe in all of the Western world, probably here in Australia, not quick enough, nor in America. But what has happened is all of a sudden, the bond rate went up, and that really spooked the equity market. This going from here to here was really a spook of the market. There are 2 factors. Of course, if you buy bonds at a rate less than this rate of 4%, you're really in a capital loss position. Excuse me. So there's a bit of a divergence. Typically when equities go down, bond prices go down. But there are factors that are causing the bond market to go up. And that is not, people are not happy, Jan, about that. So that's the bond market. The next is Jerome Powell, who's the chair of the US Federal Reserve. So as in America, as here, the chairman of the reserve banks are independent people. And so they call it the way they need to call it. Their job is to keep inflation down because it's believed that that is not a good thing. So at the moment, what Jerome Powell has got is a really tough situation, because there are other factors, which we all know, are causing potentially prices to go up in the US, and they may also here in Australia. That causes the inflation, and that would mean that it would be a challenge for the US Federal Reserve to reduce interest rates, which one would expect. And on the basis that the market is going down, you would think that that reflects what's happening in Main Street. So there is this dichotomy now. This is a really unusual situation where potentially could be for a short time. I'm not sure. I don't know. I'm not an economist, but there is this factor now that I believe we've got to take into account. And this is being a lawyer, I can't help myself. I've got to talk about some acts. There is something called the Insurrection Act of 1807. I'm not going to go through it, but I would urge you to go to the Google, and you will see why this is something that's being talked about in the US that may affect price action. Okay, now when I was with an education company back in 2003, I was drawing charts by hand, and many people in the ATAA actually did that. They were drawing their charts by hand. And for me, from a psychological point of view, I believe that was very powerful. And it's this unusual concept I call being one with the chart. Because you're actually drawing the chart, you're really one with the price or what other indicator you may want to put on there. But we can look at this concept of being one with many sporting activities. And one, which I've shown just recently, was board riding. So what you're doing is, from an ideal point of view, you're one with the wave. You want to be one with the wave. There is no boundary between you. Golf, being one with your golf stick, and skiing, one with the mountain. That brings me on to this chart. And you can see a photo of Greg Rowbottom, who I've mentioned before. Greg does not draw his own charts. He's obviously using Metastock, and not only that, he has been a long-term user of the Bigelow approach. He was a long-term user of the Candlestick forum, and now Jeff Gibby has transformed that into a traders forum, where you can still get the benefit of working with and chatting with fellow traders who use the Bigelow method. Why I wanted to show you this is the closest I believe we can come to this concept of being one with whilst using Metastock charts. So what Greg does is he marks up his chart as you can see it. They are not Metastock or Bigelow chart, marking us up. These are Greg's own markings up. And I think it's brilliant. It's a form of journalism, journaling in a way, but I think it is brilliant. It is so inspirational. And of course it does take time, but he is a trader's trader. And you can see that he not only marks up the charts on a daily basis, but he also marks them up on a weekly basis as well. So that's why I would invite you to look at the recordings that Greg has made. And at each of the meetings, and I've told you when the next meeting will be in May, he goes through the American market, the Australian market, and shows you his marking up of the chart. It is inspirational. And to me, this concept of being one with, relates to me with what Mark Douglas talks about being trading in the zone, because I believe being one with the chart is really being in the zone. I'm going to finish on this basis. I have, as the bonus, provided details of what I'm going to show now. This is the psychology behind price action. So to me, price action is more than just chart patterns. It reflects the psychology of the traders: fear, greed, conviction, and hesitation. The good news is we can take advantage of the emotions in the market, the sentiment in the market. And let's face it, it's the sentiment that it moves the market, not necessarily fundamentals. But understanding how traders think gives us this insight into how the market moves. And I love this quote from Van Tharp, that you will always have an external struggle with the markets and with systems until you master the internal struggle within yourself. And of course, people often say, well, how do I do that? And there are various methodologies. My approach, and it's reflected in my academic approach, and that is I like to think of mathematics meeting psychology. So rather than looking at the soft psychology aspects, I look at, as a technical analyst, how can mathematics assist me to deal with my emotions? And it is, of course, using understanding and mastering probability theory. The price action reflects crowd psychology. So there are supply and demand imbalances. There's herd behavior in trends, and particularly with the market going down. I mean, why does it go down by the elevator and up by the stairs? I believe it's the herd behavior. And it's because of one cognitive thing that I'm going to come to. There is fear and greed in breakouts and fakeouts. And these are some of the that you'll see in the bonus, the details of this approach. The candlestick patterns as emotional footprints. Doji represents indecision, engulfing, reversal conviction. Inside bars, I didn't talk about inside bars. If you're interested in inside bars or inside candles, and you're looking at a meta stock add-on to assist you, elasticity 2 is something that I use with regard to inside bars. Behavioral biases in action, and this is where academia comes into its own. And Daniel Kahneman, Thinking Fast and Slow, he is a brilliant scientist. He's written several books. Unfortunately, he's passed now. He did get the Nobel Prize. So there is a recency bias, so we chase recent price moves. This is the biggie: loss aversion. We hate losses with a passion. We will avoid stop losses, or we exit early. There's confirmation bias. I'll go through this a little bit quicker. There's volatility that increases emotional reactivity. Overtrading can be a psychological relief, and revenge. And so just with the overtrading and psychological relief, just going back here, I mean, people often gamble because they find it fun. It's a psychological relief. And some people do trade because of this fun that they get. But avoid revenge. And there are various styles and personalities. You can be impulsive or systematic. There's risk tolerance and confidence. There's the illusion of control in discretionary trades. That's one of the reasons why I like to be a systematic trader. So with discretionary, there's high emotion, flexible decision making. With systematic, is rules-based, and it does help to reduce emotions. There are various archetypes. Some people are visual, some people are analytical, some people are kinesthetic. And there's also something called metacognition in trading, it's to be aware of your own thought processes, journaling for feedback and growth, learning from your mistakes, but the mistakes are not necessarily an unprofitable trade. It is natural and normal to have unprofitable trades. Daniel Kahneman's book, Thinking Fast and Slow, is excellent with regard to understanding System 1 and System 2, and it's available in Kindle. It really is an excellent read. And to me, traders must shift from a reactive to a reflective mode. And I'm a big fan of, as you can imagine, the power of probability thinking. It does focus on expected value. That's how the casinos make money. That's how insurance makes money. They focus on expected value. There's a mathematical formula for it. They don't focus on outcomes. They avoid the concept of certainty. They embrace the law of large numbers. That's one of the reasons why sometimes your trading system may not give you the result you want, because notwithstanding you may have an edge having regard to expected value, if you do not have a significant number of trades, then that edge may not kick in. There can be decision fatigue, and that's why sometimes, if you've got to make more decisions, there's more fatigue. Systematic rules do reduce the mental load. Simplicity is so important. That's an overview of Steve Bigelow and price action. The tools that I use is the Candle Profit System 3. The President, Kelly Clement, helped me with the Metastock conference that was held in Sydney last year, and it's what I use. I just wanted to reflect that the ATAA does have a deal at the moment. If you're not a member of the ATAA, you can become a member as a new member for $1. Look at the terms and conditions. And I have, as I said, provided as a bonus the various resources that I've used. So the closing thoughts is, price action is a psychological map of the market. You can understand trading behavior, your own mindset, and how you make decisions. Use price as your guide and develop a trading process that matches your psychology. That is important. If you're interested in following up anything I've said, this is my email address. And with that, I'll hand back to you. Thank you very much indeed for your attention.
Hey, thanks, Darryl. Fantastic job there. I'll go ahead and just make myself the presenter so you don't have to worry about leaving and accidentally closing anything here.
Thank you so much. And thank you once again, Bobby, for everything. Take care.
Take
care, everyone. Happy trading and keep safe. Bye now.
Bye for now. All right, guys. So yeah, Darryl did a fantastic job there. We do have an offer for that ATAA to get the $1 membership. You can see the link right down here. I'm going to actually, let's see if I can share this in the chat here real quick for everyone. All right, there we go. And Greg will share it on the YouTube side because I'm actually not able to do that there. And so a big thank you again to the ATAA for their sponsorship of the event. I also, I don't want to take up too much time. I had just a few slides prepared here on like the Candle Profit System 3.0 that Darryl had spoke about kind of throughout his entire presentation. But as you can see with CPS 3.0, we have a ton of patterns included inside of Metastock, and you can have these automatically identified on your chart. You can get commentary on them. You can run explorations to search for them. So you get multiple expert advisors. The ones highlighted in yellow are the newer ones from the CPS 3.0 that we released with Bigelow. We also have multiple templates. You get all of these explorations. You can also like scan his universe and then scan for the different types of patterns that you are interested in. And the Candle Profit system has been like our top selling add-on for a number of years. A lot of people in the office utilize it on a daily basis, like Metastock employees. It's one of the favorites for customers and employees. I utilize it myself. And so you get over 58 patterns, and the retail price on it is $697. And also, so you guys are aware, we've actually kind of taken all of Steve Bigelow's training, the different training courses that he's done throughout the years, and these have been offered at various price points for like his GAPS course for $500 or his Candlestick bootcamp training for $700. We have all of this plus a lot more actually on the tradersforum.com, which is something that we kind of help run, and we have access to it. And normally you pay $47 a month to get access to the Traders Forum and all the different training and courses on there, which include Bigelow's work. But we're actually kind of doing a special webinar offer for you guys where you can get the Candle Profit System 3.0 that's normally worth about $700 plus 3 months access to the Traders Forum membership. So that's, you know, about $150 just about for the 3 months. Total price $838, but as a webinar special, you can get this for just $547. And that offer is available by visiting, you know, metastock.com/summit-savings, or we actually have someone in our chat room right now that's ready to answer any questions that you might have. He can help you get set up on a trial of Metastock if you don't already have a trial of Metastock, and he's more than happy to look into any other promotions that you might be able to take advantage of as well. And we also, so you guys all know, offer unlimited Metastock support. And if you're looking to get, you know, a bundle where you could get the Candle Profit System 3.0 that Darryl just showed throughout his kind of presentation, as well as the SuperTrend Bullseye that you saw Daniel Sinnig present on earlier, and the 3 months access to the Traders Forum, you can get all of that for a bundled deal of just $1144, and the price for that is normally $2,194. And here's the link for the chat room, metastock.com/sales chat. I know Dave Derricott is actually in there right now helping people out. He normally would have been off work a couple of hours ago, but he's going to be with us all day today. So if you guys have any questions, you can jump into the chat room and he's more than happy to help you out there.
Hey, Bobby.
Yes, Greg.
I'm sorry to interrupt. I just want to make a point of clarification. The Traders Forum is a free forum. You can go there and join the forum for free.
Yes.
The training, the additional training you discussed it with Steve Bigelow is an additional subscription.
Yes.
But the forum itself is free, just so people know that.
Thank you for pointing that out. Yes, that's absolutely correct. And there's a bunch of conversations going on daily over at the Traders Forum. Plus, we do like weekly scan sessions where Jeff Gibby will actually showcase the results of some of his scans utilizing the Candle Profit System. All that's included for free. But to get all the special training from Bigelow, we're just including that in as part of the bundle. So you get that at pretty much no cost for those first 3 months because it's priced into the bundle to be basically free. And your total charge there, just $1,144. So really good deal, you know, saving $1,000 there. And yeah, as mentioned, the sales chat or on our website, we can help you out with that. Also available on the phones too. So if you prefer to call in. Again, big thank you to the ATAA. I did put their link in the chat. And now to kind of move on from there, because I don't want to, take up too much of his time, but we have Adrian Reid. He spoke at our last Australian event, so really happy that he was able to do that, and I'm excited to have him on again because he does such a fantastic job. Hey, Adrian, how are you doing? Oh, I think you're muted.
Hey, can you hear me?
There we go. Now I can hear you. Yep, and I can see you looking great.
Thanks, Bobby. Great to be back.
Yeah, we're definitely happy to have you again. I'm going to go ahead and make you the presenter here and kind of let you take things away. I will be available though, like if you have questions or need help with anything, I'll be in the background here.
Sounds great. Thank you so much. Let me just try to share my screen as well.
Yep, so I just sent that request to you.
Okay, can you just give me a thumbs up, Bobby, or actually tell me out loud, can you see my screen there?
Let me actually open up my other view. Now I can see it. Buying the dip, fantasy versus fact.
Okay, and you can see the next slide?
Yep, looks like a disclaimer.
Okay, so let's get rolling. Thanks for the introduction. Thanks again so much for having me, Bobby. Appreciate your time and the energy and effort put into organizing a great event like this. And before I get started with my stuff, I just want to encourage everyone, if you haven't joined the ATAA, as Darryl was saying, please do that. There's a lot of great resources in there, and as you can see, some really great offers from the presenters in this program. So make sure you take advantage of that. Okay, Bobby, my screen just changed. Can you still see my my slides all right?
Yeah, I think it's because I took my webcam off, but I can still see you and your screen.
Okay, brilliant. Thanks so much. So look, my name's Adrian Reid. I'm the founder of Enlightened Stock Trading. I've been a systematic trader for well over 25 years now, and today I'm going to share something which I think is really interesting. Some folklore around trading. You know, this idea of buying the dip is really commonly discussed. You know, if you look on social media, people will be talking about, you know, the market's dipping, you got to buy the dip. That's how you make money. But I want to dig into the fantasy versus the fact. Is this really real? Is this a good strategy? And so for the next 50 minutes or so, we're going to use Metastock. We're going to dive into this idea and really prove out whether or not buying the dip and under what circumstances this makes sense. So how's that sound? Good? Alrighty, let's get rolling. Before we go any further, as always, this is presentation is general advice, general information only. Please don't take it as personal financial advice. It's not. I don't know you. I don't know your circumstances. If in doubt, consult your advisor and consider whether it's right for you. Okay, let me ask you a question. Do you like a bargain when it comes to buying stocks? In the chat, I'd love to see yes or no. Do you like a bargain when it comes to buying stocks? Most people will say yes, and that's completely rational. We all like a bargain, particularly when we're going to the shops or buying stocks. Because buying something cheap makes us feel good, we get a deal, and hopefully we make more money. But some people may not be interested in buying bargains, particularly when it comes to stocks, and that's okay too. I'm going to cover whether or not buying bargains or buying the dip is a sensible strategy. So let's get into it. Before we go any further, I just want to share this one lesson, and this is probably the most important lesson out of the entire presentation, and that is that learning requires energy. I'm going to put a whole bunch of energy into this presentation for the next 50 minutes or so, and I'm going to give you my very best. I've spent days preparing for this. I've got hundreds of back tests that I'm going to be sharing the results from, so I put a lot of energy into this. But in order for you to get the most out of this, I'm going to need you to put some energy back into this as well. So don't just sit there passively. This is what learning requires. This is what putting energy into the presentation looks like for you. It's sitting up. It's writing notes in your journal. It's writing questions in the chat. It's paying attention, leaning forward. If something doesn't make sense, put a question in the chat, and I'll make sure I cover that for you. So don't just sit there passively. I know, you know, a lot of people treat these webinars like Netflix, you know, sit down and binge watch and walk away and haven't really learned anything. But if you actively learn, I guarantee you'll be a lot better off as a trader. So please grab your journal, write notes, write questions in the chat, and you'll get a lot more out of this presentation. Good? Great. Okay, here's my goals for you today. I have a few big goals. First one, I want to show you whether buying the dip is actually a sensible strategy. I'm going to talk about the gaps in recommendations like buy the dip. People use this as a throwaway line. But what does it really mean? And what are the gaps in that? There's a whole bunch of gaps, and I want to highlight those to bring them to your attention. Third, I'm going to share a better way to trade, and Darryl has touched on some of this already. I'm going to elaborate on that. I'm going to show you how to quickly and easily test your trading ideas, and I'm going to investigate many different buy the dip strategies and show you some results, and then finally share one buy the dip strategy that actually works. So there's the 6 things I'm going to try and do for you in the next 50 minutes. Sounds like a lot. let's keep moving. We'll see how we go, but I'm pretty sure we're going to get through all of that and maybe a little more. Good? Right. Okay, since we're going to be spending a little bit of time together, would it be okay if I spend just a minute or two and share a bit about my background? Would that be okay? All right, great. So as I said, my name's Adrian. I've been trading stocks for over 25 years now. I need to update this slide. As a result of my trading, I managed to pay off all my debts, built a 7-figure trading account, bought a couple of houses, all the good stuff. In 2012, I escaped the corporate world based on my trading profits. In the corporate world that year, I was working in strategy and finance for a big Australian insurance company. I worked anywhere between 5 and 7 days a week, anywhere between 10 and 15 hours a day or more some days. I absolutely flogged myself for the entire year, and for the privilege, I managed to earn about $230,000, which was great, except it was killing me. At the end of the year, I looked at my pay slips and I looked at my trading account, and with my trading account, I had made more money trading just 30 minutes a day using some of the methods that I'm going to talk about today than I had in my day job working up to 7 days a week, 60 plus hours a week in that day job. So it was an easy decision for me. I walked away from the corporate world forever and continued on my trading journey. Now I coach and mentor traders from all over the world to profitability using the systematic trading approach. My own trading, of course, I still trade. I'm fully automatic, fully systematic. I trade Australia, US, Hong Kong, Canada, and crypto. They're all fully automated with a diversified portfolio. This trading method allowed me to spend all of 2019 traveling the world with my family. We basically packed up the house and left. And at the time, we weren't intending to come back. We were intending to travel indefinitely. Unfortunately, the kids decided that they wanted to settle down and finish school in a normal way. They had been to 7 different schools by that time. So when we got to the end of the year, they said, enough's enough. We want to go back to Australia and stay in one place until we finish school. So now I'm in Port Macquarie on the east coast of Australia, just north of Sydney, and we'll be here until our youngest has finished school in a couple of years' time. So that's me. Now you know everything there is to know. So let's talk about buying the dip. What is the problem with advice like buying the dip? Well, there's quite a few problems, in fact. But buying the dip, if you look on social media, you're going to see things like this. I just bought the dip, but it keeps on dipping. This guy is my favorite guy on the internet. You can use him for just about any meme you like, but he's very popular amongst trading memes. When you buy the dip, but it keeps on dipping, how does that feel? Anyone ever experienced that? Yeah, absolutely. Me too. They said buy the dip. I bought the dip, then I bought the next dip, then I bought the next dip, then I bought the next dip. The market just kept on dipping. What am I doing wrong? And then finally this one. This person bought the dip and then the actual dip and the dip of the dip and the dippity dip of the dip. This is the problem, right? What is a dip in the market? When is the dip finished? When is the recovery? And really, how do I convert this saying, which people just bandy around like conventional wisdom, how do I convert that into a strategy that actually works? Okay, here's the real problem. It sounds sensible at first glance, but really it raises more questions than it answers. Let's look at some of the questions that it raises. If I say to you, buy the dip, questions you could be asking yourself would be, well, what time frame are we looking for dips? What is a dip? What constitutes a dip? How do we know when the dip's finished? What's the difference between a dip and a collapse? When should we exit? If the dip keeps dipping, do we cut our losses? At what point do we cut our losses? Is a dip a short-term or a long-term buying opportunity? Are we buying a dip or buying a dip? When should we exit if the market bounces? How long should we wait for a bounce? How much should we buy? Does buying the dip actually work on this instrument? The fact that conventional sort of wisdom saying like buy the dip does not address any of these questions is why it doesn't work for most people. But if we could answer these questions and wrap it all together into a complete strategy, then we can finally start to make some traction. So here's the solution. Instead of just going for conventional wisdom, sayings that people bandy around like buy the dip, we want a complete trading system. A complete trading system gives us the setup, which is the conditions under which we're willing to place a trade. It gives us the entry, which is the precise moment that we want to trade. It gives us the initial stop, which protects our capital in case we're wrong, and the exit, which allows us to get out, hopefully, with a profit. And then wrapped around all of that are the portfolio risk management and position sizing rules. A complete system eliminates the vast majority of issues, both psychological and practical, financial, that most traders face. There's no subjectivity or judgment in a complete system. If you've got rules that define every action that you're going to take in the market, then the subjectivity goes away, the uncertainty goes away, and all of a sudden it becomes testable. So we really want a complete system rather than just some sort of nice fluffy saying. So we're going to convert by the dip into some complete systems and see how it actually works. So here's what we're doing essentially. We're taking price data, historical price data. We're overlaying objective rules on it. If A and B and C are true, you buy. If D or E is true, you sell. Objective rules that are measurable, observable on the chart. If I have the rules and you have the rules, we get exactly the same signal. The challenge most people have with discretionary trading, which is where a lot of us started, is that it's very hard to pass over the knowledge. I can talk to you about my discretionary trading technique, but because there's discretion in it, when you look at it, you might make some slightly different decisions, and without the same level of experience and understanding, we're going to get different results. But with a systematic approach, what happens is I have the rules, you have the rules, we get exactly the same trades. And the great thing about that is we get the same trades, we can also get consistent results. Now, objective trading rules, trading system, trading strategy, trading algo, they're basically different words for exactly the same thing. Objective rules that tell you exactly when to enter and exactly when to exit. So they cover things like the entry and the exit, obviously, how much to buy and sell. When you have rules that do this, the psychology doesn't get in the way, at least nowhere near as much as it does when you're squinting at the chart trying to decide whether to buy or sell. The rules tell you to buy. The rules tell you to sell. And so we don't have that subjectivity and that psychological confusion. So what I want to do now is I want to convert buy the dip into some complete trading systems that we can test together. And I'm going to take you on the journey of how to do this and show you the results each step of the way. So here's what I want to do. First of all, I'm going to define the scope of this entire investigation. So I'm going to talk to you about the instruments I'm going to test, the setup conditions, the entry triggers, the exit, and the initial stop loss. Now for the instruments, there's obviously a huge variety of instruments available that you can trade. What I've done is I've limited it to 9 different instruments so that we can keep it manageable for this presentation. But obviously you can take the principles that I'm going to share here, the approach that I'm going to share, and go and test these ideas on your own instruments as well. And I'm going to stick to ETFs of indices and a few non-stock ETFs as well. Of course, you can apply these principles to individual stocks and other markets, but I've just kept it contained for the purpose of this presentation. Hope that's okay. Then we're going to talk about setup conditions. Now, buy the dip, again, it sounds sensible at face value, but do you buy the dip in a bull market? Do you buy the dip in a sideways market? Or in a bear market, do you buy the dip? Now, which one works? Now, this is the challenge. We don't know until we test. So what I'm going to do is I'm going to test some different strategies on bull, sideways, and bear markets, and we're going to see what floats to the top and actually works. How does that sound? Good? Great. Okay, then we're going to test some entry triggers. One of my questions when I hear something like buy the dip is, okay, you're talking about a little short-term dip or a medium-term kind of decline, or more like a bear market kind of dip that's sort of 20, 30, 40% deep? What is it? So I'm going to test all 3. Short-term, medium-term, and long-term dips. But the entry trigger is not enough, right? We also have to test the exits, because once we get in, the immediate question is, well, when do we sell to take a profit, to get a profit? And so I'm going to test 3 different exit strategies. The first one is a bounce. Now, what I mean by a bounce is when we've bought the dip and it just starts to tick up, just a small little move up, maybe a day or 2 bounce. We're going to get out and take our profits. The second one is a recovery. So there's a dip, and the recovery is back to the price that it was at previously, back to the previous levels. So that's more of a medium-term sort of exit. And then finally, the long-term trend following exit, because the idea of buying a dip in a long-term trend and then riding the entire trend is quite alluring. Is that a profitable strategy? So we're going to test short, medium, long-term entries and bounce recovery and long-term trend following exits. And we're going to combine those into a number of different systems, as you'll see on the next slide. And then finally, we're going to test initial stops, because we know we have to protect our capital, but how do you place a stop loss? Do stop losses actually help or hurt when we're using a strategy like, a concept like buying the dip? So this is the scope of the investigation. There's all of the pre-work that I've done for this presentation. So let's first of all decide on the universe. What will I use for this investigation I'm doing in this presentation today? So these are the ETFs I've chosen. I chose the SPY and the QQQ because they're two of the biggest ETFs in the world. Gold is pretty hot right now, so I thought that would be a good addition. There's a lot of Australian traders here, so I've chosen STW, an Australian ASX 200 ETF. But I don't want to just look at stocks, so I've got a agriculture ETF. I've got the iShares TLT 20-year Treasury bond ETF, a Vanguard Australian bond ETF, silver, and also a commodity tracking ETF, DBC. You could have applied these principles to any tickers you like. These are just the ones I've chosen for this investigation. We're going to do our back test on 1990 to 2020. We're going to use that data series for our in sample to analyze our results, and then we reserve some recent data just to validate that the system still works on, still works on unseen data. So that's the universe that we're trading. All right. So now what we want to do, we've got our universe, we've got our kind of framework, we're going to form some testable ideas. So what I'm going to do, I'm going to talk through each of the components of the system. We've got the setup conditions first. Now really there's three broad types of markets, right? Bull markets, sideways markets, and bear markets. So I want to have setup conditions that isolate each of those three different market conditions. And the way I've defined a bull market is that the price is above a medium and long-term moving average. For a bear market rather, the price is below the medium-term and below the long-term moving average. And I've defined a sideways market for the purpose of this discussion as anything in between. Okay, so that's the setup conditions. Then we've got entries. And there's lots of different ways you could define dip. What I've done here is choose some ways to share with you. Hopefully it gets you thinking about some other ideas you could test for yourself. Let's talk about a short-term dip. Okay, X number of down bars in a row. One of my favorite entries is 3 down bars in a row and then enter. After 3 down bars in a row, there's a high chance of a bounce in many instruments. So I've chosen 3 bars or X bars down as a short-term entry. Close below the previous day's low, close below the short-term RSI being oversold are both common dip buying methods for a short-term dip. Then we can look at the medium-term definitions. And for medium-term dips, what I've said is a medium-term RSI becomes oversold, like a 14-period RSI dropping below 30 or something like that. A pullback from a medium-term high. So we had, say, a 200-day high, and now we're 10% below that. That would be a dip. A cross below a moving average, maybe a cross below a 25 or a 50-day moving average. A new medium-term low, like a new 50-day low or a new 25-day low, or a cross below a low Bollinger Band. So you're getting the idea here, hopefully. We can define a dip in many different ways, but what we've got to do is make it objective so that we can measure it on a chart and then backtest it and see if it actually works. I've also got some long-term dips, more to kind of try and catch a big low in the bear market, like a percentage pullback from an all-time high, an X bar number of bars down from a 200-day high, a pullback to some certain percentage below, like 20% below a 200-day moving average, a new 100-day low, or cross below a 100-day Bollinger Band, something like that. So we've got short-term, medium-term, and long-term dips defined, at least conceptually in words here. We'll convert these to rules and code in a minute. And we've got some exits. Again, we've got bounce, recovery, and long-term trend following exits. So a bounce exit for a dip buying strategy could be if it has a single up day and you get out because it's bounced. That can work really well in many markets. A close above yesterday's high or a close above a short-term moving average. For the recovery, this is things we're trying to get the price, we're measuring when the price gets back to the to levels it was at previously. So we're looking for a bigger move here. So RSI recovers from oversold positions, a close above a medium-term moving average, or a new 20-bar high, or price makes a new all-time high. All of those you could define as recovery sort of exit methods. And then trend following. Trend following could be closed below a 200-day moving average. So what we're after here is, let's say we've got an uptrend, there's a little dip and we buy. And what we want to do is ride the rest of the uptrend and get out when the market falls and crosses below the 200-day moving average, for example. That sort of exit keeps us in the big move so the stock can keep going and going and going. But then when the stock turns around and starts going down, then we get out. So buy the dip and sell at the end of the trend. That's the idea here. Or we could have a new long-term lowest low, like the price makes a new 100-day low, then we get out because obviously it's not a dip, it's a downtrend. And then finally, we've got initial stops. Now I've tested two different methods in this presentation, no initial stop at all, and also an in-market percentage-based stop. And I'll show you how I've tested those. So these are our testable ideas. So we've written down the concepts. We first defined the scope of our investigation. We set our tickers that we're gonna test on. Now we've got the scope of the ideas for entries and exits that we're going to test. Next thing we have to do is convert these into code snippets. So there's things that we can actually put into Metastock so that we can backtest them for ourselves and see if they actually work. Now I'm not going to go through this laboriously for you. You can take a screenshot of this if you like. And if you opt into my, my special free bonus at the end of this, I'll give you all of the codes for these anyway so that you can test these ideas for yourself. But what you can see is I've taken all of the plain English description of the ideas on this slide, and I've converted them into code in the Metastock formula language so you can put it into the backtester and run these rules and see if they actually work. So there's a one-for-one correlation here. Got each of these bullet points has one line of code, and we've got all of the different entries here. Now, because we've got 13 different entries and 9 different exits, that's a lot of combinations, and not all of those combinations make sense. So what I've done is I've grouped them into 25 different strategies by combining the entry triggers with a logical exit trigger based on this entry. And I've got some shorter term ones, some medium term ones, and some longer term systems here. So my job now is to take all of these 25 strategies and backtest them for you and show you what actually works, or show you how to backtest them so you can see if they actually work. So we've got 3 different types of entries combined with 3 different types of exits. And then overlaid on top of that, I've got bull market, sideways market, and bear market. Because what I've discovered in all of my trading is that different things work in different market conditions. So what you do in a bull market may not work in a sideways or a bear market. So I've got those 25 different systems, but then I'm going to try all of them in a bull market. I'm going to try all of them in a sideways market and all of them in a bear market, giving us 75 total combinations. And by testing all of those strategies in all 3 different market conditions, that's going to allow us to see what works in each market environment so that we can then deploy the right strategy at the right time to make more money trading. Sound good? Great. Okay, let's keep rolling. So we've got 75 possible systems here. What I want to do to keep this simple, I'm going to test all of these systems without stop losses first, and then I'm going to apply a 30% stop loss, or I'm going to apply a stop loss to strategies that work and see what width of stop loss makes the most sense. Otherwise, we're just going to end up with too many combinations. Okay, so let's take a breath and have a look at what does this look like in the Metastock backtester, because you've got a great piece of software there. It does all sorts of amazing charting, but it also has the backtester tool. I want to show you how to use that to evaluate trading ideas like buy the dip, like all of the rules I've just showed you, to see if they actually work. So the first thing you're going to do is open up Metastock and go to the system backtester. It has a nice $ icon there. So you open it up and you'll see a whole lot of strategies that have already been pre-coded. The ones in the image here are the ones that I've done for this presentation. So you won't see those in yours, but there's lots of other strategies already pre-coded for you. But let me show you how simple it is to code a strategy in this console, in the system tester, so that you can test it for yourself. You'll see you've got the system editor and there's several different tabs along the top. The general one is just for description, and then we've got buy order. So you can see the rules I've put in here for the first strategy. The close is greater than the 200-day simple moving average, and the close is greater than the 50-day simple moving average. And the number of bars since the close was above yesterday's close is equal to opt1. Opt1 is an optimization variable. So what this means is I'm going to say, let's say we set this opt1 to a value of 3. So that means it's 3 bars since the close was higher than yesterday, or 3 bars down in a row, like I was saying earlier. So this rule says if the close is above the 200-day moving average and the 50-day moving average, and it's been going down for 3 days in a row, then you're going to buy. Then we've got the sell tab. And the sell rule here in this particular example is the close is greater than yesterday's close. So ref close minus 1. So if the close, so we've had X number of bars down, if it then closes up, we're going to enter. Then if it closes up, we're going to get out at the next open. And then we've got the optimization. And you see here, I've got this opt1, like I mentioned before. This is an optimization variable. We can set that up to vary from over a wide range of values. I've just gone from 2 bars down to 5 bars down in steps of 1. So when you press backtest or test the system, it's going to test 2 bars down, then 3 bars down, then 4 bars down, then 5 bars down, and give you all of the results together. So this is how we're going to take our rules, put them into the system tester, and evaluate which ones actually work. So what I've done is I've coded all of those 75 different systems that you see here using, let me just go back here, this code here. So here's the entry rule, here's the exit, and then I've combined them with the different market conditions. So we've got the bull market condition, and this entry rule and this exit rule makes the first system. I spent a bunch of time coding all of those systems, and then I've selected the SPY, so the S&P 500 ETF, and I've backtested them all. It took only a couple of seconds. And what we can see is of our 75 dip buying strategies applied to the SPY, some of them work and many of them don't work, which is great news, because what that tells us something about refining our strategy. We can't just buy any dip. We need to know exactly what type of dip and exactly when to exit in order to be profitable as a trader. So now we can look at which one of these strategies actually work, dig into the rules, and apply the strategies that actually work. But I want to go a bit further than this. I don't want to just test on the SPY. I want to test on all 9 of those ETFs. And what we're doing is I'm looking for robust models that work across a wide range of markets. And not just a wide range of markets, I also want models that work across a wide range of parameter values. So for example, if we have a dip buying strategy that buys when it crosses below a 50-day moving average and sells on a bounce, if that's profitable, that's great. But if when you buy on a cross below a 40-day moving average and that loses money, and you buy on a cross below a 60-day moving average and that loses money, then it doesn't give us that much confidence in the 50-day moving average strategy. So what we want are strategies that work over a wide range of markets and a wide range of parameter values. This is how we get a robust model that's likely to work in the future. It's got to work over a broad range of markets and market conditions. So what I did is I ran those 75 strategies, and I ran them across all 9 ETFs, and I assembled the results into one spreadsheet, and I did a pivot table so that I can show you the net profit returns from each of those strategies. So you can see, I mean, down the left-hand side is the 75 strategies, and it's 75, remember, because we have 25 strategies times 3 because it's bull, sideways, and bear markets. And we've got our 9 different ETFs, 1, 2, 3, 4, 5, 6, 7, 8, 9. And what you can immediately see is there's black, there's 0, and there's red. And there's a whole lot of red. What this means is that there's a whole lot of strategies that out of the 25 that don't work. So buy the dip as a generic piece of advice should not be applied to all markets, because most of these markets are not actually profitable with most of these dip buying strategies. But what you can see is that QQQ, which is the NASDAQ 100 ETF, does respond very well to this type of strategy. And dip buying is another way for just describing long side mean reversion. You buy something after it's been hammered down, expecting a bounce up. That's a mean reversion strategy. And many mean reversion strategies work very well on the QQQ or the NASDAQ 100 index. But we can also see that the performance of those 75 models varies widely on all instruments. So the generic buy the dip advice is bad advice. Different definitions of buy the dip work on bull, sideways, and bear. So we really have to test. And entry and exit conditions both have a massive impact on the profitability of our strategy. So we need to make sure we test every aspect of our systems to make sure they work. And as a systematic trader, this backtesting is your secret weapon. You can have lots of ideas, but I guarantee you the vast majority of them won't be profitable. And that's just the hard reality of trading. You've got to do the work to test ideas to find the small number of ideas that actually do work. And you'll only be able to tell which ones work in advance through backtesting. So we know, looking at this chart, if you're going to trade TLT, for example, that most of these dip buying strategies you don't want to do. But if you're going to choose an instrument for dip buying, QQQ is a much better instrument, maybe followed by SPY, because far more of our strategies are profitable. And then if we choose an instrument which responds well to this type of strategy, and then we choose a particular system that works well for that instrument, then we can have a winning idea. So what I want to do now is dig into one of the strategies that's floated to the surface here, because you can see the QQQ worked really well. So a lot of these are profitable. And then these top 4 strategies, particularly number 13, worked well across many of the instruments that we were talking about. So I'm going to dig into buying the dip strategy 13 in sideways markets and show you how it works. And my whole plan here is not to get you to trade this strategy. My plan here is to get you to test your ideas and show you how to do that. So let's understand the basics of this system. It's a sideways market, which means the stock is either above its 200-day moving average or above its 50-day moving average, but not both. So it's not a strong bull market, and it's not below both the 50-day moving average and the 200-day moving average. It's not a strong bear market. It's something in between. And then this strategy enters when the price drops to a new X-day lowest low. So it closes at a new X-bar lowest low. And then it exits when it makes a new X-bar highest high. So it's like a Donchian channel, but you're using it in the reverse of a trend of the typical trend following way. You're buying a new breakdown and selling a new breakout. And that's basically buying the dip, selling the recovery. So the exit is when the price makes a new X-bar highest high. So on the chart, here's what it looks like. I've got a meta chart on the screen here, and you can see I've got the price bars of the QQQ. I've got the long-term, the 200-day moving average in red at the bottom. I've got the 50-day moving average in green up here. And then I've got the 25-day lowest close, which is this horizontal line here, and then it jumps up. So what this line is doing is it's looking back 25 days and finding the lowest closing price in the last 25 days. And then I've got the 25-day highest close. So this looks back 25 days and finds the highest closing price in the last 25 days. And what our strategy does is buy when the market makes a new 25-day lowest close, which happens right here in the middle where we get entry signal. And then it enters the next bar at the open. And then we hold until the strategy makes a new 25-day highest close. And then we sell the next bar at the open. So we're buying the dip, selling the rally. This is a great sideways trading, range trading strategy because You know, when the market is ranging like this, it's not really trending strongly. You want to buy the dip, sell the rally. You're not expecting a really big profitable trend because the market is not trending in a longer time frame. So this is what this strategy looks like. Making sense? Okay, so what I want to do is now dig into this strategy even further. Initially, when I tested this strategy on different lengths of breakouts. So I tested 15 days, 30 days, and 45 days for the lowest low and the highest high breakout. So now what I want to do is expand this test range and see how robust the strategy is to different periods of time. So I'm going to take the QQQ with this set of rules. I'm going to test from 5 to 100 days in steps of 5 and see if I buy on a 5-day low and sell on a 5-day high. What if I buy on a 10-day low and sell on a 10-day high, 15-day low, 15-day high, and so on all the way up to 100. And that only takes a couple of seconds. All we have to do is change the optimization range in the system tester, and we get the results here. So this is just net profit. You know, we're essentially looking to make money trading, so net profit is a reasonable indicator of how good the strategy is going to be. Obviously, there's other things you want to look at as well. You want to look at the drawdown potential, the win rate, the stability of the equity curve, and so on. But net profit is a good starting point. So you can see here when we go from 5 days to 100 days that all of those different combinations are profitable. Actually, 95, 19, 95, and 100 produce 0 trades, so we can sort of discount them. But every other look back period for the highs and lows in this strategy is profitable, which is a really good sign. It means that the system is not fragile to one particular parameter value. It doesn't matter really what parameter value we chose. Historically, this strategy would have made money. But what we can see is that there's a bit of a local optima here and here. So that's at about 25 days and 50 days. And so I want to dig in a little further and look at those two areas because they're the center of a high mound of good performance or a range of good performing parameter values. And that's where you want to choose. When you do an optimization, you don't want to just choose the best. You want to choose the value of the parameter, which is in the middle of a broad range of good performance. And so 25 days and 50 days, yes, they're local optima, but they're also surrounded by fairly good performing parameter values. So here's what the equity curve for the 25-day look back looks like. Again, this comes straight out of the Metastock system tester. So if we bought on a 25-day low and sold on a 25-day high in a sideways market for the last, since 1990, this is what the equity curve would have looked like, including an allowance for slippage and commission. And then if we looked at the 50-day period for the 50-day lowest low and the selling on a 50-day highest high, this is what the equity curve looked like. Now, if you've got a sharp eye, what you'll notice is they look somewhat similar, but not exactly the same. So these two strategies, while they're exactly the same rules, they've got different parameter values. The different parameter values means they'll get you into and out of trades at different times. So you could actually trade these two together and improve the performance of your system because you're going to take a lot more trades, you're going to get some diversification benefit. But I'd like to take one of these and go a little bit further and test it a little bit more deeply using the Metastock system tester. So when looking at these charts and thinking about the rules, I've got two concerns at this point. Yes, we've got a profitable strategy. Yes, it works over a wide range of parameter values. But here are my two concerns. The first one is we've got a stop loss, and I've tested this with and without a stop loss at this point. My question is, how wide a stop loss should I use, or should I use a stop loss at all? So I want to dig into that. And my second question is, I've got open positions and I'm waiting for a new X bar high, like a new 50 bar high. What happens if a bear market emerges? Should I close those open positions and wait for a new signal, or do I just wait for a new 50 bar high even if we're in a bear market? So I want to test both of these concerns because whenever I've got concerns about a strategy, I think it's really important to address those concerns in data, backtest them, and find out what the real answer is. Does that make sense? Okay, so let's do this one at a time. So stop loss width optimization. The problem with a strategy like this is that over the last 30 odd years, it's only got a handful of trades. I mean, if we go back a few slides here, let's look at this one. The 50 bar highest high and lowest low only generated 17 trades, and the 25 bar one generated 41 trades. That's not enough data points to be really confident in your optimization. So instead, what I'm going to do is I'm going to optimize the stop loss width at the same time as the look back periods. So I'm going to say, okay, what stop loss widths work for a 5 bar look back, a 10 bar look back, a 15 bar look back, all the way up to 100. I'm going to consider all of those data points. So that's going to magnify my number of data points many times over so that I can make a good optimization decision without overfitting. I can use all of that data to draw my conclusions rather than just running optimization on 17 trades, which will give you a really high risk of overfitting. We need hundreds of trades to make a sensible optimization decision. So here's what I did. I ran the backtests again with a stop loss width of 5 through to 50%. And I ran all of those stop loss widths over the different look back periods from 5 up to 80. And you can see this is a pivot table of the results. So the way you get this pivot table is run the backtest in the system tester, copy the results out for each backtest and put them into a spreadsheet on top of each other. And then you can use the pivot table function to produce the chart like this. So what we see here is the number is the net profit, right? And you can see the biggest net profit range in green is over here. But if you look down the stop loss width column, you can see that the profit increases up until a certain point, and then it stays the same. What this means is, for example, with a 5 bar look back, a stop loss width of 25% or more never gets hit during the back test. And this is kind of what we want actually for the stop loss. We want to put it just outside the noise of the system so that if something goes really wrong, then it takes us out of the trade and keeps us safe. So if we had a 40%, 45% or 50% stop loss, it would, in the historical backtest, it never gets hit on any of these different look back periods for this system. And if we go to a longer term system, we can have a 25% stop loss and it never gets hit because you can see that the net profit doesn't change as you widen the stop loss. That means it's not getting hit. So we can set a 25 or 30% stop loss out here and know that unless something really goes wrong with our trade, it's not going to get hit. And that's really what I'm looking for, because the stop loss is a disaster sort of protection mechanism. Because we're buying a dip, it's likely to keep dipping a little bit before it bounces. And we don't want our stop loss to take us out too often. If we have a tight stop loss when we buy the dip, it's going to get hit all day long and drop our profit. And you can tell that because if you put a 5% stop loss in with a 50 bar breakout, the system would have only made $45,000. But if you put a 25% stop loss, the system would have made $130,000. So having a tight stop loss causes the stop loss to get hit too often, banks a bunch of losses, reduces your overall profit. So we don't want to make our stop losses too tight with a dip buying strategy. So with this analysis in mind, what I've done is set a 30% as a reasonable disaster stop loss to keep me safe if something goes wrong for both the 25 and the 50-day look back period. Now, the next question I had a concern about was the exit rules during a bear market. So we're trading in a sideways market, but what if the market turns down and turns into a real bear market where it's trending down strongly? Should we get out of our trades and wait for a new sideways market before getting in again? So what I'm going to do here is test two different strategies. One is close the trade. If a bear market emerges, just close the trade. Get out, go to cash. The second one is if a bear market emerges, make it much easier to get out. So instead of requiring a 50 bar high, maybe require just a 25 bar high. So I've tested that as well. And so again, I tested it over the full range of breakout periods. So from 5 days, 5-day lowest low and highest high system, all the way up down to the 80-day lowest low and highest high system. And here's our original results. No bear market exit. This is the 130-odd thousand I was talking about before. If in a bear market you allow it to exit more quickly, you can see generally it doesn't make a difference down here. It reduces the profitability a little bit here. because we're saying for a 30 bar breakout system, if we exit more quickly in a bear market, it made 79,000, but if you just exit normally, it made 81,000. So it's a little bit better to not do this. And then closing the trade entirely if a bear market emerges, you can see these are all in red because they're much worse than the other two options. So what does this tell us? It tells us don't worry about whether a bear market emerges or not, just follow the system as prepared. So the concern about exiting during a bear market, should we exit during a bear market, is just a psychological concern. It actually destroys value by doing that in real life. And this is one of the great things about backtesting your strategy. You've got a method of determining whether or not your fears are real and whether you should act on them or not. And that helps really improve your consistency. So now we've tested, so we've done our optimization, we've tested some concerns. Now what we want to do is validate our strategy out of sample. So all of this testing up until now was done on 1990 to 2020. Actually, it started in 1999 when the QQQ started, because before that there were no trades. So I've tested it in sample here and out of sample here. This is the in sample equity curve up to 2020, and then this is the out of sample from 2020 to now. Now you can see the out of sample equity curve is still profitable. It is more volatile. There's some bigger drawdowns, particularly more recently, and that's probably to be expected because the market has been fairly volatile in recent years. But it is profitable, and the annualized return is still pretty good. So while there's some degradation, if you dig into the stats, you know, for me, I want to do a little bit more work on this strategy before actually trading it. But the out of sample shows me that it has managed to survive, and you know that gives me some hope. And remembering, we're not just trading one strategy. What we're going to do is have many such strategies in our portfolio. So if one of these goes into drawdown, it doesn't matter so much. So what have we done so far? Here's the process in summary. We've created objective testable rules to define dip on a short, medium, and long-term basis. We combine those rules with logical exits, which cover the different types of exits for a dip buying strategy: a little bounce, a recovery to previous levels, or a trend following exit. We've added a regime filter to separately test bull, sideways, and bear market environments. All of that gave us 75 different system combinations. So we tested those combinations across 9 ETFs. We've found one really promising strategy, and we've optimized the rules for that. We've validated that strategy on out of sample data, and now we have a system, which is, you know, I'm not recommending you go trade it right now, because again, my purpose of my presentation here is to show you the process so you can reproduce it for yourself. But this is a system that certainly warrants a little bit of attention to see, you know, can we make it into something more tradable, or other instruments that it could really work well on. So that's the process. Now, what's next is learning how to do that for yourself. So conclusions. Buying the dip is not sound advice on all markets, but it does work on some markets, particularly QQQ and a few others. Performance varies drastically depending on the definition that you use of dip. You know, we need to be more specific. Thirdly, the exit rules have a significant impact on performance. You know, if you haven't figured out by now, the entry is not the key to profit in trading. You need a complete set of rules: setup, entry, exit, stop loss, position sizing. You need all of that in place in order to make money trading. The exit rules that capture recovery I found to be much more profitable in this investigation than just small bounces. So a recovery back to a previous level seemed to work better, particularly on the QQQ. There are plenty of profitable buy the dip strategies on both daily and weekly charts, but not all of them were profitable. So again, we've got to backtest our strategies. And this is one of the big advantages that systematic traders have over discretionary traders. You can actually put your rules into the system tester, run them over historical data, and check they actually worked. And if you take multiple of these strategies, several of them, and combine them together into a portfolio, give each one a little proportion of your capital, you're going to achieve much better results overall. So for example, I like the 50-day breakout, the 50-day lowest low and highest high strategy that we just talked about, but I wouldn't trade that on its own. I'd probably also trade the 25 bar one, And I'd probably also go back and trade 2 or 3 of the other good strategies that work and combine them into a portfolio. Having a diversified portfolio like that is much more likely to give you good results in the long run. And that's the biggest lesson. Never take anything at face value. Always, always, always backtest for yourself. If you read something in an article, if you see something on a video, if you read it in a book, backtest it for yourself, build confidence. If it works, deploy it in your portfolio and follow it rigorously. That's the key to consistent, profitable trading. So that's what I wanted to share with you. Start trading systematically so that you can test your trading ideas like this. Build confidence and actually pull a trigger knowing that you've validated the strategy actually works. So here's what I want you to do next. First of all, get your Strategic Traders Toolkit from Enlightened Stock Trading. There's 2 trading ebooks, some 4 trading cheat sheets to show you how to improve your results fast, 3 free courses, Millionaire Trader Code, the Trading Confidence Builder, and how to evaluate a signal service, a quiz to investigate how you're trading today and give you specific feedback to improve, and a complete mean reversion trading system that I actually use. Get all of that for free by scanning here, enter your name and email, and then it will be sent to you. Or you can go to bit.ly/EST Metastock. Make sure you get the case right, otherwise it won't work. Enter your name and email and get all of this for free. And also, if you do that, if you decide later on that you want to join the Trader Success System before 30th of April 2025, I'll give you 1,000 Aussie dollars discount off the Trader Success System just because you've been here on this event. So that's what I want you to do next. Scan the QR code or go to that link, enter your name and email, get the Strategic Traders Toolkit, qualify for the $1,000 discount on the Trader Success System, and become a systematic trader and start using tools like Metastock System Tester to really evaluate whether or not the strategies you're using work. That's everything I've got for you. Love to take some questions if we've got any time. Any questions in the chat I can help with? Maybe one of the moderators can support me with that.
I can help you out with that. So Catherine has asked, will this reversion system work on the short side, or are bear markets too short and sharp for this type of system to work?
Yeah, really great question. And my answer to questions like this is you should test it and see. It's actually very easy to flip a system like this and apply it to the short side. I haven't done it for the purpose of this presentation. I typically don't trade long and short systems symmetrically because bear markets are different than bull markets. So what I would do is I would take this logic, flip it, put it into the system tester on the short side, and then rerun the optimizations. In fact, I would do probably this entire investigation and flip all of the rules and see which out of those 75 combinations has some potential on the short side. But the answer is learn how to test it for yourself so that you can answer questions like that, and it puts you in a really powerful position as a trader.
Okay, great. And then we have another question here from John. He says, how long do the drawdowns last on each system?
Yeah, you can see that varies quite a lot. So this is, again, one of the reasons for backtesting is to get a feel for what you can expect. So when you run the backtest, you get the equity curve and you get the data day by day in that system. And you can copy that data into a spreadsheet and very easily see from equity high through the drawdown to the next equity high and figure out how long those drawdowns last. If you look at the 5-day breakout versus the 50-day sort of breakout system, that varies a lot. And so part of it is doing the test to see what could happen so that when it does happen, you can be comfortable to follow the strategy. Some strategies can have really long drawdowns, some are much shorter. But the key is to know what to expect so that you can be comfortable. Like if a 50-day drawdown is normal and you're 20 days in, there's no sense freaking out because you know that 50 days is normal. And then also remember that I would recommend that you trade multiple strategies, not just one strategy. I trade dozens of strategies in my portfolio. And the reason I do that is because when you trade multiple strategies, the profits and drawdowns even each other out, so that when one's zigging, the other one's zagging. And that smooths the portfolio overall. So the drawdown of an individual strategy doesn't matter all that much once you get it into a portfolio of strategies. Does that make sense, Bobby?
Yeah, great job there.
Great.
And it looks like that covers most of the questions I see that came in.
Brilliant. Well, if anyone has any questions afterwards, again, opt into that QR code there. You'll get an email from me. You can reply to that. I see all of my emails. It's me that replies. So feel free to reply to an email, ask me your questions, and I'll help you out. But again, Bobby, thanks so much for the opportunity to share. I've used the Metastock System Tester here because I think these are tools that more traders need to use, frankly. And test analytically, does what you're doing actually work? And really just validate that, because I'd much rather trade a strategy that's worked in the past than a strategy that hasn't worked in the past. And I hope most people feel the same way.
Yeah, I really like what you did, combining kind of multiple different tests, into the pivot tables and everything. It looked great. Fantastic presentation. So yeah, thanks. I'll be in touch in the real near future, Adrian.
Great. Thanks so much for having me. Everyone, enjoy the rest of the presentation. Bye for now.
Bye. All right, I'm going to go ahead and make myself the presenter again here. So that was Adrian. He did a fantastic job. For those of you that are watching that might be interested, in a trial of Metastock, you want to do some of your own system testing like you saw him do, you can sign up for a trial or look at some of the different offers from today by visiting metastock.com/summit-savings. We also have Dave. He's available on the phone and in our chat room right now, metastock.com/sales chat, and he'd be happy to answer any questions you have or help you kind of get up and running with the platform. Or you can take advantage of like our full kind of special bundle offer we put together today, where you can save over $1,000 on some of the strategies, and you can get a trial of Metastock with this too if you need it by visiting metastock.com/summit-savings. If you visit that link, you might see it might show that the price is slightly higher on that page, but as soon as you click order now in the cart, it'll reduce down to that price. You might be seeing that, but it should be fixed here very soon. I want to give a shout out again to Stocks and Commodities Magazine for helping to sponsor the event, as well as the ATAA. They're both fantastic companies. We really enjoy working with them. And then with that, I'll say hello to our next speaker. We have Brad Gilbert. Hey, Brad, how are you doing? Oh, I can see you, but it looks like.
Oh, there we go. How's that?
There, yeah. You sound good. You're looking good. Great to have you on, as always.
Bit of a haircut, make it slick, you know what I'm saying?
Yeah.
No, it's good to be here. And thanks to everyone for taking the time out to be here as well. I know it's sort of middle of the day almost here, so just hang in there. We'll see what we can see what I can do for you.
Hey, fantastic. Well, I'm going to be here in the background, same as my team. So if you need anything, just holler. But I'll go ahead and change you over to be the presenter. You should get a pop-up here in just a moment, and then I'll kind of let you take things away.
All right, let's do it. What do I do?
Okay, I can see the Zenith workspace.
Oh, you can. All right. Okay, well, let me get onto that page. All right.
If you want to show a different screen under the show screen, there's a down arrow you can select.
Gotcha. Yeah. It's been a while since I used GoToWebinar. I'm just trying to shrink this one here. View everyone. Oh, sorry, I'm just checking these headings at the top. I don't know if you can still see me, but I've just hidden that screen. Okay, right.
So yeah, I still see the Zenith kind of workspace.
You don't see the, I've got your webcam very large right in front of me.
Here, let me, I'll turn off my webcam.
Okay.
So yeah, if you're screen sharing, it'll often show up under audience view on the right, but you might want to go to where it says show screen. There's a little arrow underneath that you can click if you're trying to share a different screen or application.
Okay, sorry, where is that, Bobby? Just on the...
So yep, on the GoToWebinar bar, one should say
Yep.
sharing, and if you open that
Yep.
up under the show screen, click the arrow, and then it'll let you hover over different screens to show the
Okay.
one you want.
All right, just want to get rid of this.
So I see workspace again.
Okay, all right, let's get cracking here because the yeah, I've got the screen up for some reason. My video thing keeps coming up. All screen playing. Is that, you still see that, Bobby?
Yes.
Okay, all right. I don't know how to get this other thing off, but let me just see if I can take that off. Ah, there we go. You may have lost my image there for some reason, but all right, now guys, the just to get this thing, get the ball rolling, right? I want to give you a really practical session here on understanding, like, there's two parts to trading, right? Let me just sort of wind it back just a touch, and let me come back over here. The now, when you're trading technically, well, there's two aspects. Trading the technical aspect of the market, which basically just shows you, it's like the form guide for what's been happening and where things are most likely to go, right? So let me just get the pen up here. Okay, so just looking at the, like, and there's a number of different perspectives. So what I'm going to show you is, you know, I worked sort of for investment banks for almost 20 years, right? And this is the way, not only the guys at Citibank, I worked for Citibank, Commonwealth Bank, Toronto Dominion Bank as well. Everyone was trained the same way, pretty much by like this one organization. Okay, back in the well, 1990, put it that far back. But what you get is you get a general overlay. Now, the one thing why technical analysis works well, and this is going to lead into, you know, really focusing on the Aussie dollar, right? Because, you know, it's directly connected to the hip of China, regardless of what you think it is, and it's going to make a bit more sense. So just looking at the markets here, right, you can very easily see, like, I'll show you how to draw these trend lines. I know some traders may be new to drawing trend lines like this, but you know, you got a very clear picture here of what the dollar is doing, and then you've got the dollar block, euro, sterling. Well, Aussie, and this is obviously the focus for the presentation, the Aussie dollar, and then you've got the Kiwi there trying to pick itself up off the floor as well, right? So technical analysis, as I said, I'll show you how I was trained how to do this, how we do it, how everyone else I know that still works in the bank still does it. So then you'll get a very good idea of what is going on. Now, so the Aussie dollar, right? We're sort of looking at the markets, you know, more often than not. Let me just change the pen color there. Looking for opportunities where momentum and direction sort of coalesce, right? Or where we have a very clear snapshot. Now, I'm using the new workspace settings here, platform, right? Which is going to be in play, I think, within a month or a couple of months. Now, I look at the markets on a hourly and a daily perspective, right? So just looking at what we've got here, on the hourly charts, there's a lot of noise here, right? And you can get sort of misled into what is actually going on. So just on a general perspective, we are looking for direction, right, on a short-term basis, okay, looking at the hourly charts, and then also looking at the daily charts and making sure these two aspects are working together. That is a cleaner trade. Now, it's not always the case that you can get, you know, you may have good opportunities just on the hourly charts and none on the daily charts. The opportunities on the daily charts come up sort of once every sort of 2, 3, or probably 3 or 4 weeks, right, for an optimum trade. Now, let me just connect this to what we're going to be talking about, and it's about looking at these markets, right? Now, you've seen that the impact that Trump's had. Now, it's very diverse, the impact, because we have got a situation where, you know, the tariffs against the Eurozone, the UK, Australia, New Zealand are all different, right? We've got a basic 10%, right? But then you've got to look at each of these countries' major trading partners, and here it would be China, right? So China is a driving force. Australia and New Zealand, the biggest export markets for those two countries. Australia is just a net exporter of minerals, so it is directly connected to, obviously, commodities. It's why they call these instruments, or these specific currencies, the CAD, the Kiwi, and the Aussie, the commodity currencies. So if we do see an impact on, on China or on commodities, these two things are going to really stumble. Now, that's just like a little bit of a precursor, because what I want to sort of show you is just having a look here at the euro and sterling, right? Now, these four pairs at the bottom are all traded the same way as against the dollar, right? Sorry, I'm just trying to get this pen to be a little bit thicker. Okay, so you're looking at euro and sterling, right? And then you've got the Aussie and Kiwi. Now, I've had a lot of traders sort of asking me, what do you think? It's like, well, you know what? If China's got 145% tariffs on there, that's a direct tariff on Australia and New Zealand, and somewhat Canada as well. So you're looking at these two different aspects. Now, looking at sterling, okay, it's up at 133.77. It got down to like 121. It's up like 13, 14 cents. And same for the euro, right? It's up at 115. I think the low is around 102 or thereabouts. So you're looking at 12 or 13 cents there as well. You look at the Aussie and Kiwi, and this is just the general impact of what we've seen so far. Okay, so the Kiwi 55 up to 59. So it's gone 4. The Aussie has gone from 59 sort of 30 up to 64, right? So almost 5 cents. So this thing is almost 10 cents behind the others, and this is a part of the whole tariff situation that you can't really see is the impact on Australia and New Zealand at the moment, right? But it will become apparent as we start to get the data. Now, what we have seen in the markets just at the moment is the immediate impact, the hypothetical impact of what is going to happen. Okay, so that's where we are. So you're looking at these two pairs, and in particular, I'm more looking at the Aussie because it's got more minerals and these things going to China, more so than New Zealand and Canada. Okay, now I was just sort of, as I was coming into this, I was just having a look around how I was going to sort of connect you guys to this. Now, when it comes up to technical analysis, by all means, fire away your questions, and I'll try and answer them as I go. But now, looking at the Aussie dollar, now I've got an economics degree, and I would say to trade, you don't need an economics degree. It is handy if you understand how the economic equation sort of works, how the economies connect together, how the fundamental data, right? So we're looking here at the technical side of things, and obviously the key fundamentals, if I can just get that up, these numbers here, okay, tell us exactly what's going on behind closed doors, so to speak, right? This is where trading in the Forex market can be a little bit, to me, a little bit transparent than sort of just trading company shares, because you know what, we get to look at what's happening inside the company the whole time, right? That's the whole aspect. And we also know what the central bank is doing. Okay, they tell us what their plan is, what they expect for the data, and if there's any variations on these numbers, either up or down, what impact that will have on the general economy, inflation, leading into employment, retail sales, and it sort of filters down through the fundamental tree. Okay, so the normal market conditions, right? When we are looking at the general markets themselves, we are looking at, you know, if we were just trading the Aussie, you're looking at the Aussie against a string of different instruments, right? Different currencies in particular. Let me just come over here, and you know, we can see what the Aussie dollar is doing. So this chart here, right? This dashboard it tells me a lot about everything that's going on in the market. Now, what I'm sort of talking about there is what are the US treasuries doing as far as the yield? Is it going up? If the US treasury yields are going up, the US dollar generally goes up and equities go down, right? So there's a direct relationship between these instruments. What you've got to understand when there are geopolitical events, and Trump is a geopolitical event, a continuous one, the impact can be quite deceiving and discombobulating, right? And we've seen this over the last couple of weeks, but you know what? Last week was pretty good trading conditions. And what I mean by that is the markets were behaving quite nicely. Okay, the equity markets, which, you know, right here in Asia, North American equities, which basically drive global equity markets. That's why I've just got the US stuff here, because this is one big giant market. Now, you've got the equities going up. Generally speaking, you would think that you would have Euro, Sterling, Aussie, Kiwi going up. That's like a risk-on profile. The fact is the 20 and 30-year treasuries are going up quite a lot. The other ones are going down. So we're seeing a bit of a dollar buying situation, okay? Now, that's normal markets. What we've got now is a more dynamic situation with the Aussie dollar, because we do have these tariffs on China, right? So I'm just getting used to GoToWebinar again. It's been a long time since I used it. Okay, so now let me just come back to the charts, because this is what I want to get back into is actually showing you very clearly how to technically look for the trading opportunities, and then how to predict the outcome through the fundamentals and the various updates, right? So that we get from Trump and so forth. All right, now let me just move this control panel over so I can get a bit closer to it. Righto, so now, just if you're looking at these charts, right, this is the hourly chart on the Aussie, okay, and I've got no trend lines drawn on here, and I'll draw some of these in just a second, just to show you what's going on. Now, as far as what I use and have used for a long time to just quantify, and don't get me wrong, there's a yellow line here, right? It's just a moving average. Now, I use this moving average to quantify if an instrument is moving up or down, right? If it's above the bull bear pivot line, and I'm on the wrong screen, let's get you on this one. Now, if might make a bit more sense now. Okay, so if the instrument is above the bull bear pivot line, I would generally, if someone asked me and said, what do you think on the hourly charts? Is it going up or down? I'd say it's going up. That's a line, the pivot line itself tells me if it's going up or down, right? That's what we're generally looking for. Now, we've got a situation here where the Aussie dollar is going up, right? We've got dollar weakness across the board. Now, this is another situation which has arisen since before Bobby sort of scheduled the whole presentation and the Traders Summit. Was, you know what, we're talking very much about the tariffs, and that's what this is. Now we've got a huge amount of pressure on the chairman of the Fed, Jerome Powell, and that's creating another issue, right? Which is, this is where you can actually understand, you look at your charts and you go, right, let's just work out what's going on here. Now, the Aussie dollar has been going up with Euro and Sterling. They're all traded the same way against the dollar, and it is a bit of, it's like the Jerome Powell issue in the Fed is a distraction for the market from the tariffs. Now, all last week, I spoke to 3 or 4 mates that were still working at the banks, and they're all sitting there wondering, when is China going to release their sort of countermeasures, right? And so that's what the market's very nervous about. So what we want to try and do is isolate the best instrument that is China, right? So if you're looking at out of all the major currency pairs, the Aussie dollar is a pseudo Chinese trade, right? Whatever happens to China happens directly to the Aussie dollar. So we can sort of piece this together. Now, the situation is we've got Jerome Powell in here as well. You might be sort of thinking, well, Aussie dollar's going up. Yeah, short term, going down long term. It's massively overbought. I still like the Aussie dollar down based off the Chinese tariffs and what I was sort of calling the bloodbath, right? The situation is, and let me just come back to this. Basically, when we are looking at general economics, right? And where our export market is for Australia, it is directly into China. So now you don't have to be a rocket scientist to work out if there's a problem in China, and we've seen this over the last sort of 10 years. You go back to the global financial crisis, right? And, you know, a massive discombobulation of global growth. China slows down, Australia and New Zealand sort of come to a shuddering halt, as a lot of the rest of the world did as well. But it is a situation where you just need to be able to understand that Aussie is a pseudo-Chinese trade. Instead of trading China, you trade Aussie and you get some joy out of it. Now, it is a little bit with the Trump situation. We do have a few different things happening. Now, I'm trying to make sure this isn't as complicated as it sounds to me. Okay, so just looking at these two charts, right? So I'm looking for opportunities here on the Aussie on a China trade. Now, you look at your major charts, and whether it's the hourlies or the dailies, you see sort of a different picture here. And I know the Aussie is lagging, right? So what you want to be doing is broaden your horizons around looking at the Aussie itself, right, against various instruments. Now, if I come over here to the Aussie against all the crosses, right, you've got the Aussie Kiwi, Aussie Swiss, Aussie Yen. You're looking for opportunities where you've got the advantage in the market, knowing exactly technically how the setup is, whether it's going up or down, and then also trying to factor in, or ideally get in two ways you can get in for direction, right, or immediate momentum. The fundamental data releases, right? And I'm not saying necessarily jump in straight to the actual release itself, because that can be problematic, right? No liquidity at the time of entry. You get the right direction, but you get kicked in, you get kicked out, right? So you don't necessarily have to chase the numbers, but you need to look at them to see if the instrument is going to continue to go higher, up or down, right? The other thing is general momentum, right? So that is another key factor that you want to be sort of looking at. Now, sorry, working away here on this thing. Now, let me just come back to technical analysis. Now, a lot of people, I'm sort of surprised they haven't had a lot of technical analysis sort of training, so to speak. You know, they throw in a huge amount of moving indicators and these sorts of things to try and work out where those sort of key entry lines are, or key levels where momentum will shift. Now, the easiest thing to do for technical analysis, and I have been setting up this workspace, so I've got two issues here, the workspace and a little bit of GoToWebinar. So now if I just slide this across, what I'm looking for with technical analysis, it's just a matter of trying to, like, you're not thinking at this point. You've got to try and be completely objective, which is tough because technical analysis is completely subjective, right? And that's what we're sort of dealing with. Now, if I come over here and let me just change that to red. So what I'm looking for is just to get the major resistance levels, support and resistance. Now, if I've got this one here, let me just, and this is where your understanding of Metastock, and if you have got Metastock, it will make a lot more sense to you that you can, like, as Adrian was saying, the power of this thing is quite amazing. If you didn't have it, I don't know what you would do. I've been using this for, well, not the workspace, but Metastock for, Christ, the last 25 years. And so basically, so all I'm looking for is to get on the highest point here. And okay, so generally speaking, you're gonna have, with technical analysis, right, for a trend line to be like a good trend line, like I was gonna say certified as a trend line, but it's, you know, just to be recognized as a trend line, you've got the starting point, which would be the first one, second touch, the third touch. Now, I know these two trend lines here aren't touching at the moment because we've just got this new high here, right? So that would be number 4. So to quantify a trend line, you would have 3 touches. Now, in this situation, we've got 2 resistance trend lines, right? The very top one and the next one. Anyway, this is just more about technical analysis. I'm going to bring this back to China in a minute. And you would be doing the same on the downside, right? Just trying to work out where these major levels are. And if I just go on to Ray, and sometimes if it's not rolled out enough, you can get a little bit harder to get on there. All right, so the and you want to make sure these trend lines are at the right spot. Let me just get that up. Okay, so if I swing the data back in here now, what I would be sort of doing, and just to add a little bit of flavor, we've got that new sort of great. It's always the time you don't want it to sort of mess around that it does, right? So if I just hit the zoom, I can come in and and isolate that low point, and the same over here. Okay, now that trend line there is just to the recent low, right? So I'll just make that orange. Now, what that tells me is overall, you can see just by looking at the shape of this, right, that the Aussie dollar is going down. It's in a downtrend. Okay, this is a daily chart, long-term trend, overall down. You've got this new recent low. It's coming back. We haven't heard from China. I think this is an easy trade to the downside, and it's more a matter of just trying to wait for the optimum time to get in. And that's where I'll explain to you where you can use stochastics, obviously also other trend lines. The problem is at this stage, we don't have any trend lines on the downside. Now, one thing, and this is sort of, I don't want it to bounce around too much, but one thing that you can come unstuck trading the currencies, right, is if you have if you try and pick the top, now we've got this bull bear pivot line coming in at 64, 67, right? So it's not that far away, what, 50 points away. So does that mean I go and buy? Not necessarily, right? It just means, like once again, if I was trying to quantify that this was going up or down, I would say it's now gone it's going up, right, is what we're looking for. But this is the thing with the markets, right? They're extremely dynamic and they react to different news different ways. Now, we've got two events here. We've got the Donald, right, Trump, as I call him, the Donald. He's coming out with, like, let's sack the head of the central bank, right? It's giving us a lot of dollar weakness. I mean, and that's giving the Aussie a little bit of breathing space. But look how far this thing is not going, I should say, because it is struggling. Now, do you look to get short here on the run up towards these resistance levels? Well, this is the thing. And with Jerome Powell now in play, apparently potentially getting sacked, you don't want to be trying to pick the top. You want to go trade with momentum, right? This is what a lot of the fund managers do that a lot of people miss. And the hardest thing about trading with direction and momentum is trying to be patient and be objective, because once these things start trending a lot and they start moving a long way, and if I come back to the majors, you'll sort of start to see what I'm talking about here. If I just come back to, say, dollar Swiss, like if you're a technical trader, you know what, it's already broken down. Whether you got into the trade on the break or you've already taken profit, you know, a couple of 100 points lower, primarily because we've had sort of inconsistent markets. Well, at that point, yeah, it's very hard to get back into the trade on the downside because there's no sort of technical entry levels, right? That's why we come back and start to look at things like momentum as a specific gauge of when to get in and when to get out as well, right? Managing positions with stochastics is a great way to manage your overall risk and potentially lock in profits. Like for me at this point, I would be, if I was short dollar Swiss, I would probably be considering squaring up and waiting for another look, right? Because it's massively oversold, especially on your daily charts. Now, would I go long there? No, I'm not going long. I'm just squaring up the shorts. Now, this thing is going down, okay? So I'm looking to basically get short, and if I come back, this is where you sort of tie it back to the shorter term perspective. Where are we? Okay, and here we are. You got dollar Swiss, right? It's still going down. You got the bull bear pivot line here. It's, you know, it's still a little bit above. You've got resistance above that. It is overbought. So on a short-term perspective, dollar Swiss could be something that you'd be looking to get short on. The thing is with the daily charts, right? And if I just come back to that quickly, it may take literally a week for this thing to come out of an oversold situation. So don't sort of jump in thinking this is going to work itself out over the course of a day. It takes longer time for the longer term trends to come into play. All right, now we sort of got through the icky parts. Now what I want to do is just show you some different skills around technical analysis around the Aussie. Now, for me, you know what, the whole presentation about, you know, the bloodbath coming for Australia, China is under a huge amount of pressure, right? And if I just give you a look at the news here, like this is China's kicking back, as you would expect, right? So you've got a situation there where China are now sort of saying, you want to be careful about striking up deals with the US and leaving us out, right? If you do that, we're going to like basically bury you, is the interpretation I get. So that's something that everyone needs to be very conscious of, especially like countries like Australia, New Zealand, and Canada for that matter, because you know what, you start messing around with China, they are going to have a good old crack at yourselves. All right, let me just come back to this screen here. Now, so trying to work out, because as I said, the presentation sort of slightly shifted because we have two major events happening at the moment, right? Jerome Powell, weak dollar. If they sack him, dollar goes down. We've got a situation where the whole Chinese tariffs sell Aussie almost buy dollars, right? So it's a bit of a mix-up. So, but let me just sort of bring it back into reality and just tell you this, that the Aussie and Kiwi, as I was showing you there at the start, are lagging about 10 cents behind the euro and sterling, primarily because of the tariffs, right? So we can sort of start to sort of piece this together. So the best thing about when it's a bloodbath and there's a huge amount of pressure on one specific instrument, it makes it easy to work out what side you should be hitting, right? I'm not looking to buy Aussie to get on a bounce. I'm looking to sell this sucker any chance I get, and against other instruments, not just the US dollar, right? So if I come back to now looking at the crosses, right, this is where you can get a little bit, not misled, but you can obviously, you draw technical trend lines around your crosses, and I've got the crosses here on a hourly perspective and a daily, just like the majors, right? So you can sort of see what's going on. A lot of these things are just hugging the bull bear pivot line at the moment. Last week was a funny one, right? Because China did go quiet, and you know, it's like the giant monster hiding in the bushes, ready to come out, and everyone's on edge waiting for it. So that's what's happening on a lot of these instruments, especially related to the Aussie, because that is the China trade, right? Now, if I come in and just have a look at the daily charts, right, you start to get a bit more perspective here around what is actually really happening across the pairs here. Aussie Kiwi is down, right? And that's, you know, a little bit of Kiwi strength. They've had some good echo numbers last week. You got Aussie Swiss, right, to the downside. Everyone's buying Swiss. They're buying yen. That's the safe haven trade, right? So you're sort of looking at those two options there massively, right? Now, we saw last week, don't fall in love with these trades still at the moment. You might hold these for a couple of days, 2 or 3 days, but you want to have close or reasonably close trailing stops, like 50 points away, to take you out in case the safe haven trade does flip, which we did see last week. Now, Euro Aussie, no surprise, Euro through the roof. Sterling is holding up against the dollar as well, and against the Aussie doing extremely well. Aussie CAD and Aussie Kiwi are the tricky ones, right? Because they're the other commodity currencies. So how can we make these instruments, trading the Aussie, trying to identify the best times to be getting short on these instruments? Well, there is a better way to sort of look at this, right? Now, let me just get the pen off. Now, if I just come into the Aussie and say, let's have a look at Aussie Swiss, right? You get the way you can set this new platform up, the workspace platform, right, which is going to replace the Icon, is it's much lighter on your computer systems. You don't need anywhere near as much RAM. You can set up all the templates in a not too dissimilar fashion. So it is an easy one to use. Now, I've got the Aussie here, right? And I'm sort of looking at the Aussie Swiss. Now, I've got Aussie Swiss on this right-hand side. Now, if I just take that back to the, well, let's just stay with the daily just for the moment. Now, what you can do is just come back up here and break the two currencies down against the dollar to sort of try and work out what is actually happening with these instruments, right? So if what I could do is just take, let's go with, well, actually, I'll go with the Aussie as the main pair. Okay, now dollar Swiss, as it's said, is US against the Swiss, right? Which is the opposite way to how the Aussie is quoted. So what we can do, there's two things you can do. You can either go dollar Swiss and just invert it, or that's sort of reverse the way it's quoted, or you can just come in, type Swiss, which is dollar Swiss, and just invert that one, right? So what I would do, invert the scale. And this is so what we've got is, we've got a situation now where I can see Aussie Swiss, Aussie against the Swiss, what's going on, okay? What we're trying to do here, and so I've got the Aussie dollar as it normally is, okay, against the US dollar. Now you can start to see a lot clearer because the safe haven trade is connected to what Trump is doing, you can see where Swiss is really outperforming the Aussie, right? It's a lot clearer than looking at the various instruments. Now this is on the hourly. Let me just change it to the daily chart. Actually, it might be easier for me to change. I've got a whole bunch of templates saved here. Once again, makes it very easy to switch between the various templates. Sorry, I don't want the hourly, so let me just get onto that. Okay, so here you've got two different things. Now, I've been using this for quite some time. Trading the crosses, you know, you can sort of see it moving in the market. You know, there's a safe haven trade in play. You're looking for, let me just come back to this screen. Okay, what I was just saying there is, you know, if you're looking at the Aussie dollar, I mean, today it's predominantly going up, but then you can see like the Swiss is going down. Okay, so Aussie Swiss is going to be going up today, and you can sort of generally see it. But visually, coming back to a chart and actually sort of seeing it in action is a much better way to really gauge, you know, when this thing is going to take off, right? So looking at what's happening at the moment, you can see it has come back to some sort of normality, right? When you see the Swiss take off to the top side, that's generally when the safe haven trade is coming into play. And you can see at this point here, let me just clear the screen there a touch. Right, Aussie hasn't gone far at all, and dollar Swiss has gone massively. So you can see here exactly where the Aussie is being outperformed by the Swiss. Okay, so you look at the trades there. Let me just get this other chart across a bit. Wrong way. Okay, so just looking at that, you see this big move down. When you look at the Aussie versus the Swiss, you can see this thing it's like someone's got its foot on its throat, and the Swissy against the dollar is racing to the top side. So when you're looking at the crosses, it pays dividends just to have a look, not just at the cross as it is like looking generically at Aussie Swiss, but also break the two components down against the dollar, especially if the news is out of the US, right? Because anything Trump says, that's when the safe haven trade comes into play, right? So focusing on the Swiss and the yen is a great thing to be doing. Now, excuse me. Yeah, what platform is this? This is the, I don't know, Bobby, have you told these guys about the new LSEG or workspace situation? I don't know, but let's.
We haven't.
Oh, right, okay. Sorry, guys. Well, let's just keep focusing on this, right? So the, I should have used my old things. I should have asked you that, Bobby. No problemo.
But it's okay, because these are basically the same charts as what's in Zenith right now.
Mate, and the whole system is the same thing. It's just a different shell. It's so that's good. Now, looking at the safe haven trade here. So against the dollar, you see it moving against the dollar. Aussie dollar, you know, there is a specific weakness, inherent weakness in the Aussie from the Chinese tariffs, right? So that's what we're sort of looking at now. If I just come back to the hourly charts. You know what, I'll just come back, do it this way. Now, once again, all you need to be doing is coming through, and the reason why I'm sort of going through this, and I'm gonna draw, like you draw some trend lines on this as well as just what I'm showing you, it's gonna really light up like a Christmas tree, right? So once again, the dollar yen is quoted the opposite way against the dollar. So we'll just invert that scale. And then you can start to see what the Aussie's doing against the yen. And when you're going to see a big move on this, okay, where's my pen, right? You start to see this sort of trading, this sort of movement on the yen against the dollar. You know the Aussie is going to be under the pump big time, right? Because the yen is massively outperforming. You can see it as clear as day, okay? Now, just as well as that, right? So there's a number of different things. So there's trying to tie this into a short presentation is a little bit problematic because there's a lot of different things to actually explain to you and show you, right? So one key thing around looking at the crosses, you do your technical analysis the same way you do for the major pairs, right? Actually, for all instruments, equities, commodities, anything that you're doing, it's the same thing, right? Now, and I will explain to you this at the end because you're going to have a risk-free trial to get the whole masterclass course, which will explain this. So for those traders who are scratching their head wondering what's going on, there's a lot of, you're going from here to there. Well, there's a lot to do here. Let me just, I'm a bit temperamental with my colors, right? So like trading dollar yen, I mean Aussie yen. Now this, if I'm looking at Aussie yen, I've got three different layers of resistance up the top here. You've got the bull bear pivot line, you've got the Ichimoku Kinko Hyo cloud, you've got the just, I would say like the Westerners resistance, okay, which is just trend lines. So you've got a lot of different trading opportunities here on Aussie yen. Now you would be looking to get short here. Now, all I need to do is wait for the short-term trend to line up with a long-term trend, or what we built around this was a specific tool, right? Once we identify, let me just shrink this for a second. Once we identify that, let me just take this off. If you get the long-term trend going with a short-term trend, then that's a good situation to be getting short these things. You're trying to work out when to get in. Like Aussie yen is a no-brainer, right? Absolute no-brainer. We had one of these last week on sterling CAD. Now it's below. It's hard work, right? Now they're buying yen across the board. They're buying euro and sterling, but Aussie's not going with it. So to me, it's a good trading opportunity. Would I trade the short-term or the long-term chart? Well, what I would be doing is I would be setting up an order here, and I designed, I've designed a bunch of different trade execution tools over the last 10 years. Some of them are based around trying to trade around the economic numbers, some just trading live, trendline trader in this situation, looking to take advantage of a trending market. And there's also the Ichimoku trader, which is also trading the cloud. There's an extra one that I've done over the last sort of 10 months called Primetime Pro. And this is where you can really, like it just changed the way I manage my time at the screens, right? And I know you sometimes when things are kicking off, you've got to be in front of the screens. Other times you don't. Now, what I've done here with Primetime Pro, and this is working for, you know, especially the Aussie with that bearish tone based off what China's happening to China. And I don't think we've started to see the worst of it yet. We are going to see a lot of carnage as China gets impacted. The numbers in Australia are going to fall off the face of the earth, and that's where the easiest trading opportunities are. When you've got pain in a specific sector of the market or currency or country, then you have an easy trading opportunity because you know the direction that instrument's going. It's a matter of just nailing the timing. So in the timing here, I would not be trying to pick the top. Now you can, and if you want to spend a bit of time there and wait for it, you can do that. Now, the strategy you choose is important. Now, a range trade or a trend trade would be selling below those multiple resistance levels. Now, you could look for a range trade, you could look for a false break trade through the top here as well, and then get back in when it breaks back down. Now, the other part, what we do with Primetime Pro is we trigger this to set up, so when it's overbought and it's starting to break back down through the 80 level on stochastics, as long as the direction is the same, short term, long term, and we've got resistance in play, you've got everything in your favor. And in actual fact, I generally like, if it's possible, just to get a bit of a false break, because that would accelerate the move to the downside once the trend sort of kicks back in. Okay, so I'll show you a bit on that in a minute. Oh my God, this sort of time management here is pretty poor. I mean, I've just got trying to work out the best way to sort of show you around this, right? So one thing that you can do, there's a number of different things, right? As a professional, I would be anticipating where Aussie and the yen are going to tell me overall, because as I said, if you look at this chart here, right, which is the majors, okay, and you see, okay, dollar yen going to the downside, you see Aussie going sort of to the top side, albeit struggling. You don't see that clear picture, right? And you probably don't line up. If you're just trading the major currency pairs, you're gonna like miss a lot of good trading opportunities, because when you do come back to looking at Aussie against the crosses, right, even if you're looking at the hourly charts, you might be looking at Aussie yen and going, well, yeah, this thing's sort of just dragging out sideways. But looking at it on a different longer term perspective, you start to get some shape around it, and then it's just a matter of trying to execute the trade with the right timing, right? And that's all you need to be doing, is focusing on this. Now, with China, right, as soon as these numbers come out like exceptionally weak, right, we are definitely looking to get on board here. Now, I would say when China does start to discombobulate, it'll probably take another month or two. Then you're going to start to see the safe haven trades really kick in. They're buying Swiss, they're buying yen. Now, the biggest raw nerve in the market is going to be the Aussie. That's going to be tanking. So you've got Aussie going down, you've got the Swiss going up. It's like a double whammy, right? So looking forward to the markets, you don't need to be sitting there all day, every day trading the markets. We're looking for the optimum time, whether it's on a short-term perspective or a long-term perspective, to get into these trades that make sense around the key fundamentals, right? So I'm saying to you that Aussie Swiss will keep going down, Aussie yen will keep going down. They're going to get absolutely drilled. And then the best thing is, right, when do you get in? Well, if there's no trend lines, you can definitely come back towards momentum and start to look for those on a short-term or long-term perspective. And then at the same time, you can be looking here at this is where the fundamentals come into play, right? Now, as I said, you don't need to sort of trade the actual release, but we have a calendar here that tells us when these events are going to be coming out. So you don't need, and the good thing about the fundamentals, as far as direction and momentum, you know the exact time that is going to occur. Now, I still speak to a lot of traders who don't understand the fundamentals or haven't heard of them, and they're always wondering why, you know, the various instruments are moving around when they do. Well, there's a calendar here, and the general calendar is set a year in advance, right? And they slowly collect the data. So you can come back, look for the Aussie numbers, and you can come back into your panel here. If I just come back, right, I would have the Chinese data there. You could probably keep the US up as well. Update that. Then you can actually sort of sit here and just wait for the Aussie and Chinese numbers. Now, the Chinese numbers are going to come out terrible. Will they be before the Aussie numbers? It's hard to say. Let me just go this month. Let's just take the US off, because the calendar is just going to be full of like trading opportunities, right? And this is where you've already got Aussie Swiss going down, Aussie Yen going down. Where do you add to the position or get back in on these numbers? If these numbers come out really terrible, well, they get naturally just going to sell these instruments, right? If we get stronger numbers, well, that's good. You just stand back, just let it sort of let the counter rally go. There's going to be short squeezes through this, and that's where the market sort of has a counter rally against the overall trend. Let me just get off that. Okay, so when we are looking at the overall trending markets, right, there's two different ways, two different strategies, right? One is to sort of start looking at the markets and run a long-term trending trade. So you're setting this up probably at the start of the week, okay, if you haven't got the trade tools, because those obviously as the time goes by, this trend line is going to come into place here, not up here, right? So there's a few different tools that you need to have to understand where to get in. You get on board on a long-term perspective, short-term perspective. You're basically going to have a smorgasbord of trading opportunities on the Aussie dollar, and all you need to be doing, right, if I just come back to Aussie Swiss and all these instruments, is draw your trend lines, right? The best place to be getting in is the trend lines. This is what the guys at the banks are drawing every day, and they are looking for opportunities. So they look for direction and then the trend. This is getting to an overbought situation, so there's going to be pressure on the downside at some point. When? I don't know. It could be 2 hours, it could be 3, it could be 6, right? Then you've got a support trend line. That breakdown will probably coincide with the push down in momentum. You've got everything working for you, right? So we need to wait a month, maybe 2 months, and we'll start to get all this crazy weak data out of China. It's going to directly impact Australia because they will be cancelling all the orders they usually have. What you need to be doing is drawing your trend lines, okay, against the various instruments. So you know exactly the key levels to be getting in, whether it's technically, fundamentally, or even momentum-wise, right? Okay. Now, I don't know if I did an excellent job there because it was sort of just dealing with GoToWebinar, which is my sort of issue. But so all I'm trying to explain to you is that looking at the major currency pairs, there's some that are different to others. And that's because of what the global sort of geopolitical situation is doing. Aussie's the major focal point, Kiwi's the backup. Okay, they trade together, and then you've got the CAD. Now, what's going to happen with the other ones? Well, they'll probably drag the chain, but this is what you're looking for is the raw nerve, right? We can see the tsunami coming. It's just a matter of getting in front of it and making sure that you understand what's going on. All right, now I know we're getting close to the end. Let me just show you some of the things that you're going to get access to. There's a 7-day risk-free trial to a lot of our components. And I apologize for the presentation being a little bit here and there and all over the place. It's a fine line to try and structure a technical analysis sort of learning session in with fundamental analysis, and then really what the whole topic is trading the Aussie. Now, if you come to the main site, you'll have obviously you'll come through. You'll be sent an email with access to our risk-free for 7 days. Excuse me. Now that's going to include access to the live trade hub. This is more like a general catch-up page, right? Where you can see what the plan is for the week, what the key opportunities are. Now that the daily updates come through Mondays, or since we had Easter Monday yesterday, Tuesday is the weekly kickoff. You get daily updates each day. You'll be sort of instructed somewhat around the US yields, whether we have a risk on, risk off profile. The live sessions, we have 2 live sessions each week. And actually, if we get this email out soon enough, you can join the live trading session around our live trade signals, right? Now, this is the other part, right? So looking at your charts, right? And we're just looking at the major currency pairs on this one here. Now, if you go and start to look around like all the different instruments, and that's just the 6 Aussie crosses, you've got so many different instruments to be looking at. So what I've set up is and designed over a long period of time is a tool to actually tell me, are these instruments going up or down? And the ones that are uniform, that have clear direction, short-term and long-term, they come up on our live trade signals page, right? And then it's just a matter of waiting for the alert to get into the trade, right? If you see an alert, to me, that is a signal, okay, I need to go and have a look, right? So, and just to give you the heads up, you may join the webinar tomorrow, you may not, but Euro, right? This is going up short-term and long-term. Momentum is going up in both, okay? If we had a fundamental release, definitely looking to buy. You're a buyer, right? If this thing's going up, you're a buyer. Now, on the long-term chart, it's in the sell zone, right? So, yeah, I probably wouldn't go in and start buying Euro just at the moment because the signal is in the wrong, doesn't match up with the overall opportunity. Now, Euro Kiwi, on the other hand, is bullish. Short-term momentum's going up, long-term momentum is down, but it's massively oversold. We're in the buy zone, right? So you are looking to get into that trade, right? So one of the things that I would always encourage is if you see a signal, right, and there's one extra layer that the tech guys are sort of just about to roll out on this to make it a bit easier to read or understand, is if you see a potential setup, investigate, go and have a look, go and have a quick look at Euro Kiwi and sort of get the lowdown on what is going on, right? So, and that's where having Icon is ideal because I can come into this and go straight into Euro Kiwi. Where are you? I've got the time there, Bobby. I know we're right on the cusp here. Righto, so this thing here, it is going up. We've got a nice pullback just of late. It's just getting into that oversold situation, and you know what? It's still sort of hanging in there on the daily, on the hourlies. To me, I'd be sort of starting to consider. One thing I would do at this point is have a look at the economic calendar and go, is there any Kiwi news coming out, right? Because that is the crux of it, where you are combining, you know, technical analysis with like a strategy structure, and you would be looking for Kiwi numbers. And then all of a sudden you are trading technically, fundamentally with the market, and you're also factoring in the overall bigger geopolitical events, which are going to hit specific currencies like the Aussie and Kiwi. All right, so just as a bit of a wrap, you are going to get access to that. So you got the live trade signals, Prime Time Pro. Actually, you can check that out on the site. There's more information there about that, but excuse me, that's a tool we use to put all these trades into play. The live sessions, as I said, you get a 7-day risk-free trial. We will have a live session this week. We haven't exactly worked out what the key, where the major focal point of the data is. This is the third, coming into the 4th week of the month, where there's not that many really key fundamental numbers, but we'll look at that. Utilizing our live trade signals will be tomorrow, and that's something that our members will be getting into. Got the economic calendar, which is also on the homepage. Oh, this is the most important aspect, the courses, right? The masterclass courses. Now, I was jumping around there because there's a lot of structure here around our education platform. Okay, the quick start guide to get you into it, prime time trading, which is all about trading the the momentum and trend lines, and then you've also got the other key courses here. So there's a lot of detail, a lot of data. I would have liked to have broken it down into a little bit more of a finite situation, but I think I've given you a bit of a cross section. May have confused a few people, Bobby, but the whole aim is just to try and open your eyes. Think about where is the pain coming, because when we know the pain in the market, it's very easy to sort of start picking off the markets. That's it, Bobby.
All right. Yeah, thanks, Brad.
Yeah, a little bit here and there. I don't like to sort of really over prep the presentation, and trying to just the fact with Jerome Powell under pressure to lose or keep his job from Trump has really messed up the flow of things a little bit. But hopefully your clients there get a decent bit of understanding around that. Sorry about potentially using the wrong platform. Workspace, it is the same as Icon. It's just yeah, maybe a few different pages. The way the templates come up may be different. Anyway, did my best.
Yeah, no worries. Thanks again for joining. And yeah, the markets are kind of wild right now, so totally understandable where you're coming from. It's still nice to have you in and kind of showing everything for us. So yeah, we appreciate that. I'll go ahead.
No worries, Bobby.
And yeah, I'll go ahead and take over from here. So yeah, thanks, Brad. I'll be in touch in the near future.
Cheers, mate. Cheers, mate. See you, everyone. Bye.
All right, guys. So let me see here. Going to utilize a slightly different screen here. So just getting things kind of shifted over. So that was Brad Gilbert. And now, wow, this is huge over here. Let's close that down. I'm actually going to be your next speaker. So with that, I still want to give a big shout out to some of our sponsors today, one of those being the Australian Technical Analysis Association, or the ATAA. They've been fantastic. We've done a lot of events with them in the past, both in person and online, and they are doing like a special offer for users who are interested in getting access to their platform for just $1. I can see Greg just shared in the GoToWebinar chat. I'm sure he's sharing that in YouTube as well, but you can just go to this link down here and take advantage of that. So just to tell you guys a little bit more about who I am. So I've been with Metastock. It's going to be 9 years here in a few months. So it's been a little while now, and it's been fantastic. It's a great community here. I was on our sales team for 5 years, and now in these last 4 years, I've handled all of our international business development. So I've kind of helped partner with different professional traders or educators or people of that nature from all over the world. And luckily, I myself, I would not say I'm a professional trader by any means, but I am lucky enough, to be able to learn from a lot of different people and see a lot of different ways that someone can analyze the market. And what I'm hoping to do today is, maybe share a few of those things with you. A lot of what I'm going to be showing today, you guys have already seen. Because it's all going to be inside of Metastock, and so far, all of our speakers have been utilizing Metastock or one of a similar product. And I think I actually have a slide showing all of that. Real quickly, just before I do my specific demo here, I want to remind you guys that this demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by Investors who are aware of the risk inherent in trading in Metastock shall have no liability for any investment decisions based on the use of the software and any trading strategies or any information provided in connection with the company. I also want to give a quick shout out here to our other sponsor, Stocks and Commodities Magazine. In fact, we've been kind of working with them for a really long time. For the last 30 years in a row, we've been rated as the #1 technical analysis software according to the readers of Stocks and Commodities Magazine. So, it's not just me saying that the platform's great. There's a lot of other people that agree as well. I also like to briefly kind of just talk about the heritage of Metastock in all of my presentations here, just to give you guys a little bit more of an understanding in case you didn't know. We've actually been in business for over 40 years now. We were founded back in 1982. We were purchased by Reuters in 1995, and we released our first real-time data feed based on their technology for Metastock back in 2005. And then came Metastock Zenith in 2012. And then the following year in 2013, we actually divested from Thomson Reuters. There's been a lot of name changes in the years, Refinitiv, now they're owned by the London Stock Exchange Group. But basically, we've always been the same core people at the company. The average employee has been here for over 10 years, so I'm actually below the average mark here. But now that we're not owned by Reuters or that group anymore, we have less red tape that we have to deal with, so we're able to move more quickly through to get you guys like updates and maintenance improvements and things of that nature. And here is where I was kind of leading to earlier. So what all am I planning to show you guys today? Well, I want to show you how can you find securities to trade. Also, when should you get into and out of a trade, and what system should you utilize? And how do you test these different systems before actually getting into a trade? So those are all the questions I'm hoping to answer for you guys today. I am going to actually pull up my question box over here on my other monitor to make sure. And to answer your guys' questions here. So I see someone has asked, is my presentation shorter than the others to allow for a chance for lunch? So we didn't really program in any breaks throughout the presentation. Sometimes you have a few minutes between speakers where I'll just be talking about our sponsors, but we are going to be just running straight through the day, Chris, to answer your question there. And I'm not seeing anything in YouTube, so we'll go ahead and keep going. I'm not going to be inside of a PowerPoint the whole time. The majority of the time I'm planning to hang out inside of Metastock and kind of showing you guys some things inside of there. And feel free to ask questions throughout. I'll try to look over here and remember to look at them. I'll definitely get around to the questions before the end of my hour here, or there's about 50 minutes left for me. But yeah, let's go ahead and get to Metastock. So I believe you can see my charts now. Yeah, so all right, this is just the AORD, so the All Ordinaries for Australia, a very basic chart inside of Metastock. I'm sure you guys have seen similar charts, all over. Nothing really too exciting to be looking at here. But I want to kind of show you guys first why I like Metastock so much, and just a couple of different things that you might notice that we do differently than some other platforms, and give you some reasons as to why you might want to be utilizing Metastock for your charting service as well. So again, starting with a real basic chart here, it just has the volume down here, and then we have some candlesticks up here. You can of course come in here and change the price style. We have a ton of different styles for you to choose from, including the normal bars, candlesticks, etc. But we also have candle volume, Heikin-Ashi, 3-line break, Renko charts. So you get tons of different options there. You can customize everything to kind of be however it is you may like it. I like having the green and red for the up and down. You can also fill them in differently. So still, I know this is all real basic stuff, but I think you guys will kind of come to appreciate some of the things I'm going to show you today. So what I'm going to be working with today is a very popular strategy. It's been along for a while, and a lot of people that are into technical analysis have probably heard of the MACD, or the moving average convergence divergence is what that stands for. It's a real basic indicator that I've kind of just plotted onto my chart right here. And there's a few different things that you can do with the MACD, and I'll be showing you guys kind of a few of those different things today. But one of the most common things that the MACD might help you look for is like a bullish or bearish zone, or maybe as simple as a buy signal when you have a crossover of the MACD and the signal line, as seen right here where it's crossing, or also a cross down of the MACD as well. And oftentimes people can just work with that as a very easy kind of buy and sell indicator, or bullish and bearish type of indicator. There's additional things that you can do with it, such as, so this is the zero line here. Often when it comes really far away from this, you might be getting into what could be considered overbought or oversold conditions. So that's another thing that people look for with the MACD. And basically, if you have this indicator on your chart, often what you're trying to do is see, okay, well, when I had a crossover here, that means there was like a sell right around here, which, that actually kind of lines up pretty good there. And then there was another cross about here. So that actually would have been a really good trade. But one thing that can often be difficult, sometimes, like right in this area, you can't really see, well, did it actually cross over on this day, or was it this day? Is it a cross up or down here? That might be kind of hard to notice at like a glance, and maybe you forget, how far away does it have to get for it to actually be considered like overbought or oversold, something like that. Well, one of my favorite features inside of Metastock is the expert advisor. Now, here is our expertly designed expert advisor right here. The president, Kelly Clement, went ahead and updated these icons recently, but our little man with the top hat, as he's always had, at least as long as I've worked here, he's the expert advisor. You can click on that or right click on your chart to kind of open up this tool. What I'm going to do is just type in MACD here. You'll see a few different strategies that kind of utilize it, but what I want to look at is the MACD by Metastock, and I'm going to attach this to my chart, and you guys are going to notice a few things happen here. All right, so we'll click attach. I'm not on my normal work PC, so it might be a little bit slower than normal, but we got that on. And okay, here we go. So there's a few things that have happened here. One that's very obvious, you guys can probably notice, is that we have these buy signals and sell signals here. And let me grab a line here so you can actually see what I mean. So when we have these crossovers, like right here, I know automatically, okay, well, this had a buy signal right here. Also in this kind of choppy area here that I wasn't sure on, well, you can see we actually had a buy here, and then a sell signal here and another buy here. And that's kind of hard to like make out here at a glance, but this expert advisor just automatically puts highlights on the chart for these buy and sell signals. And again, I'll say the MACD is a very basic indicator. Maybe you're saying to yourself, oh, well, I can see it. I know those things already, etc. Well, keep in mind this expert advisor can also be utilized for very complex systems as well, where you might have multiple different variables that signify a buy or a sell signal or something of that nature, and it can automatically put the signals for that on your chart as well. So that's one thing that I like about this. But again, we're using the MACD just to kind of keep things simple today. So another thing that it's done is it put this bullish and bearish ribbon down here on the bottom. So after you have one of those buy signals, that puts you into a bullish zone, as you can see here. And then when it goes back to a sell, when we have a cross below again, then it goes back into bearish down here. So you can also just quickly at a glance, especially, if you're more zoomed in, I just look and I automatically know, okay, I'm in a bullish zone right now, at least according to this indicator. on this time frame, etc. And currently we're just looking at a daily chart in case you guys didn't catch that earlier. I'm going to be keeping kind of everything just on our daily chart again for demonstration purposes today. However, this isn't all that the expert advisor does. It is doing a little bit more than just this kind of in the background. And I just need to turn on this additional feature, which is the expert commentary. So I'm going to go ahead and click on that. And now we have our commentary window that's popped up here. You can have this as a pop-up. You can put it on another screen. I like to kind of just drag it over here, and I can drop it either on the whole left side of my chart, or I often like to hide it inside of this side window here. And then when I want it to come up, I can just hover over it again or click on it. And then it's going to stay open until I click back out here. So that's also a place I like to drag it for the demo. Maybe I'll just click it right here so it stays open though, and I'll give it a little bit of resizing. So another thing that it does, let's go back over here, and I'm actually going to click on my chart. You can see where this arrow is where my commentary is. And on each date, when I click through, this updates. So it lets me know the current like close and change price. It tells me the MACD value and the signal line value. I can also read here that currently the MACD is bearish since it is trading below its signal line. The MACD crossed below its signal line 0 periods ago because we're on that bar. And since it crossed its average, it's changed this much. So I'll go ahead and maybe click into another zone here. Now, when I have like a buy, it's going to change this to bullish. It's going to let me know how much it's changed for the positive. And as I click through here, I'm having different things update. It also lets me know on here whether the MACD is in an overbought or oversold condition. And it also lets me know if there's been any like divergent signals within the last 5 periods as well. That's another thing that the MACD is often used for, are divergence periods. I'm going to zoom out to see if I can at a glance see some of these changes that come in to show you guys some of those examples. In fact, so I actually just applied an expert advisor. What I think I want to do is show you guys, we have a MACD template as well, and this is a little bit different. It has a histogram on it, and it also changes some of the background colors, but it's the same thing basically. So I'm gonna go ahead and open this up, and this is a template here, and that just loaded a lot of data. So that's what you saw at first, and then it zoomed in a bit for me. And I was thinking this might help me see some of the other indicators a little differently. It'll put a blue mark on my chart for me. It looks like none have happened in a while on this chart, so I'm just gonna go ahead and zoom back in. And again, we're looking at the same thing here. This is just a template that we have put together that has the MACD, it has volume, it has the dark mode here, and it's put together with lines. You can come in here and change your templates. Like if you want to keep it as candlesticks, you can apply that, and then you can save this like as your default template for the MACD. Also, like if you don't like some of the like grid lines or something like that, you can turn those off as well. Again, everything in Metastock is going to be really customizable for you guys, but I'm just going to be showing you some of the features today. So that expert commentary inside of there and having these signals show up on your chart and the ribbon, that's something that I really like that Metastock can do. Maybe as just another very quick example, you know, let's also look at like Bollinger Bands by Metastock. I'm going to go ahead and apply this. This is just another example here. This is an expert advisor. We still have my histogram up here, but you can also get like buy and sell signals from like Bollinger Bands on your chart. Or maybe you want to look at something like Ichimoku, I think is a good example with some commentary. I'm going to go ahead and turn that on. And I know if I actually try to pronounce too many of these, Greg is going to tell me how I pronounce them incorrectly because he has spent some time in Japan. And he can say these much better than I can. But as an example, here's like some commentary on another trading system in here where now I'm getting way more indications in my commentary of, you know, what's bullish, what's bearish, what are all the different values at, etc. So I just wanted to show you guys a couple different examples here. You can also see in this, with all of the different signals and things on the chart, I'm getting information for every single one of them in my expert commentary, and I can easily see like what settings it's set to currently as well. So lots of different things you can kind of do in Metastock just on the charts that's going to make your analysis faster, save you guys some time, give you some additional information, whether you're a beginner really trying to learn all of these new things, or even if you're an expert but you just can't recall all of this information, or you want to be able to see your values at like a really quick glance, the expert commentary is going to be fantastic for that. And now that I've showed you guys kind of all of that, I of course also want to start going down the line and answering some more of those questions I told you guys I was going to help you with today. Like, okay, well, that we have many different strategies in here, hundreds of different strategies, in fact, but you don't want to go through looking at 100 or 1,000 different charts to see what's giving you a buy or sell signal today. Well, we have a tool built into Metastock, which if you've been with us all day, you've seen other people come in here and use some of the different power tools. Adrian, 2 speakers ago, a lot of the information that he had been working with came with our system tester, which I'll get to next. But I know earlier, Daniel Sinnig showed you guys some explorations for his SuperTrend bullseye strategy. Well, what I want to do is show you guys how we can take that same MACD strategy we were working with earlier, and how we can scan the market and save ourselves from having to look at hundreds of different charts and get some securities that might be actionable today. Excuse me, got the hiccups here, based off those strategies. So what I'm going to do is use the MACD expert system. If I hover over it, this lets me know that this is going to search for things that have had a cross either above or below the 9-period EMA with the MACD here. And if I come over here, the records to load, this shows we're going to load 1,000 records. I'll actually change this to 1,250 because that's about 5 years of data and what I normally work with. And now I come over here, you can see Metastock has access to over 300,000 different securities. Well, we definitely don't need to scan all of those. I'm not really interested in all of those. This is the Australian Summit. So what I'm going to do is come into our public online data list. We'll go ahead and open up our index constituents and come in, and we have the Australia's All Ordinaries. So there's about 487 securities in here. I'm going to select those and hit Start Exploration. We'll do this live. So it's currently going to show everything from these 487 that have a buy or a sell signal today based on the MACD. And you can see it's rejecting about 86%. So that's a good thing. That means it's saving me from having to look at those. It's greatly reducing the amount of securities that I'm going to have to look at. And then again, if say, I'm only interested in buy signals, I can now filter this to just show me, the buy signals here, which are all the ones with a 1. Or if I'm interested in just the sell signals, there's less of those, but I can look at those as well. I can also search for the overbought or oversold conditions in here also. So if I come back to this buy, or maybe I'm checking to see if anything's selling off in this, because we're currently, I still have the old trading strategy applied there. The Ichimoku instead of the MACD. I was jumping around a bit. I'm actually going to come in here and change my default template here to be the MACD histogram, and we'll go ahead and use its templates, use its periodicity, and come back into my exploration. And now what I'm going to do is just open up this first one that kind of showed up here on my list. I'm going to double click on it. And we can see LFS.AX has now popped up. It still has my old chart open here. I'm going to go ahead and close that. But here is the LFS.AX. And if I zoom in here, we can see that currently I have a buy signal on today's bar because the MACD template is what I have it set to open up as. And so I can kind of look at this. and see if this is something I would consider trading. Looking at these kind of unique bars here, it looks like this has a very small range on it here and not very much volume at all. So this is a security, you know, I probably wouldn't be interested in. I'm going to click the next arrow here, and what that's going to do, because I started this from my exploration list at the top, when I click the next arrow, it's just going to open up the next one from that list. So if we come back over here, we can see that it is igl.ax. That was the next one in the list. So if I come here, I can see igl.ax. In fact, let me see if I can actually turn something on for you guys. We'll go ahead and display the watermark so it's easier to see what chart I'm looking at here. So I've got that turned on for you guys. And now I can see this one has a buy signal here. And, you know, I can quickly also notice, though, you know, this has been a little bit choppy going back and forth here. It's not in a strong kind of trend in either direction, pretty sideways here. So maybe I'm not interested in this one either. So we'll keep going on down the list. Now with this one, again, I'm able to go through these much more quickly here. They all have the template that I selected applied. They all have a buy signal today, but I'm easily ruling a lot of these out. This is kind of in a downward trend, and I just got to buy. Maybe something I'd want to look at if I think the markets are going to change overall, but not really something I'd be wanting to buy, etc. Now, you know, honestly, there are still quite a bit in this list. And I'm still kind of going through maybe more securities than I want to be going through to test this. So what I want to show you guys is, you know, how we can maybe dwindle this list down of what securities I actually want to be looking at with the MACD. Or another thing that we can determine with the next tool is also, you know, if maybe I want to use a different trading strategy, like how do I kind of determine which strategy should I be using and on what securities should I be using it on? Because the Explorer can help us easily find these signals, but maybe I'm not so sold on the MACD, or I'm not so sold on this list of instruments right now. So I'm going to come back into our Power Console here, and this time, instead of the Explorer, I'm going to go down into our System Tester. And what the System Tester does, it's kind of in the name, it lets you test different systems. It's going to let me go through and kind of see what different trading strategies have worked the best on the markets that I'm interested in trading. So what I'm going to do inside of here is I'm going to select the MACD expert system. And if I hover over this, let me actually click off and then hover over it. So it's going to tell me exactly what this does. It back tests for buys and sells with the MACD when it goes above its, above or below its trigger line, which is that 9-period exponential moving average of the MACD, or, you know, the signal line. It will also use an oversought or overbought condition for the entry or exit if the crossover doesn't exist. This system's formula match those that are used in the MACD by Metastock Expert Advisor, which we were utilizing earlier. It does have this note at the end saying that exponential indicators are sensitive to the amount of data loaded, so the buy-sell signals may vary if you vary the amount of data loaded. And the reason I bring that up is because you want to look over here. With this systems test, I am going to check the last 1,250 records again, and because I was also scanning with that same amount of data, I should have the same types of results show up. Like anything that has a buy signal today in the Explorer would also show as a buy signal today in the system tester, as long as I have the same amount of records loaded. To kind of help this make a little bit more sense, say we were only loading 100 records, right? And I have a 50 period moving average on there. Well, you know, that's going to be very different on 100 records versus like 200, 300, 400 records, etc. That amount's going to vary when you have these longer like moving averages based off just the amount of data that you're loading. So that's another reason to kind of help with that. The MACD doesn't utilize a ton of data, so you could do it with a lot less, but I personally just kind of stick to the 5 years as kind of my baseline. I'm checking for questions again, just in case anything comes in that's topical. Oops, I just closed it down. So let me open that back up real quick. Chat is good. All right, I'll just go ahead and keep going for now. All right, so we're gonna select that same index constituent list, the Australia's all ordinaries, 487 out of 487. So what I'm gonna do with this first test is I'm just gonna check the MACD against that list. The system tests can start to take a little bit longer to run. You shouldn't have to run them as frequently, but they can take a little bit longer if you select a lot of different trading strategies and a large list of constituents. You have to kind of multiply those together. So if I were to select more strategies against this, then it quickly goes to having to load thousands or tens of thousands of different strategies to kind of like load through for each security. But really, it should take less than a minute to kind of have this scan run through for all of the all ordinaries on Australia with this MACD. And then I actually ran a scan earlier today testing a lot of different trading strategies against one another, and I'll show you guys what that looks like as well. But first, to kind of keep this basic, we'll go through this. You can see down here that it's very quickly going through all of these securities. We have about 80 of them left. It's just going to take a couple more seconds and it should be completed. So now if I knew that I wanted to trade the securities inside of this list, or whatever list it may be, like maybe you only want to trade the S&P 500, or you only want to trade the FTSE, or whatever it may be, you can kind of look into the different things there. So there's different ways of utilizing this, but this is just to show me, well, okay, I think I want to try out this MACD trading strategy on something in the Australian market. So this is a list you could consider. So what I have here, I'm going to go ahead and make this full screen, and I'm going to sort by net profit. So you can see, well, something crazy happened here with one of these because it had over a 2,000% gain. You guys might be familiar with this symbol. I'm not, but you can see here, it's skewing the data just a little bit. I guess we could take a quick look at it if we wanted to. It looks like if you were to have traded the MACD strategy on this, you would have had a 2,125% performance. However, we can actually come down here and look at the buy and hold performance. And if we would have just bought it and held on to it, it would have performed slightly better. So that's actually something that's important to look at, because we could have taken 155 trades on this and slightly underperformed how well it would have been had we just bought it 5 years ago and held on to it. However, there are other things to take into consideration here, like maybe you would only be trading long, or you'd only be trading short positions or something of that nature. You can actually factor that stuff in here and start to kind of change these results. Let's also look at the equity curve. The equity curve is pretty good on this. It's actually, maybe in the last year, the MACD hasn't been performing that great on it, but still pretty interesting to look at. What I actually want to do with that, oops, I actually didn't need to close that down. Oh, that's my exploration. Let me open that report back up really quickly. What I'm actually going to do with this list, just because that one's so far out from the others, I'm going to just delete it off of here. And then it's going to let me see a better visual idea of what happened with these other securities. We can see that it's actually just slightly more winners than losers across this entire thing. And keep in mind, it's okay to see red. When I see all this red, I just know, hey, half of the securities in this list, I definitely would not want to trade the MACD system against those. That's what the system tester does. It lets you know what trading strategies kind of match the personality of what different, of which securities. So that's what we're looking at here. And what I could basically just do is say, maybe I want to take just the top 50 or so winners here, and I can save these into a list or something, and then maybe consider just trading these with the MACD. But I want to get a little bit more information on what we can see with the system tester and all that. I also realized I skipped showing you guys something. So I'll just jump into that real quickly here. In the system tester, we traded the we tested the MACD against this, but you can also go into trade options here, and you can change these options to match like your account size. So you're all aware, this was testing a $10,000 trading account that's willing to have up to 50% of its equity in the markets at a time. It might be across multiple different securities and things of that nature. Also, you can go into the broker here. Nowadays, not a lot of people pay commissions on like stocks or things of that nature, but if you do, you can add those into here. If you're trading on margin and you have certain interest rates or something of that nature, you can select that as well. You can also come in here and kind of edit like the trade price. So maybe you buy at the close, and this is actually something that I'll often do with the Explorer. I might go in and run my scans 15 minutes before the market closes and see anything that's kind of generating a signal, and then I might buy or sell right around then. That's actually often what I do end up doing. So I can come in here and say, okay, I want to buy at the close, or maybe you wait and want to buy at the open or something of that nature. You can change that too. Or if you just leave realistic market prices set, what that does is if I run a scan, say after the market's closed, and it gives me a buy signal that day, well, really, when I'm going to buy in, I'm actually going to buy in at the open of the next bar. So once a bar is closed, this will get you in at the open of the next bar if you have realistic market prices selected. So that's what it was set as. So now we all kind of know what was helping to generate these results in here, and I'll go back into that one more time to show you guys. And now from in here, I want to show you guys a little bit more inside of this. I know that I showed you guys briefly on the other security here, but if we come into another, this is one of the top performers here. Again, this is something I always want to look at, the performance. So this one had annualized an 85% per year over the last 5 years. That's fantastic. Well, if we look at the buy and hold annualized, that was 47%. So this one performed significantly better if you were to trade it long and short with the MACD on the security. You can also choose in the system tester settings whether you want longs only, short only, or both. This is using both. I can also see that it took 291 trades and 116 of those were long, 32 of them were short. Oh, sorry, that's just under profitable trades. It had 148 profitable trades and 143 unprofitable trades, but the average profit was $888, whereas the average loss was $619. So the winners were bigger than the losers. That's something that I like to see. There were also more profitable trades than unprofitable trades, which is also something that I like to see, but that doesn't always mean that it's the best. Sometimes your strategy might be looking for something that's very, very rare to happen in the markets, and when it does hit, you have huge winners. But if it doesn't actually end up triggering or happening, then it's a loser. So sometimes a trading strategy will have more losers than winners, but it's still extremely profitable as long as it's keeping the losers much smaller than the winners, if that makes sense. So something to think of. I often say, for newer traders, to really help you kind of keep your emotions out of it, you might want to look for a trading strategy that has that wins more than it loses. But you always want to consider, how big those winners are and the losers, etc. So one thing you can actually look at from this page, which shows all of them here, is I can see how many were profitable and lost there, and the average profit to average loss ratio here as well. So you can see with this one, it had 101 profitable trades with 187 losers, but the average profit was much larger than the average loss. It was over 2 times as big with the 2.34. So something to consider. This was like number 3 on the list. Let's go ahead and actually take a look at it. And we can see those statistics here. You can see the trade efficiency. You can even go in and see on like a daily basis, okay, was I in a trade? Was I out of it? It lets you see the position sizing, all of that. You can come in here and also look at the equity curve. So this is something I also like to look at because I want to ensure that it's been profitable in the recent times as well. So over that 5-year period, it actually was pretty stagnant for the first couple of years here. And then it started to go upwards here. And in the last year, it's actually been, it had a big loss and then it's been kind of sideways. So this isn't my favorite equity line to look at here. I'm going to grab a drink of water. All right. Let's look at a couple other examples. So I'm going to go back. Trying to stay conscious of time as well. Let me actually close that one out. Let me show you something slightly different here. So that's one way where you can see a list of which securities have performed the best with the MACD. And so you maybe want to save those in a custom list and just run a scan every day. That would only take, a few seconds to run through 50 securities to see if it has a buy or sell from the ones that were very profitable on that list. Another way to do this is I actually came in here and I selected multiple different trading strategies, the MAC as well as the MACD. We can actually see them in here. So I took the MACD expert system, our several of our performance systems. So we have like over 80 different strategies that are in here that we used to sell as an add-on for like, it's like $300 or $400, I believe. I can't remember the specifics actually, but they're all just included inside of Metastock now, and it's a huge list of highly well-performing strategies that have passed a lot of different kind of qualifications in order to be included. So I selected a few of those, a couple different pattern trading strategies that are part of performance systems. I also tested out the Bollinger Bands expert system, a turtle trader, a Bollinger Band just crossover, which is the basics of Bollinger Bands, the MACD, which we've been looking at, and a performance systems turtle breakout. So when you have multiple strategies, which I tested against that same list with the same account, it's going to first rank those strategies. But keep in mind, sometimes these can be a little bit skewed. So even these ones that are red are going to have winners inside of them. It just means there were more losers. But let's sort it by average percent gain. So if I do that, it looks like the MACD actually ranked 3rd in this list of 7 that I tested for. And you can, of course, test far more. Just keep in mind, it might end up taking a few minutes, or some people I've seen, they like to test out 100 strategies against thousands of stocks and they just let it run for a couple hours. Really, you don't need to do these very many times though, unless you're trying to just kind of update with the most current data from the past few days or something like that. But you can see other systems have actually performed better than the MACD on this. I know that these performance systems have all test really well generally. So this was put up against some heavy hitters. It's actually interesting to see that the Bollinger Bands didn't test all that well on this market. And that's just these strategies. We actually have several other Bollinger Band indicators and things like that to work with. But now I can go into each one of these individually to see how they performed. So if I double clicked on the MACD, that would show us exactly what we were looking at earlier. But granted, I ran these scans this morning, and the scans I just ran with the scans I just ran with you guys are showing like the current day's rates. So this might all be based off one day ago. But let's look at this other one here and see kind of how it performed. Let's rank this again by net profit. So something you'll see is we don't just have that one security really taking over this entire list when I sort it this way. And this strategy actually has a lot more winners than losers that I can see at a glance. Let's go ahead and look here. Oh, this is kind of interesting. So on this Melbana Energy, it actually had 26 profitable trades and 41 losing trades. It's the #1 security on this list, though, for this trading strategy. So that's what I was talking about earlier, but its average profit was almost 2.5 times larger than a loser. So even though there's not as many winners, they're just so much bigger here. Let's actually take a look at it. I always like to look at the top one. So we'll see the performance of this. If we looked at the annualized over the 5 years, it performed 190% increase per year versus the buy and hold, which was just 77%. So this is definitely a trading strategy. The Performance Systems Pattern Trading System 1. It's a bit of a tongue twister if I try to say it too quickly. So that one performed really well here, but it just had, more unprofitable trades than winners, but it seems that there's a really good chance that, the winners when they came were going to be a lot bigger. However, one thing that I don't love when looking at this is this equity curve. Again, I generally like to see it increasing gradually over time. This stayed pretty flat, and then it kind of really did some weird bouncing here. So I'm not sure what this looks like on a chart, but again, I like to see a little bit more consistency with my equity over time. But still something I might consider trading just because, it really has done really well and maybe the security just didn't take off in those first few years. But let's go ahead and go back. I'm going to go back again. Let's look at this the second pattern strategy that was included in this list I selected. Again, more winners than losers, but this one has a good, it's a little closer to even. We do see that WA1 resources up here is a big winner again. But let's skip over that one. I can look at my trade profit and loss here again to kind of get an idea of that. This really helps you realize what systems are going to work best for you. Another thing to consider is maybe you don't want to trade every couple of days or something like that. Some strategies have a lot more trades. This actually seems like less than the last one we were looking at. This one took 60 trades, 70, 84, 120, etc. Sometimes you'll see these numbers a lot higher, like 147, 124, etc. Maybe you don't want to trade something that's going to be throwing up this many signals. This one actually ended up being a loser, so you definitely wouldn't want to trade that one. But there's different ways to kind of go through this data is what I'm trying to get at. There's so many different ways to utilize Metastock to kind of give you guidance on this. I'm just trying to show you guys some of the tools and let you know ways that a lot of people do end up using it. I also know I've had some people that I've talked to and they're like, I just know that I want to trade NVIDIA or I want to trade Tesla or something like that. Well, you could come in here and you could set up your system test to just be those securities. So you could come in and just put in, Tesla and just trade that. And then you can select on the system test whatever you want in here. If you wanted, you could choose all 129 of the built-in system tests and see which one of them performs best on however many records you want to load. Maybe you only want to do long trades though, and you want to set up your trade options to like a 5K account that you're planning to just go wild with on Tesla. You can do something like that. There's different ways of using this. Or if you just know that, hey, I want to trade the NASDAQ 100, you can select the NASDAQ 100 and maybe a handful of different trading strategies that that you're interested in to see how they might work. You can also kind of then plug some of these in together, and then you can utilize the Explorer to kind of help you with that too. So let's go back to an exploration example. I could take something like the MACD, and one thing to note is, so those results that I got earlier, there were 71 results in here. I could then, well, in my same scan, actually, if I wanted to combine the MACD with, say, a Bollinger Band crossover, I could come in here, click Bollinger Band, and over here on the right-hand side, I can use the selected instruments for all explorations. So it's going to do one scan with the MACD against all 487, then one with Bollinger Band against all 487. Well, I could change this to use the results from the preceding exploration before moving to the next. So this would scan the MACD. I'd get those 70 odd results that it gave me, and then it would just take those 70 results and then scan it with my Bollinger Bands, and then give me a list of results from that might be, say, 20 or 10 or 5, whatever it may be. And now I have something that's signaling a crossover on the MACD and Bollinger Bands at the same time. And then maybe I want to trade that. So there's a lot of different ways to kind of combine some different strategies. You could then also, of course, come create your own custom template in Metastock. Maybe you start with, oh, I guess I stopped sharing my webcam for some reason.
I can still hear you though, Bobby.
Okay, I just had a pop-up. Yeah, so you could come inside of here and now just do something. Again, you just customize this to show what you want. So I could put like a Bollinger Band on here. I'm going to say yes, so you can see a Bollinger Band plus the MACD here. I guess it would have been better if I chose a strategy that was showing them both hitting today. But now I can come and save this as my default template. And then moving forward, you know, every security I open up is going to be saved with my default template. So Metastock is very customizable, you guys. You can utilize our hundreds of built-in different kind of indicators to get your chart how you want it. We have tons of different themes. So if you're, you know, used to having a dark setup or a light setup or whatever it may be, or, you know, you can easily set this to exactly how you want it to be, and then use Metastock to help save you time in your day-to-day analysis of the markets. And we have tons of different tools to help you to do that. So I only showed you guys a couple of them, our Explorer and the System Tester, which I use, you know, the Explorer almost on a daily basis, the System Tester probably on like a monthly basis, because once I've kind of figured it out, I don't have to use it as much. There's also ways to use the System Tester with optimization. That's something that Adrian had been utilizing as well. So you can come into these different trading strategies and then come into optimizations, and you can set different parameters, and then just one system test might check this with, this has option 1 has a minimum of 9, a maximum of 50, and it's going to check it in one step each. So what that means is, on this random strategy I've shown, when it's doing a back test, it's going to test this trend watch length at a 9, a 10, 11, a 12, 13, 14, 15, 16, etc., all the way up to 50, and spit out those results. I will say, once you start optimizing, your system tests are going to get much longer, so be prepared for that. But you can do that as well, and you can come in and you can edit a lot of these scans, as well as create your own custom scans too. So you're not limited to just by what you see in here, which I know is already a lot, but you can really kind of customize the whole system to give you what you want and to help you out with that. So let me dive back into my PowerPoint here and make sure we covered a lot of that. So I have everything I've been showing you guys has been in our latest Metastock 19, which has a lot of kind of just improved workflows and layouts. I know a lot of our customers that come to these have been with us for many, many years. Most of you guys are on 19. Some of you might be on an older version. Hey, if you're interested in upgrading your Metastock, we can get you a really good deal right now. In fact, Dave, who's hanging out in our chat, metastock.com/sales chat, he'd be happy to help you out with like a discount on an upgrade, or if you want just like a trial of Metastock, he can help you with that too. If you're wondering how much does it cost, well, you can get Metastock daily charts, which basically everything I've shown to you today is inside of Metastock DC. It has all the tools, everything I've shown. The only difference with our Metastock real-time is real-time also has intraday, as well as like our Zenith platform for news and fundamentals. But everything I showed to you today can be on this DC. It starts at $74.95 a month, or you can buy Metastock DC outright. And then you can get our data starting as low as $39.95 a month, or we also have local data options for you to utilize as well. Metastock real time to get the intraday pricing as well, such as 1 minute, 5 minute, hourly, tick, etc. For the software and the data that also includes like news and fundamentals in our Zenith platform, you're looking at about $265 a month. If you were interested in a trial of either of these or learning about some of today's offers, you can go to metastock.com/summit-savings. We do, of course, include free unlimited support with all of our subscriptions. Even if you guys just sign up for a trial, we offer a white glove setup and install service, meaning we can schedule a one-on-one session where we not only help you install the software if you want it, but we'll actually do a full demo in Metastock with you. So kind of like what I was doing today, going through the tools, we can have someone help customize it. Maybe you don't want 300,000 securities to choose from. You just want like the Asia Pacific markets or Australia markets to show up. They can help set that inside of the software, teach you a lot of the other tools that I didn't get to touch on today as well. And this is included at no cost. So that's something I always recommend people take advantage of. So if you wanted, like a trial, you get Metastock 19 global data, the white glove setup. We're also including our Unleash the Power of Metastock 19, which is normally a $99 additional like training module instead of videos that go along with an ebook. But that's included for free too. If you're interested in that trial, come into our chat room, metastock.com/sales chat. We have someone available to help you right now, or give us a call. It is in the US, so it's +1 801 506 0900, but we'd be happy to help you out with that. And we also have kind of a special offer that we put together that has all the trading systems that are in Metastock from today's presenters included. So you'll have Steve Bigelow's Candle Profit System 3.0, as well as Daniel Sinnig's SuperTrend Bullseye. Our training modules, you get access to the Traders Forum's kind of special training area. Greg mentioned earlier that the Traders Forum is free, but we also have thousands of dollars worth of training on there from Steve Bigelow from his Candlestick forums that you can get access to. It's normally $47 a month, but it's actually included for 3 months in this special offer for the $1144, which you can get at metastock.com/summit-savings. So I definitely recommend checking that out. Also, I want to give a big shout out once again to our sponsors. We have the Technical Analysis of Stocks and Commodities that's been, releasing their magazine for a very long time. Well, their readers have chosen Metastock as the best analysis software for over 30 consecutive years. So we're really proud of that. We also have the ATAA, Australia's Technical Analyst Association. They're fantastic. They have so much information and like local events and things going on that you can go through. You can get access to a membership for just $1 right now by visiting their website at this link here. We'll go ahead and put this in the chat for you too, so it should be easy to just click on. So be sure to check that out too. Now, with all of that said, it looks like we're at the top of the hour. So I'm going to get ready here to pass things over to our next presenter, Gary. Hey, Gary, are you with us? I can see.
Yep, I'm here now.
Perfect. Yep, I can hear you. I saw that you've been with us, I think almost the whole day, if I'm not mistaken. Yeah. So, hey.
Yeah, absolutely.
Yeah, I've been, talking to Gary for a number of years now. He's, worked with the ATAA as well as does a lot of other things in the area. It's always great to speak with you, Gary. I know that you did a presentation. You've done many presentations for us in the past, and it's always been very, I want to say entertaining, but also very educational as well. I've learned a lot. I'm really excited for what you're going to be showing today because I've actually started utilizing some of it myself more recently. So maybe I'll even have some questions for you here. But I don't want to take up too much more of your time, so I'm going to go ahead and make you
no pressure. Thank you, Bobby.
Yeah, so you should get a pop-up here in just a moment, asking you if you want to share your screen. You're also welcome to turn on your webcam, but you don't have to.
All right, so.
Okay, I can see Metastock. Now I see a slideshow, but it looks like
so
the
display
presenter
settings
mode. Oh, there we
that
go.
Look better?
Yep.
Very good. Okay. All right. Thank you very much, Bobby. And thanks, everyone. This is now the graveyard shift. We're at, I think, 11 p.m. US time. So here we are. Middle of the day in Australia. Beautiful day today, 75 degrees. Lovely day. So I'm here to talk about the Higuro method, and we had a lot of questions last time about using it in different time frames. So I really wanted to go over that. But as always, with where's my? I need you to work. There we go. As always, this presentation is not to be implied as financial advice in any form whatsoever, and all of the other disclaimers that were read today, they also apply. Took this photo this morning, beautiful morning in Tallebudgera on the Gold Coast. You must do your own research, and that's really what I want to talk about today. Is I spent many years on the road teaching technical analysis in workshops and various places, organizations and such. And one of the most common questions I get was how do I make some money? All I want to do is just make some money. And I find that as people come into the trading world or the analysis world, because it looks like a good idea, they come in with the expectation that they were successful in their own life, or they know how to handle themselves in life, and suddenly they step into the trading arena and all the rules are different. And they find that observations that they have used throughout their working career just simply don't apply in the trading world. So I'm going to, let me go back, sorry. Today I'm going to talk about trend and price structure, which I always talk about. Anybody that asks me to do a presentation, it's always trend and price structure first. And then we're going to look at some swing point observations, and we're going to bring that into Higuro, into the daily analysis, looking for daily setups based on Higuro. So one of the things that we all get caught up in, of course, is the noise of the market, the TV and the social media and X and people you follow, and this is doing that. And I could have posted 1,000 things here, but this one I had in at fairly easy reach. And this guy says that gold and silver are strong this morning. Both are on their way to the 2020 highs. This is from 2020. My targets remain the same, gold to 2,300 and silver to 35. Plenty of naysayers looking for the metals to head lower. Always nice to see that skepticism. So we should buy gold. The issue with that is that from that day, funny enough, gold declined 17%. And it kind of highlights that we can't see into the future. People might have you believe that they can, but we simply can't see into the future. And a lot of people look at technical analysis as a way of seeing or trying to see into the future, and it's simply impractical. The other thing that caught my eye only just last week was an email I received from a broking house. And at the bottom of the email in the disclaimer had this. It said that CFDs, or contracts for the difference, are complex instruments. Well, they're not. They're quite simple. You just win or lose. And they come with a high risk of losing money. And 73.85% of retail investor accounts lose money trading CFDs, which is essentially a leveraged product. I think the authorities made them put that on there. So interesting thing. One of the most profound books I read on charting, and I really want to point out, I'm an analyst. That's my strong suit, if you like. Trading comes along with that, but my strong suit is analysis and my interest in that. That's why I was very interested to listen to today's presenters, and even as seasoned as you might be, I always go to presentations when I can to see what people are talking about and what they've got to offer. But this book here, Japanese Chart of Charts, is a very old book. If you can find a copy around, steal it and keep it in your library. And we're going to go through some of the methodology today in there. So what the book talks about is that as technical traders, and this is where people come to technical analysis so they can be a technical trader. If we want to know what's going on, we need to consult the actual market, consult the market about the market. And we should look at the market movements itself, and rather than look at economic policies. And the traders should look at market movements as the ebb and flow and the river of greater market emotion. So we can see at the moment in the markets globally, there's a huge amount of market emotions going on as markets jerk around to various policy tweets around tariffs at the moment, and the uncertainty around that. As one of the earlier presenters mentioned, the uncertainty around China. At the moment, I noticed China went to 84% on their tariff regime today, so it's just a game of one-upmanship at the moment. So we look at the market, and if we're going to define a trading system, if we're going to put together a rigid trading system, like the backtester that Bobby just talked about, that's a rigid system in there. But I'm here for the guys that don't have the programming experience, that really want to set themselves up into a simple look at the market. I'm here to show you a very easy way to work with market pricing and give you hopefully give you some understanding into that. So if we're going to define a trading system based on a rigid protocol, then it can only be developed on a rigid defined analysis method. One of the key faults, if you like, of indicators is that we can change the values of the indicators to give us anything that we might need to see or want to see in there, rather than stay with the author's settings along the way, like relative strength, for example. The author really worked around a 14-period look back, but I see charts and people using a 3 relative strength and a 7 and oh, this works great on a 21 type of thing. But I can assure you that they did the maths in the development, and they really have done the work behind developing those indicators. So when we consult the market about the market, then nothing adds more to the severe realities of trading than the realities of day-to-day price movements. And I want to talk about that as we get along on this presentation. And the concern is that no two patterns are ever exactly the same. And we're constantly challenged to keep a perspective of chart interpretation. So things are always moving. It kind of looks like it did 2 weeks ago or a month ago or 2 years ago, and you see lots of social media stuff about, oh, this is now 2008 all over again, what's going on? Well, no, it's not. It's just something different based on something different. So the real application of the chart is to speedily identify tops and bottoms when they have been set. We're not here to predict tops and bottoms. And this is the profound downfall of people setting out to trade the markets, particularly short term, is they're really trying to predict what's going to happen. And if it does happen, they feel pretty good about themselves. If it doesn't happen, it's their management of doesn't happen that really dictates whether they're going to turn into a successful trader or not. One of the I'll leave that there, but I'll come back to that as we go. A lot of people talk about Dow theory, and I just point out that Charles Dow, the only reference Dow made to his own theory, which was just a theory, was a number of editorials written in a 2-year period, 1900 to 1902. His theory centered on the barometer of confidence in the market, so whether the markets felt confident. And he noticed that as economic times kind of waned or got better, he noticed that as economic times waned, even good stocks, the stocks that they knew were good, were marked down as well. And so he came up with his theory about general market movements. It was William Hamilton and Robert Ray that took on his work and developed into the basis of what we know now as technical analysis. So it's only in the decades after that that the idea was really developed up around price trends, and then of course as computers became more useful, then we see the indicators really exploded because they can be calculated fairly quickly. And so currently in this current market, I grabbed this off a site I can't remember, but it's basically the Dow Industrials and the Dow Jones Transports. And Dow put forward that when they move together, that becomes essentially whether it's a bullish market or a bearish market. And we can see currently, really from the beginning of this year, that they're both moving downhill. So we have a bear market on our hands at the moment, and we need to change or think about our strategies appropriately around that. So let's talk about what I want to talk about, fluid movement. Inside, we're going to break down our price action into different sections of price, if you like. And one of the more easy to see things are what we call like a primary movement of price. And a primary movement is simply the bars that are very directional, going in a direction either up or down, becomes our observation of primary movement. And we can see at the moment a number of stocks are essentially in a primary move down, where the bars are just opening at yesterday's low and going lower, and then opening again at that low and going lower. And we see that as our primary movement. The other part of this is the other part of our observation that we really need to take on board is for understanding our chart is a thing called the secondary movement. And the secondary movement, you can notice that it has all of these overlapping bars. So the days or the weeks simply overlap each other and becomes our what we call a secondary movement. And hopefully then it breaks into a primary movement, and then it'll go back into a secondary movement. And it's out of these movements, it's out of these secondary consolidation areas at the moment that we start to see patterns develop. And there's many books written on patterns, but we're looking for a break out of that pattern or out of that consolidation. We're looking for a break, and it could be either way. And it sounds quite, I do some writing for a broking firm down in Sydney, and it sounds almost vague when you say, well, it could break up, it could break down, which is absolutely true, but that's not what people want to hear. Particularly when they're holding a position or looking to get an entry into something. So we have a thing called a primary movement in our price and a secondary consolidation. So, and just another look at this, primary and secondary consolidations. And on a weekly chart on the right-hand side, you'll see the same chart, but it looks very different. But we do see this overlapping weekly bars in here. And we saw this great rally, and then of course the reverse came out of that into a primary down move at the time. So we break up. Our first observation is stand behind your chair at your desk with your chart on your screen and have a look and eye out the primary movements and the secondary movements in your charts. We needed to define what actually constitutes a trend, whether it's an uptrend or downtrend. And from the textbooks, we find that a trend can be identified by the way of higher highs and higher lows. Well, what does that mean? So what we can do is put some rules, if you like, around that. And we can then say that the retracement of a primary phase, which is essentially a primary movement, should be over 10% from high to low. So 10% of price, there should be some form of decline, and then an advance, hopefully, then an advance from high to low to be considered a movement. So in this example here, we'll look at this on a lot of charts in a moment, but in this example, we had the price advance into a peak, there was a decline. These are usually secondary consolidations, overlapping bars in these declines. And hopefully we get a higher low in here, a low, and then as we break through past this previous high, we can then define that there is a trend in place. Now the breakthrough doesn't declare that we're going to continue to trend, but the buyers are willing to buy at a higher price than they were in the previous week or 2 weeks prior to that. The start of an uptrend is identified when the price makes a new closing high. I wonder where those guys found their little laser thing. Anyway, I'll work on that. Okay, so this defines an uptrend on our charts. No information in here about whether it's ever going to continue. but this is what we're looking for at the beginning of new trends. We're currently in a bear market, so in X number of X time looking forward, our market will change, and this is what we're on the lookout for, is a change in trend. Now, stocks can operate individually from the index itself. Of course, currently gold stocks, if anybody owns any gold stocks, they're also doing extremely well at the moment, and they're trending, as is gold is trending higher. So inside Metastock, there's this nifty little tool called a zigzag tool, really simple little tool. And if you set it to 10%, it will draw out the trends for you. And what it does is when the market declines more than 10% of its price, it starts to, it comes in, it follows the price down. We can see over here on the right-hand side is just following the price up. But it follows the price down, and once it's met 10% or over and the price starts to rally, it will then set the low and zag. So we've got this nice little zigzag tool in there that shows us historically whether the trend is up or down. So currently we can see we have a series of higher highs and higher lows on our chart. There we are, a series of higher lows and higher highs on the chart. One of the more interesting things that Darryl said earlier was back in the day he would hand draw his charts. And I'm a very big advocate of making your own notes on your charts that actually stay there. And Metastock is very good for that, of course. You can save a chart with all of your notes, but if you see something interesting on your chart, you should write a little note on there, or identify the analysis that you really want to stand out, in this case, high highs and higher lows. If we come in and break this previous low, then we'll enter into a downtrend, and that should be noted on your chart as well. But again, along the way, we can see the primary moves, the secondary moves, the primary moves, the secondary moves, primary move in here, then a secondary, and again the primary move here into the highs, and then the primary move into the highs, and then a primary move down in there. So, and a little secondary area here on the right-hand side as a little consolidation. Now these are weekly charts. Always do your analysis first on a weekly chart, then step down. You really need to see in the big picture where the big money is going before we start to look into smaller timeframes, daily timeframes, and less. And I'm going to go there as we go into this presentation. So again, there we go, Microsoft. This was a couple of years ago now, just a chart I grabbed, but it shows primary move, secondary consolidation here on the right-hand side. And thank you. That's really what we're looking for, is a series of higher highs and higher lows in our chart, just by observation. And the zigzag tool will give you that. It's a really simple little tool. It's the bottom of the indicator list. It shouldn't be there. It should be on the top of the indicator list. But there it is, a Z down the bottom of your indicator list. And just to simply put it over your charts, and it will show you where the trend is. All right, so the same with a downtrend. As the market comes in and makes the high and declines, and then has the first retracement, and then often will then decline and break the previous trough or the previous low, then we declare at that break point, we then declare that there's a downtrend in place. And if you go and look at most indices around the world today, including the XJO here in Australia, we're in a downtrend. It's simply doing this. This gives you no information about how low it's going to go and how fast it's going to get there, basically. But we are in a downtrend. It's where the buyers can't lift the market up to break previous highs, and it's where there's not enough buyers to lift the market and before they encounter selling again to see it sell down. And we saw last night in the US, markets got sold down about 3%. We were down earlier this morning and starting to rally as we speak. So here we go. This is Apple currently. So zigzag tool, simple tool on Apple, made the high in January and then set a lower high, and currently Apple is trending down. So if you advisor rings you and said, look, let's buy Apple, well, maybe you're lucky to pick the low, but basically you're currently buying a downtrend. Evidence would suggest that if you wait for an uptrend, then probability is dramatically stacked on your side, just on this simple observation. There it is there. So back in mid-March, we broke the previous low and we entered into a downtrend. I really wish I could find that little I won't touch it in case I break it. Yeah, here on the right-hand side, Apple is set in a lower high and a lower low. It's irrefutable. It's a methodology that can't be changed, if you like, just on that simple observation. There's no manipulating your observation of that. It just is. It's based on our 10% retracement method. Then this and 10%, it did rally more than 10% here, and then found the sellers again and declined. Within our charts, one of the if we start to look into shorter timeframes and start to look for swing points in the market, and this is something, and I really want to emphasize this. This is, if you're out trying to understand what your charts are, this is a great place to look before we start getting into fancy indicators and various other things. Is simply understand your price action, understand what the chart is doing, and it's the buyers and sellers involved in that which you're basically trading with or against. But I would ask you to give some consideration to this. So defining a spike. So a spike in a chart, or a spike point, is simply a bar, and I've got them in blue because it's regardless of color, we're just looking for a bar that has a lower high next to it and a lower high following it. So we then declare this to be a spike high point, if you like. Any time frame, daily, weekly, they're always there. And so the spike low is the opposite. So we find a higher low prior to that low, and then a higher low after that low, and irregardless of the color of the bars themselves. And so here's my first statement, is that there's one of these at every major swing point, but there's lots of them along the way. But there's one at every major swing point on your charts. We really want to untangle which ones are important to us and which ones we might let go. And here we are with Costco. I've marked off, I've missed a couple. There's one there back in November, December 2023, a little one there I missed. I'm really going to have a go at finding this. Okay, can't find the pointer. Then in March, we work through the chart, February, March 24, we come in, there was a large spike high. And you notice that March spike high, red bar down close, and it's a larger bar than the previous bar, so it's an outside range. I haven't got this on our slides, but the outside range, where it's simply a larger range high to low than the previous bar, they show up about 17% of the time. So about 17 bars in 100 set as, or turn up as outside ranges. And we can see another one here in July, just in mid-July 2024. There's a large red outside bar. And just recently in March, there was a very large outside bar set in Costco. And prior to that, there was one in December as well, red down closed bar, which was the spike high. The staggering statistics around that, not only is there about 17% of your bars are outside ranges, but they have a staggering outcome of, they show the highs and the lows like about 90% of the time. You'll find an outside bar at a high or a low in your chart. And we can see here in August 2023, Q3, August 2023, there's a spike low. which is a green bar, which is also an outside range on your chart. It's the statistics around this are mind-boggling on that one simple bar that people tend to overlook. If there's an outside bar shows up on my chart, I can lose a night's sleep. No, I don't really, but it makes me look at what's going on, that there's something about to change. So now we want to qualify a high and low based off a spike point on our chart. Very simple method. I guess a lot of people have seen it, but for those that are new here and are really having a look at understanding their price action, this is a great little trading method, if you like, what we want to call it is a valid pivot point. So and there's one of these at every single swing point in the chart as well, every single major swing point. So a valid pivot point has a very strict set of rules around it, if you like. So the bar that finally makes the low, the next bar hopefully has a higher low, because that'll be our spike low if it is. And then we're looking for a bar with a closing price that is over the high of the bar that makes the low. So let me say that again. We're looking for a bar with a closing price, which means we don't see that until the last 30 minutes of trading sometimes. A bar with a closing price over the high of the bar that makes the low. If we have that, we have a valid, what we call a valid pivot point in the chart. And I know traders refer to pivots as a calculation of daily support resistance levels, that type of thing. In my world, a pivot point is where the price actually pivots to go into a different direction here. So a closing price over the high of the bar that actually makes the low, that makes the spike low. So on a chart, it looks like this on the right-hand side. So simply a closing price over the high of the bar that made the final, hopefully the final low on our chart. So it becomes a valid pivot point. Then the same with the highs. As markets move higher, we get a spike high, and then a closing price below the low of the bar that actually makes the high. So we have a spike high pivot point in place. And we can see here on the right hand side, there's a bit of chart that I grabbed. The second last bar makes the high, and the last bar sets the pivot. The closing price is below the low of the bar that made the high. That one thing will get you on the way to building a trading system, a simple trading system. So I'll say it again, I'm here for the guys that aren't Excel experts or back testing FSC rates and things like that. We're here to just build a very simple trading system based on very simple price observation. We'll give it a bit of room, but we'll enclose it to say that the valid point must be formed within 3 bars. So when we get for example, when we get a spike low, the next bar may trade over there, but may not close over the high. And in this case, the second bar on has also traded a little higher, but didn't close over that high. And then the third bar did close over that high. So it's got to be a green bar, but it closes over that high. So a valid pivot point can occur within 3 bars of the actual low being set. If one of these 3 bars, 1, 2, 3, makes a new low, then we sit back and we wait for the next potential pivot point, because that simply indicates that this spike low is not the low on our chart. So there's an example there. The black down close bar set the pivot, set the low, I should say, and then 1, 2, 3 bars later, we had a closing price over the high of that bar on that final bar. So that's all we see. When we open up our chart, this is, I guess, one of the challenges of trading, is we open up our chart and it's showing us a pivot point, and we have a trading plan that includes pivot points. Do we need to act, or do we just sit around on our hands and wait for the next, wait for confirmation, and with the potential it might get away from us? I'll come back to that statement as we go. So there's the There's the break of the high of the bar that made the low. I'll also point out in this little example at the right-hand side is that the bar that actually made the low set a pivot off the previous two bars as well. I'll come back to that as well, but that's the fact it did at the time. Off the 1, 2, 3, 4, 5, 6 bars in, there was a down close bar, set a spike high, and 2 bars later set a close below that low of that bar, so it set a reverse pivot down, and then here we are 3 bars later, set a reverse pivot high. If you take on that simplistic approach to your trading and admit to yourself what's actually going on in the chart, it will do away with a lot of, hopefully, do away with a lot of confusion around, well, what's happening in price action. Some of the worst presentations I have been to where an analyst will be standing in front of a screen going, well, I kind of think it's going up. Well, it could be going down. That type of talk, you would run a mile. If they can't describe in some form of accuracy what's occurring at the right-hand side of the screen, you're probably in the wrong place. There is a very profound statistical outcome to this type of movement, so we'll get to that in a moment. So as your chart unfolds, we can see down here at the bottom left, it set a pivot point, had a bit of a rally. Currently, it's set a spike high 3 bars in, and then the last bar shows a closing below the high, so a reverse pivot. Didn't work out, and the market starts to set new spike highs and new spike lows. But the qualifier is we can see 1, 2, 3, 4, 5, 6, 7 bars in from the right-hand side. Did set a reverse pivot off a spike high and followed through lower and so on. But this is what we see. This is what we have to deal with on a day-to-day basis until we get to the right-hand side with the potential of making some form of decision at the right-hand side or making no decision at the right-hand side. So one of the other observations, and I did this in a presentation earlier with Metastock some time ago, was we looked at and someone alluded to it today, I think after 25 bars, and I've looked at this after 20 bars and said, well, what happens really when you see a 20 bar low or a 20 bar high? So a simple count back. This is the 20th bar here, where it's got number 20 in the middle of the screen. If we count back 19, 18, 17, 16, 15, so it's the lowest low in 20 bars. We start to see some form of reaction, some form of price reaction, whether it's a short cover, whether it's news that's come out, that type of thing. But it's after that first 20 bar low, we really start to see some consolidation take place. And again, right up on the right-hand side, it was actually the 20th bar that set the high and the market declined, 20th new high, and the market declined from that point. So there's an observation around price action in its, as people say, it rhymes. It doesn't always show exactly the same thing all the time, but it does rhyme in its outcome. And only by looking at your charts, and I mean turn your TV off and open up your charts and go through them and study each single bar in its relationship to the previous bar, in its relationship to the previous 5 to 10 bars, that type of thing, will you start to see how the market is starting to move. And it's one of the, I really agree with what Darryl said about drawing your own charts. In this case, it's becoming understanding your simple price action, simple day-to-day price action, and over time you will get a feel for price movement. You'll start to see things that potential swing points coming up, that type of thing. And so this is just a simple chart I've marked off with 20-day highs and lows, and it shows the spike highs and spike lows, but each time I've marked a spike high or a spike low, it's at a 20-day at least high or low, and we start to see those play out into some form of reversal or some form of consolidation there. So it's an interesting phenomena around charts. It will demystify your chart for you if you're new to charting. This will simply demystify what you're looking at and give it some context. And one of my a guy that mentored me, nearly 15 years ago, was he drilled me on this for years, on this spike high, spike low, and made me do the research on it. And it is quite a strong phenomena in our charts that we can build systems around, and we can build a strong observation of what we might do and get comfortable. As if you're on to buy something and it's starting to go in your favor and it gets higher and higher, and one of the most common comments around that is, when do I get out? Well, maybe you'll get out on a reverse pivot. Might be a good place to get out. So if you know what that is, then there's your exit signal right there on a potentially good trade. And of course, then if it breaks a spike low, if you enter a trade and it breaks a previous spike low, then that trade is that chart is potentially going to trend lower in there because it's disrespected a previous spike point. Lawrence Connor from Connor Research, with so many trend following breakout traders in the investment area, the rewards are large when a breakout fails and reverses. And what he's referring to is essentially that breakout trading does not work. Let me qualify that. Everyone come back to me and say, oh, what about the turtle traders, that type of thing? That absolutely, they made a ton of money. They had a 60% failure rate in their trades, and they knew how to take a stop loss. And so Linda Ratchke developed Turtle Soup, which takes advantage of false breakouts, and the statistics are much better on that for winning trades. But this breakout trading, everyone gets excited about breakout trading, and often it's quite a strong losing strategy unless you can really confident you can handle your stop losses, that type of thing. So I'll go there in a moment. Okay, so let's take a look at the Haguro method. Very fortunate with Metastock. I was at a investment expo in Sydney, and Jeff Gibby and Metastock was in the stand opposite me, and Jeff comes over and goes, what are you doing? And I had this on display, the Haguro method. And so Jeff and I got talking. I give all the credit to Jeff at Metastock for getting this into Metastock and in a way that makes sense. And so let's go through the basis of it. So the Haguro method came out of that book, The Japanese Chart of Charts, which I showed earlier. The explorations for this are conducted on a Friday or the weekend. This is a weekly chart method. It is not a daily chart method. It is a weekly chart method. So if you have Haguro on your screen and you're in a daily chart, it'll still give you the Haguro numbers, but they're really of no value. It's got to be viewed on a weekly chart to make that clear. One of the key aspects of Haguro is the definition of our candle, whether it's a long period or a short period. And a long period is simply made against a reference against the previous 5, 6, half a dozen candles prior to that. Is it longer than those? Then it's described as a long period. And again, a short period is described simply high to low, shorter range than the previous group of candles is described as a short period. So within Haguro, we're looking at where the body of the open close, or where the body shows up in the range of the week. So market will open, trade up, trade down, whatever it does for the week, and then where it closes sets up the body within the range of that week. And so that's our main observation with this. And they came forward and made observations that as we know, the open close can be in the lower part of the range for the week, or the open close can be in the higher part of the range for the week. And so we're making a strong observation around the middle of the price, the middle of the high to low for the week. Now, irregardless of the body, we want to know where the middle price is for the week, the middle of the range for the week. And this middle price often acts as a significant support resistance level going forward. So we'll classify the lines. There's only 8 green lines that you can have in a weekly chart, and these are those. And here we have the numbers along the bottom. I'll come back to those in a moment. But the Higuro method searches for these or numbers these inside Metastock. And red lines, we can only have 8 types of red line in our chart. There's a couple of in here that are like, for example, the second one from the left, line number 16 comes up a lot in our chart. Let me go back. Can I do that? Yep. And line number 2 shows up a lot in charts. So as the body is over the middle of the range for the week, high to low. And number 1 is the body is below the range for the week, and so on. Number 4, the body is over the middle of the range for the week and closed exactly on its high. And number 5, opened exactly on its low, but closed over the middle of the range for the week. And so, excuse me, and so on. So the red ones are the same. And so inside Metastock, if you go into your chart, you can set the Higuro template up in here. So we set it on a weekly time frame. You apply template Higuro, and the expert advisor would be the Higuro method on there. Obviously, you can bring this, open up any chart and just bring this in on top if you need to. So the classification on these, and I'll go through these fairly quickly because I really want to get on to the daily application of this. So line 1, the movement body is below the midpoint, indicating buying at a lower price. So the following lines, even if a rise in price takes place, will be limited and a lower price will be set. So my challenge for you then is to find out, is this actually true? More often than not. It's not always true, but more often than not, is it actually true? Small fluctuations will occur in price, and price will tend to move to the center. Any upside price movement should be a place to take profits. So if it shows up in a downtrend, and we've been through what a trend looks like, the price declines from this week, look for a rising price within a few days and buy, which is not financial advice. Classification of line number 9, which is the opposite but in red. The body appears above the midpoint. If the short line, the trader should wait for the market to show directions. The following price movements can engulf the short movement, which means the following price movements can enter into a consolidation area next to it on the right-hand side. Selling is indicated when trading in the direction of the underlying movement and trend, and I've got some examples of these. And the two that show up quite often are this number 2 and number 16. Line 2 and 16 show the body midway between the high and low price. Line number 2 appears at the outset of a rise in the market after a fall in prices. A further opening above the midpoint of line number 2 in the following price movement should occur. After the 4th week, and then it goes on about trading methods. So I'm not here for that at the minute. Line number 16 also appears on a regular basis and can an indication of a high point in prices or a low point. Long positions can be open when the following week's price trades below the midpoint and rises to close above the midpoint. So essentially, the following price action engulfs that red candle. And then 3 and 15, these show up quite a lot at swing points, and I've got some charts in a moment that I'll go through. More importantly, line 15 indicates erratic price movements in the following weeks. And let me just go back one here. Line number 3, when it says here, when found in a high price area means at the end of one of those primary movements, price has had a good run. Where if it's found at a high price area, long positions should be closed. You would not believe the amount of Twitter arguments or X arguments I get into when I point out that this is actually a bearish candle on a weekly chart. The only thing I can surmise about why it's a bearish candle, because it has a long lower shadow in here, is that the larger sellers in the market have to sell into upward momentum. They can't find the liquidity after the market's put in a top. So they have to sell into a rising market to get themselves out of larger positions. And we see this lower shadow take place. Once they've finished selling, the market recovers and does what it does. But we often find these at the top when the larger money has sold, doesn't come back, and then it's left to retail to try and move the price higher. You and I are retail, by the way. I include myself in that, absolutely. We talked about line 15. Then I'll let you go through Metastock and look at these. I really want to get on to a couple of things here. These lines 5 and 12 rarely show up on a weekly chart, very rarely show up on a weekly chart. You might see 1 in 100, 1 in 75, but rarely show up in there. The same with these, where the market opens exactly on its low or opens exactly on its high and doesn't go 1 cent higher. You'll often see these are quite rare as well. But we're looking for these to show up in high or low prices. I just want to scoot forward so I don't run out of time. Inside Metastock is the expert advisor, which will also give you all of these exactly same notes on there and give you a little bit of insight. So this is what it looks like on a chart. This is what I want to get to. So what Jeff has, and I still admire Jeff for this somehow. At the top here, there's a red line. So this tells us that once this red line has crossed the upper line here, the underlying price has moved more than 10% from its last swing point. And we see as price has gone into a strong primary movement here, this is just telling you how far away it is from the last major swing point low. And then as it declines and heads into this lower 10% line, tells you that this is where the stock has declined 10% and so on. So it dances around, in this case, has then moved up over the 10% line and then back into this middle area, and currently it's in the middle. So that gives us just a simple indication of the current price from the last major swing point. The second part, as you can see, Haguro template numbers all of the candles. Every single candle on here, it numbers them. And so if you put the advisor on next to it, the commentary on next to it, if you can simply click on each candle and it will give you the description of that candle. The other important, we talked about how we're interested in the large range bodies, how they provide a mid-range point that we should take note of. And that's what this black line is. And this was programmed to say that the candle that is the largest within the previous three will set up a support and resistance level. So the black line becomes the Haguro support and resistance level. And so we here in January, February 23 on the left-hand side, there's a number 2 candle there, which was a very large range, larger than the previous 3 or 4, in fact 5 or 6. And so going forward, that is the support level. Until we get another large range, which turned out to be the number 3 there, and was larger than the previous 3. So that midpoint of that candle becomes the support level and so on. So as this develops, it's looking for, in fact, then number 16 in early March, the midpoint of that becomes support resistance level. And it's nice when we see price continually trade above the Haguro line until we see it trade below the Haguro line, and we know then that something has dramatically changed. So it's broken through key support up here in August 23. There's a 16 candle at the top, and it has broken through and closed almost at its low on the. You notice 2 bars before that, there's a number 3. High probability that's going to mark a high after a fluid movement. And in fact, there's one here that didn't, but it's there, and they don't show up that often, but there it is, they're marking the high. So I've got a slide here that sort of points out a little bit more easily the midpoint of the range. So this black line simply picks up the middle of the range of the large range candles and gives you a Haguro support resistance level. As price breaks down through that line, it's broken. So here at the 19, in January 24, 19th, it set up a support level. It then went to the 2nd of February, where a number 9 candle turned up, and it set up a new support level just slightly lower, and then as it was broken on the 16th of February, then the downward movement continued down in there. So this, I'll just point out, I'll come back to this, but this number 9 up here, number 1 and number 9, also indicators of a higher price. We saw in the notes for number 9, it said that following prices may engulf this bar, and here we are with 2 bars, in fact 3 bars trading inside that range in there. So I encourage you to take the notes, go through your charts carefully, and see if this is true, and hopefully you'll see, oh, that's not terribly clear. I was going to just here up on the left hand side, you can turn on your expert commentary, and this is what it looks like. I must have taken a pretty terrible snapshot of that, but you can simply click on the candles that currently it's on candle number 2, which is the last candle, and also point out that it's no good looking at this on Monday because it's Friday where the weekly candle finishes, but it'll give you a description of that candle and potential outcome on there. So there it is, that's better. There it is. So, and we can, number 2 is the last one. So this is Bitcoin actually. A bit of chat about Bitcoin this morning, and we noticed that currently the Hagura line is trending down on Bitcoins. This is a weekly chart, but we've just crossed over there, and it says that number 2, the bottom candle here, number 2 that crossed over, when this is a long line, the midpoint is set as future support of any declining prices. So our support level on Bitcoin is 80,244. Concerning line number 2, it appears at the outset of a rise in the market after a fall in prices and a further opening above the midpoint, which we got, which is the second last candle, and the following pricement should occur. Wait for the next week's price to open above the midpoint of the line. If the price closes below the midpoint of the line, close any long positions. You're wrong. But it gives you your Haguro support level on there. So, and there's your number 9 again at the top, and there's your number 3 prior to the top in Bitcoin. So it's a longer term look at price structure in a weekly chart. Now let's go here. 2 key observations around price. One is what we've talked about, support, midpoint support resistance. So Metastock uses the largest range from the previous 3 bars. And the second one is the better daily swings. This is where we bring Haguro into the daily chart. Better daily swing points occur after a 10% advance or a 10% decline. So we go back to our zigzag line and start to look at that. So this is Apple currently, and I just point out that Apple is trending down, has set a high in December 23. Oh, sorry, this is last year's chart. But at that point it was trending down, and then we pick it up at March 24 on the left-hand side. Things changed. The price moved to the top side of the Haguro line, and Apple started to trend up into July 24. And then set a higher low in early August and made a new high up in December in there. But currently on the right-hand side, number 9 candle says that prices may consolidate. There's your number 1 at the top, up there in December 24. But number 9 here in February, March says that you may get some consolidation sideways, and then it broke into 16 and so on. And currently here we are. The current resistance level on Apple is 206.48 based on the Haguro line, and we had a look over there last week but closed below there. So we take no notice of the last number because it is this current week and won't be set until the end of the week, until the market closes at the end of the week. So in a nutshell, that's Haguro. We can see it right at the top. The percent line is really trapped in the middle there, but it has moved to the 10% lower area in April, and as we consolidate, it's just moved towards the center there. So Apple definitely trending down. One of the Australian stocks in here, Fortescue, same thing. Number 3 candles turned up at the top, up here in Q1 2024, January, February, March. We saw a series of 3 candles, number 3 candles turn up, and has declined since, with most of the price action remaining below the Haguro support resistance line in there. And it's really when, so currently, if you were to go long, trying to buy the low, if you were trying to buy the low here on Fortescue, your current support level is $14.33 on the right-hand side. You've got to have your stop loss somewhere in this area or close by. So one of the things about, so we could build a little trading system out of that, and I'll go there in just a minute. One of the things around this is position sizing. So not working with a simple, a proven trading plan or simple plan, and failure to control your position sizing. This will kill every single trader that comes to the market if they do not control their position sizing. And I noticed over the years that many retail people new to the market, they get actually pretty good. They can use the MACD, and as Bobby displayed, you can use the MACD as a crossover tool, and they get pretty good at picking things, but they won't take a stop if they're wrong. Because in life, you don't have to do that. In life, you can twist things around to get what you want, but in trading, you can't. And unless you understand the exercise of taking a stop actually makes you profitable, unless you come across that bridge, you're on the road to failure with that. And this idea that I'm sure it's going up is actually not a trading plan. I'm sure, as most people know by now. When we build a simple trading sheet, it can be as simple as this. I did this on, just made this up on a Word document. It's something that that I use. I don't use Excel per se. I've done a lot of Excel stuff, but just a simple trade sheet. You just really want to have your rules up top here. So rule is we're looking for a 10% decline or advance from the previous swing point. We buy or sell at a daily pivot point. We talked about what a pivot point was. We enter the trade details, and the third one is your key, is really your key to success in this. So we've got our instrument, we've got our date that we enter, we've got our buy price, we've got where our stop is, the risk between our entry price and our stop. There's a dollar risk in that. In this case, it's $30.50. If we are using 1% of our account, and this is a lot of people can't get their head around this about why you would use 1% of your account. So we simply take our bank up the top left here is, well, I've nominated $100,000 just for a number. If we're going to use $1,000 of that and buy this thing with a $30 risk, then we can only buy 32 shares. That's okay. So on the 11th of the 12th, so this is, I know the US dates are around the wrong, the way this is November, it should be 24. Anyway, there was a profit of $67 per share, which equated to 2,144, which against your initial bank is a 2.1% gain, or 2.1% R, what we call return. And again, Fortescue down here, 1482 is the buy price. The stop at the time was 1318. There was $1.64 of risk. It allows us to buy 609 shares and so on, and we made 13 cents, so we made $79 against our 100,000, so it's 0.07% of our account. The thing about this is, what the key message in this is, if you're prepared to lose a fixed amount of your account on each trade rather than a random amount, or I'll give it a day, I'll give it a week, I'll wait for the announcement, whatever, and trades are going against you, you'll have a short life in the markets. Every professional trader I know uses risk management in here, including the trading houses in FX, that type of thing. They know if they're wrong, they know how much they're going to lose and whether that's acceptable or not in their trading accounts. And we can do this at a retail level just on this simple method of setting up a trade sheet. So looking for a daily swing. We talked about the 2 and 16 as our, sorry Bobby, I might go over 5 minutes here, as our key swings, and here, and I'll go here with Costco. And so if I've got a chart set up here, if we look at these major swing points back in, say, Fortescue, we'll come over, in fact, we'll come over to the right-hand side. So Fortescue has declined more than 10% in here. I've marked off on the left-hand chart where the 10% swing actually occurred from the high point. So in this case, it occurred about just under $18. That's where the 10% swing occurred from the high up there, just under $20. So below that, we start to look for an entry. And so if we come over to the right-hand side, we can see where the 10% occurred, and then gap down further. And about 10 bars later, in mid-March, it set a pivot, a green bar there that closed over the high of the bar that made the low. Now this followed through for 1 bar before it started to decline in there. In fact, it set another reverse pivot on the way down, keeping in mind that the primary trend is down. So we're trading against the trend. Really try and understand whether you're trading with the trend or against the trend in here. And just recently, it's set up another pivot down here, early April, just a few days ago. The last one is the closing price over the high of the bar that made the low, and currently that's in profit, a small amount on there. So I've got a couple of examples here, and I want to show you one. This is, there it is again, a bit closer. So it does set up pivot points along the way. You can easily be wrong on these things, particularly if you're trading against the trend. If you're trading with the trend, it's set up a pivot point up here February, set up the pivot at the break of the high, excuse me, and a really strong short on the way down. Because it had rallied 10% into this point early February. There was a 10% advancement in price. So anything after that, we're looking for an opposite trade to try and catch the trending movement. So back in mid-February, there it set up the pivot and market fell into the mid-March lows at that point. Excuse me. At the time, just prior to that, a number 3 candle turned up on the chart. Oh, that's better. And then down at the bottom, where the pivot occurred, that became a number 2 candle on our chart. So we can see here on the left-hand side, the number 2 candle, 1, 2, 3, 4, 5, 6 bars in, became the number 2 candle. Within that candle was the pivot point, which allows us to take a directional trade based on number 2, the potential of number 2 to set the low. And here we are again, which in this case it didn't. It's fine being wrong. It's what you do about it will make the difference. And here it set another low in early April, and there was a pivot inside that low, which was also a number 2 candle. So we can see that there on the left-hand side. Caterpillar, same thing, downtrend in the stock. The red line, the left-hand chart, the red line there is actually the Guru resistance level off the weekly chart. If we had the black line on there, it shows up at that level. We notice in the weeks after that, after it was broken, in the weeks after that, could not get back through that level, and has now fallen into the April low where it set a pivot at the number 2 bar, and has set a pivot also, sorry, no, it hasn't. It's set a pivot on the way down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 bars in, set the pivot in the direction of the trend down in there, but it hasn't set a reverse pivot back up as yet. So you would still be short on that particular thing. I looked at this Caterpillar thing, and I went through and I listed every single pivot point in here and built a little back test. As Darryl talked about drawing charts by hand, I strongly encourage you to do your back test by hand. Once you think you've got something that works, then go into the Metastock back tester and test the thing out. But if you're not savvy with spreadsheets and Excel, that type of thing, just do it by hand. It's laborious. I've spent 3 months building a back test by hand on some work that I did a few years ago. It makes you understand the consequence of price action. When you have to go in and write or take another loss, you have to write it into your little sheet. So again, $100,000 bank, enter the trade details and so on. So Cat, this is in English date and time, 2nd of December, 10th of January type thing. on the left-hand side. Whether you went short or long, the risk, the position size, and the profit and loss, and it was simply done on a reverse. As if you've got a buy pivot point, simply stopped on a red pivot point on a swing down. The right-hand side, there's two columns, R plus, R minus. So the first trade took a bit over $5,000, so 5.2% return against your $100,000 on simply 105 shares. The second one was a 2.5% return, 3% and so on. Then we took a loss, so your maximum loss can only be $1,000 if you set your stop on there and take it. Which is 1% loss. Now, if you think about that for a second, that means you'd have to lose 100 trades in a row to lose your bank account. And I'm here to tell you that's impossible. I've tried it. And so as we work through the pivots, we can see this red line here is where the stock actually broke into a downtrend. And we can see after that the series of losses along the way. But all in all, the losses, we took 2% of our bank in losses, and we made 11.5% against our bank in profit. So about 9% gain over a 4-month period, 4.5-month period. On one simple strategy on one stock. The message is do the work, just write down a simple sheet like this and do the work. One of the other, if you're looking for something that's a little more lazy, is looking for the zigzag swing. Look for a weekly chart. This is a weekly chart down there. Look for a pivot point. Same thing in a weekly chart. Pivots set up themselves up in a weekly chart. At the same time, look for the relative strength to be swinging over 50. Very, very strong long-term strategy based on that. I've got some numbers around that on its success and failure. It's still only around a 50-50 win-loss rate, but I've got a couple of hand-picked examples here, of course. But we can see.
We will want to try to get through this for our next speaker, Gary.
Yes, David's fine. He's good. Yeah. No, I will. I'll come to my point.
Okay, thanks.
All right. So there we another example, pivot, RSI over 50, a very, very strong trading methodology, and I will go through this. If you want to see some of my work, you can see it at I write a weekly indices report. It's at FP Markets. It's in their blog site. These are my charts. I post my notes on my charts and my support and resistance levels on my charts. They look very, very busy, but when you work through them, it makes a lot of sense, and it also points out to me when I'm wrong on there, and it's in there black and white. People think that silver is in a bull market. Silver's not. Silver's in a large consolidation zone. They're currently trading around $32.50. The charts that I put in the blog site come with their own commentary. You can go through that. This is where you find it. This is what the page looks like. Down here on the left, Index Commodities Trading Week beginning the 14th. The 21st is up this week already. There's no sign up to see that. You can go there and see it for free. You don't have to enter your name or anything like that. It's called the Weekly Indices Report. One thing I do as a side gig is I do one-on-one coaching in TA to build an edge for trading. That means that if you are interested, you have to allow 2 hours a week at least and allow 6 months to work with me in building a strategy and some form of trading plan. It's 3,150. That's my email address if you'd like to contact me on there. And that's it. Thanks, Bobby. Sorry, David.
No worries. Thank you, Gary. It's always great to kind of see you go through it. I do love what you have to show on the Haguro method. I know Jeff has always spoken really highly of you, just as you do of him. So thanks again, for taking some time out of your day and coming on and presenting with us. So we really appreciate it.
Thank you. Thank you, everyone.
All right. So I'm going to quickly take you back over here. Oh, hey, David. Yep, I can hear you loud and clear.
All right, so I just see you show my screen here if I can.
Yeah, so I just quickly, I'll go ahead and make you the presenter, and you should get a pop-up in just a moment.
Okay.
Just getting to my slides to you guys. So yeah, if anyone has any questions kind of about the Haguro method or was interested in a trial of Metastock or any of the offers from today, we do have someone waiting in our chat room, and you can speak with them about, you know, different ways to kind of sign up, how you can get a trial, how you can get access to the programs you've seen today. That's just metastock.com/sales chat. Also, a big thank you to the ATAA and Stocks and Commodities Magazine for for sponsoring today's event. Sorry guys, it's getting late for me here today. Next up, we do have David Novac. David's been a partner of Metastock for many years, a couple of decades now, I believe. And you know, this is the first time since I've been here, since we've been able to get you back on for like a presentation. So it's been a long time. David, we're really appreciative for, you know, having you join with us today. And I'm really looking forward to your presentation. And with that said, yeah, I'm happy to kind of help walk you through kind of getting started here. So I'm going to make you the presenter, and you should get a pop-up on your screen here in just a moment. And it's going to ask you kind of which screen you want to share. All right, and I can see wealth-wise, the power of combining technicals with fundamentals.
Okay, great. So, yep, is that, sorry, let me just go back there.
Perfect.
Is that okay?
Yep, and if you want to, you can share your camera, but you don't have to.
Okay, well, I'll talk, so I've got the full screen here, and, you know, I can, maybe later I'll share my camera so people can see who they're talking to.
Yeah, but, all good. I'll be here in the background if you need help.
Great, thanks, Bobby, and welcome everyone. It's great to be here, and thanks for the invitation, Bobby, to speak here for everybody here, especially what the information that's being presented here for anybody who's a trader or an investor. What I'll be talking about is obviously the power of combining technicals with fundamentals, which I've found provides you one of the most powerful formulas for achieving, you know, profitable results in the markets. So with that, I'll just proceed with the next slide, which, let me just see if I can, there we go. So this is just part of the financial services regulation. I'm authorized under a licensed stockbroker here. This is for general advice only. So it's for educational purposes, obviously not giving you specific advice here, even though I'll be showing a number of charts. So just want to let you know that. Okay. So I just want to use this analogy of a hammer. You know, if you're a carpenter and you only had a hammer as your only tool, you'd be very limited in terms of what you could achieve with just a single hammer. So I just wanted to give you this kind of analogies, like whatever tool that you use in the markets, you know, you want to add other tools to your trade, so that, you know, gives you more competence and confidence in the market. I've been a veteran for over 40 years, so I can certainly testify to that. So I started, or Kate and I did, my business partner, started our educational programs back in 1997. I started in the markets in the mid 80s. Actually, 83 was my very first time I ventured into the market. And so I went through the infamous, I should say, stock market crash of 1987. And then when we were teaching to small groups, I got, well, before I get to that, actually, this is our curriculum of courses. Our Financial Wisdom is a 1-day, Invest for Success is a 2-day, which is combining the technicals and the fundamentals. Options for Success is a 2-day program. Advanced Options is a 4-day. And at the very top of the tree is the Super Traders program, where I go away with my advanced traders and we trade live for 5 days. So I was asked to speak for Tony Robbins in 1998. You know, I was a derivatives expert, and I was quite shocked and surprised when Wealth Mastery came to Sydney, which is where I'm based, in 98. And it's a 4-day Wealth Mastery program, and they invited me to come and speak, and I was the only Australian speaker because of my options or derivatives experience. And up to that point, I'd only been speaking or educating people in front of, you know, 30 or 40 people, and next thing you know, I was launched into the stratosphere in front of Tony's group of 2,000 people back in '98. And then I came back as a keynote speaker in '99 for Tony, in 2001 in Singapore. And then I met Robert Kiyosaki in Australia in 2000. He'd heard all about me. I just went to his 3-day financial intelligence program, and he tapped me on the shoulder and introduced himself. Obviously, I knew who he was as the author of the best-selling financial book, Rich Dad, Poor Dad. And then he invited me to come to the States, and I became his keynote speaker in the US from 2000 to 2005, and then also in Asia, throughout Singapore, China, Indonesia, Malaysia, etc. And then since 2010, I've been on Sky Business, well, it was Sky Business TV back then, before it was taken over by Murdoch. And for whatever reason, I don't know why they axed the Sky Business program, but the group of people got together who were ex-Sky Business and started what they call AusBiz TV, which is live Monday to Friday, and it's the premier business channel. So I appear regularly every month on that program talking about stocks. So let's talk about technical analysis, which obviously gives you an indication when to buy in terms of timing. You know, what to buy is the fundamental analysis rules. And then, as Gary mentioned, one of the most important aspects of investing or trading is risk management, knowing when to sell or when to exit. In my experience, and certainly when I started, 90% of people who get into the markets do not have a properly defined exit strategy or stop loss, and therefore lose, as Gary was sharing, mostly lose, as I did when I started off. And so, you know, you've got to have a predetermined stop loss or exit strategy. And like I said, my experience, and when I've been on TV, when it was live TV, talking to people who'd been in the markets and losing money, you know, first question I asked them is, well, where was your stop loss or exit strategy? And as you can imagine, most people didn't have one. Now, what goes over the top of this is what's going on in the global markets, because I find for myself, you know, it's critical to understand what's happening in the macro picture, because that shapes your strategy about where to invest, what's the best places to invest depending on what's going on globally. So I'm just going to cover briefly some of those macro issues right now in the global markets. So the first thing that's been a major concern is, sorry, I don't know why my pointer's, there we go. Interest rates has been a concern for a lot of people, especially from 2020 and then 2022, 23 in Australia especially, and around the world, interest rates started to move up. So that's a big factor, because interest rates have a repricing mechanism of valuation on very highly priced growth stocks. So there's a rebalancing, if you like, in the macro sense when interest rates are going up. And also the concern about inflation rising. I mean, right now, inflation seems to have stabilized, but that's one of the concerns I know the Federal Reserve Chairman Powell mentioned just last week, and unwilling to cut interest rates at this stage, although the ECB, the European Central Bank, has quite a different view, because their target inflation rate is below the Fed's target inflation rate, so they've been cutting rates. And then, of course, if you look at GDP, what's going on in the global growth sector, there's obviously slowing growth. Employment's been remaining relatively steady, especially here in Australia and in the US, I know. But the thing that's really created a lot of uncertainty lately is the tariff policies from the Trump administration, as you know. And there's declining consumer confidence. And the other factor is whatever exchange rate, wherever you're based, you know, the exchange rate is a very important factor in terms of when it comes to investing. And of course, what we're also dealing with right now is geopolitical tensions between the US and China. So here's a chart of the US 10-year Treasury bond yield going back before 1960. And you can see in the 80s, when interest rates and inflation was very high, it's the on 10-year it was 15%. Paul Volcker, who was the chairman of the Federal Reserve, took the decision to raise interest rates aggressively to slow down inflation, which did work. And then we saw a decline of interest rates for the next 30, 35 years until we got to the low in 2020, which was COVID. And this is showing you a chart of the 30-year Treasury bonds. This is going all the way back to 1980 to 2023. I've got a more updated chart, but I just want to show you this, that when Treasury bonds are going up, the capital value I'm talking about here, and this was a secular bull market all the way up to 2020 from 1980 low. When bonds are going up, the capital value is going up, then interest rates are going down. So this has been one of the longest, at this period of time, was one of the longest, what they call secular bull markets in Treasury bonds. So of course, this is what it looks like when back in 81, 82, if you bought a US Treasury, 30-year Treasury bond, you would have been getting 15%. And then at the peak, this is COVID, in March 2020, people, because they were scared of when the global pandemic hit, they were buying US Treasury bonds that were just 1% yield, which just shows you how scared people were at the time to be buying US Treasury bonds to receive just 1%. In fact, in some places like Germany and Japan, they had negative interest rates on their bonds. In other words, people were paying the government to take their money just as a form of security. Now, of course, when you've got interest rates going down for an extended period of time, then that's bullish for markets, particularly for the equities market. And you can see the S&P there, and property as well. And in Australia, it's been very bullish, especially in Sydney here, which is now rated the second most expensive city for real estate in the world, next to Hong Kong. And certainly, Australians love property, but also have borrowed a lot of money to buy property while interest rates were low. But now there is some pressure here with mortgage holders because of the rise in interest rates. So, but again, when interest rates are going down, it's all things are great. And this is our biggest bank, Commonwealth Bank, CBA, from 1991 when the stock was $5, and today it's actually back to $164, and you can see that breakout level about above $110. That was a year ago. So this has had a massive rally, and just shows you the extent of the love for our banks, particularly this one, our biggest stock in the ASX 200 or the Australian market, CBA, and in fact the most expensive overvalued bank in the world. So it just goes to show you how people have a love for property and borrowing, and that's shown up in CBA. And I was in banking. I was in merchant banking for 12 years. I used to be the chief financial officer of Barclays in the 80s. And we haven't had a recession since the early 90s. So, a lot of people won't know what a recession looks like, but that's going to be a big problem for banks if we have a recession, which is the biggest risk that I see going forward, especially what's happening with the tariffs at the moment, the tariff wars. That creates inflation that can easily lead to a recession, if not worse. Then that means unemployment goes up. When unemployment goes up, that's a big problem for banks because their bad debts go up. So this has been the most unbelievable bull run for the banking sector, certainly in Australia from my time, because I remember in the 80s when banks lose money, they stop lending. So that's very cautious right now, especially buying into Commonwealth Bank or CBA up here, especially with the valuation that people are chasing. I mean, every banking analyst in the world, if you take the top 18, have at least a 50% price target that's less than where CBA is right now, at least at 110 or below. So this is like what speculation is looking like right now, and certainly greed is there as well. So this is now the Treasury bond market. This is updated to where it is, and you can see the break of that long-term trend line, and you can see that rates went from 1% in March 2020 to now 5%, or just under 5% at the moment. It's 4.8. This is on the 30-year US Treasury bonds. On the 10-year, it's 4.4%. So this is the most important chart right now. This is what a lot of people are worried about. So if bonds, and you can see the trend of bonds was up for, like I said, a very long secular bull market, and now it's clearly trending down. And this is the biggest, like I said, the biggest concern, that if this trend continues, this will create a crisis. I can promise you that. So that's what everybody's watching at the moment, are the yields on the 10-year long-dated treasury bonds at the moment. So you've seen a correction here just recently on the S&P of 20%. It's just a sharp fall. And also on the NASDAQ, it's bigger correction of 25% as a result of the tariff wars, plus the threat of inflation and the bond market in particular. So I just want to show you this on my meta stock with CBA. You know, I've drawn in here one of the indicators that I use, that I love using, relative strength index. So when you've got a market going up, and you can see on the right-hand side that there's a declining, it's called the bearish divergence. And this is CBA as we speak, is hitting its previous high. So if it makes what I call a double top up here, and the likelihood is, looking at the indicator, the probability is it could easily do that. So what it tells me right now, looking at that indicator, the relative strength index is telling me not to buy the stock up here. In fact, to take profits right now would be the prudent thing to do, given the valuation of CBA and the move up here. And also you've got this bearish divergence on the relative strength index at the bottom of the chart there, which is going down. So that's a sign of be careful. That this could be a very sharp correction coming here. So that's just one of the indicators that I use, or other tools that I use in my toolbox. Now, I just wanted to show you this also. When I was teaching in the States, I was telling Americans back at that double top pattern there in 2001, now was a good time to move out of the US dollar and go into any other currency. I mean, compared to the Aussie dollar, you know, they're getting 50% discount coming to Australia when it's 48 cents to the US. And I was saying, but there was running, you know, the US was running big trade deficits back then, of course, and continues to. So I said, this is not sustainable. And as you can see, the US dollar decline over that 10-year period from 2001 to 2011. And you can see the Aussie dollar at 2001, it made a double bottom pattern there. You can see very clearly, it was very bullish, and then it actually went above parity. You can see back in 2011 at 110 to the US. So that was when the time a lot of Australians were traveling to the US, and you had stocks like Flight Centre and travel stocks like rocket up because everybody was traveling to the US. And the other factor was, and I mentioned back then, was to buy gold. It was $250 US an ounce. And over that 10-year period, you can see with the decline of the US dollar, that gold went up 600% from $250 US an ounce to 1900 US as a result of the decline of the US dollar. Now looking at the US dollar index, this is the index, by the way, I should say. It's the US dollar against the whole basket of major currencies. You can see to the right-hand side where the US dollar has fallen sharply, and it's just broken below a key support level at 100 that you can see there on the right. So over the last couple of years, it's been in a very choppy sideways pattern. But what I find really interesting at the moment that we've never seen before is there's a decoupling away of the US dollar from the gold price. The gold price is, in other words, even with interest rates going up and with the US dollar that's been holding up, the gold price has taken off in the face of all that. And that's usually counter to what normally how the gold price would react. Fundamentally, I'm talking about here, to if the US dollar and interest rates are going up. So this is quite a move away from historical norms. And what's causing the gold price up, I'll give you the factors later, but basically a lot of fear and trepidation about what's going on in the world right now, and particularly like in the US. And here's the Australian dollar right now. I mean, it has bounced very strongly. It did get down to 59. You can't see it on this chart right now, but it's trading at 64 cents to the US, which is very profitable for Australian gold producers. So right now, the gold price hit a new record high last night at just above 3,400 US. That's equivalent in Australian dollar terms. Australian gold producers are receiving just over 5,300 Aussie dollars per ounce, which is a huge profit margin for Australian gold producers right now, which I still consider are significantly undervalued, particularly if the gold price continues to trend higher from here. I mean, obviously, you'd expect there'd be some corrections along the way, but there's certainly a lot of fear driving the gold price at the moment. But the Aussie dollar being weak is a real bonus for our exporters, particularly gold producers. So one of the things I look at, there's the facts, there's opinions, and there's trends. So if I break it down, if you're looking at the facts, I'm looking at the financial health of a company. You know, does it have debt? Has it got a lot of cash? What are their earnings? You know, cash flow. Do they generate positive cash flow? That's a really important element for me when I'm investing. And secondly, you've got the media. You've got opinions from the media, from brokers, from analysts. I mean, I listen to what a lot of brokers and analysts and people say, but I selectively choose who I listen to. That's for sure. So you've got to be careful who you listen to. I don't take what they say with blind faith. I really focus on the facts and, most importantly as well, what's the trends happening at the moment, the technicals. So that's where, for really powerful analysis, combining the technicals, the charting, with some of the things that like Gary shared, I'm sure other people have shared earlier, with the fundamentals, the facts is to me a very powerful, complete analysis. So what we teach under the WealthWise methods, we call it the sweet spot, is where you combine the fundamentals with the technicals and risk management. Those three combined give you a really powerful formula. So we look at charts. What do they do? Help us determine is the trend. Obviously knowing when to buy and sell from a timing perspective, knowing when a stock is overbought or oversold. And most importantly, it determines, like, looking at the bullish and bearish sentiment, price action, in the market. Like I just showed you that chart on CBA, that's an incredibly bullish sentiment right now that's driving the price action. So let's look at some fundamentals just to put this together. So why look at fundamentals? Well, they help us measure the financial health of a company, identify, what sectors are growing, and within those sectors, what industries are growing the fastest within that sector. And then what we're looking for ultimately is strong earnings growth in that sector or industry. So, simple company financial triangle is you've got revenue or income, expenses, tax, and it's after-tax profits that gets distributed to shareholders. And the shareholders in Australia particularly love the banks. That's a weighting in our market of at least 40%, 45% of our market is financials, because people here love dividends. I mean, if you bought CBA at $5, you'd be getting a fully franked dividend of more than 50%. At least, in fact, more, 60% dividend yield back then. And there's a thing called fully franked, which means it's also, you get a tax break on it. So Australian banks are the highest dividend payers in the world. Although, again, given where CBA is trading right now, Commonwealth Bank, I'd be very cautious because the yield is going down. So people are taking a bigger risk buying at a much higher price up here and not factor into account what the downside potential could be. So, but that's the thing that shareholders love, particularly in Australia. I know not so much in the US. In the US market, because I taught there for a while, they're very much geared to capital growth and not so much dividends. Here in Australia, dividends are very important to investors. So here are my seven key fundamentals. Firstly, I like to see a company that's got a healthy balance sheet, lots of cash. I mean, if they do have debt, I want to make sure that they're generating really strong cash flow to support that debt, but preferably they've got a strong balance sheet with lots of cash. and no debt. Earnings per share, which is, obviously net profit after tax divided by the number of shares on issue in that company. And what analysts are looking for are always earnings per share growing in a business. I won't go into too much detail with each of these, but this one's a price earnings ratio. In other words, measures how expensive or how cheap that stock is relative to their earnings. And I'll go through some examples in a moment. Return on equity is quite important. How much is the business generating as return on shareholders' funds and equity, retained profits? And then also looking at dividend yield, does the company, if you're an income investor, you definitely want to focus on, income and looking at the yield that the company's paying, and is that sustainable as well? And then there's the market capitalization. What's the value of the company in the market? Is it $100 million value or $1 billion, or, if you take CBA right now, it's 260 plus billion. Huge market capitalization. So that's a factor as well, because as the market capitalization of the company goes up, like say it starts at 50 million or 100 million, and then as the share price goes up, the value of that business goes up. And then when it gets to $500 million or $1 billion, then you've got funds who buy into, as part of their mandate, must buy into those stocks. And then, of course, coming back to the sector, which sector is growing the fastest and what industry within that sector. So here are the 10 global sectors: energy, materials, industrials, consumer discretionary, staples, healthcare, financial, information technology, which has been a very strong sector, that's for sure, in the US at the NASDAQ, telecommunications and utilities. So I'm just going to go through quickly here some examples of companies that are healthy, how to spot overvalued stocks, and how to also know or find explosive growth opportunities. So this is the first one I'm going to show you, which is a great example combining strong fundamentals with the technicals. Now this is going back, this is back to June. This is just an example. I could use lots of examples, but this is just to demonstrate what I'm talking about. This was a stock in the consumer discretionary white goods area called GUD, Australian company. Only had a market cap of 207 million, $3.30 share price. Its earnings per share was 33 cents, and that 33 cents was up 89%. So the profit was up, the earnings was up 89% on the previous year. And I've got these benchmarks, like I'm looking for a growth of greater than 25%, return on equity greater than 15%, had a 24% return on equity, which is outstanding. But here's the key thing. I'm looking for a PE, preferably below 15. It had a 10-to-1 earnings. In other words, you divide the share price by the earnings per share, gives you a 10-to-1 PE, which is incredibly cheap for a stock that's, a company that just generated 89% growth. Now in the sector, this is when everybody was doing renovations, home renovations. So this is a white goods supplier. So their sales were going through the roof. There's a lot of TV shows about home renovations. And so this company was, shooting the lights out in terms of sales revenue. And then half their profit they were paying in dividends, 17 cents. So if you bought the shares at $3.30, getting 17 cents, that's a 5% dividend yield, which is pretty good. And this was the trend. So just left to right, I mean, say no more. You've got high highs, high lows, positive trend, positive earnings. So that circle is the reporting period. So this was a buy as far as I'm concerned, just based on those numbers and the future outlook of that business. So you can see the following year, just comparing it, now the share price moved up to $4.80, good percentage move up. Market cap is 285, and look, the earnings grew another 36% on the back of an 89% growth. Now the return on equity has gone to 32% and still trading at only 11-to-1 PE, which is again, grossly undervalued on a price to earnings multiple, given the growth of this business and their earnings. So the dividend went up, of course, because anybody buying it at $4.80 would be receiving 26 cents or 5% even today at that time. And you can see that it broke above this resistance level. There was a new entry there, and again trending up nicely. And then the following year, now the company's gotten into the big league where it's over $500 million. Share price doubled, and the earnings was up another 54%. So was the return on equity, 42. The PE is still cheap, like 13, still below my benchmark of 15. That's still undervalued. And the dividend had gone up now to 40 cents. So anybody who bought this stock 2 years ago is now getting a 12% dividend yield in only 2 years. So even anybody buying it at that time at $9 would still be getting a 4%. So this is an excellent example of what I'm talking about. And you could apply this to any company where you've got earnings per share growing, and consequently the share price continue to move higher and beyond that. Now here's an example of an overvalued stock and a weak trend. So this was Brambles. Now this is a big company, $9 billion market cap. So people think just because they're big and it's got a big valuation in terms of market cap that it's safe or good. No, I'll dispel that myth. There's better opportunities in companies that have lower market capitalization values as long as their earnings is growing strongly. Now this is Brambles, which is a global transport group. Their earnings went down, profit went down 13%. Return on equity was still good, but look at the PE. That's way too high for me, and paying only a 2% yield. And look at the trend. Just the trend alone is something I would not have bought on. Just looking at the trend itself, I would not have bought on that alone. But combined with looking at the earnings profile, which was down 13%, that's another reason not to buy. The next year, the stock price continued to fall. The market cap halved. You could see that the earnings per share was down another 10%. The return on equity was lower. The PE's come down, but still expensive in my book. At least the PE, the dividend yield went up to 4%. But consequently, this is what happened. You can see there's plenty of warnings just looking at the decline in earnings. And then they just had a slight improvement. I mean, the not much, but it's only down 4%. So now there's probably viewed as a turnaround story by some analysts. But again, it depends on the outlook of the company, what they're saying, the future outlook, and still paying a small dividend of 3.3% or 2% still on what you paid 2 years ago. So again, at least the trend started to change here from down to up, but still not enough reason for me to buy until I see a strong turnaround in earnings. Now, this is how I identify explosive growth stocks. Now, this is a stock in the material sector. This was a nickel producer back then, had a small market cap of 190 million, share price $165. Look at the earnings per share growth was 63%. Return on equity was unbelievable, 64, and the PE was 7, incredibly undervalued, and paying a dividend of 9% back then, which is amazing. Now the stock was going sideways, so the opportunity was to buy on a breakout above that resistance. The next year, the stock did break out slightly to $2. The market cap went up, the stock price went up to $2. The earnings per share went up another 66% on their earnings, 83% return on equity, which is ridiculous. And this is the amazing thing. The PE went down, which is like when you think about a company growing their earnings at 66% and return on equity at 83%, that you can buy this at a 5 to 1 earnings multiple was ridiculous to me. And increasing their dividend, so even anybody buying it at $2 was getting a 14% dividend yield. So this was the breakout entry after that second report and having a stop loss 10% below. And then suddenly the market recognized the value of this company, and it doubled, more than doubled in price in the next year. The earnings went up another 94%, 102% return on equity, and still undervalued at 6 to 1, paying 45 cents dividend. So anybody who bought the stock at $1.65 2 years ago would be getting a dividend yield of 27%, which is extraordinary. anyway, there was a stop loss there. And anyway, there's an opportunity to get back into this. Eventually, by 2007, just prior to the GFC, this company was taken over by Xstrata at $23. $23 in 2007. And this was the nickel price. And from there, nickel went up to 50,000 US per ton in the peak of 2007. So it was a perfect time for someone to buy Jubilee at that stage. And this was another company, I'm just showing you quickly. Again, this was an oil company. Oil was breaking up above $40 US a barrel. And you can see the earnings per share growth. I won't go through all the numbers, but you can see the return on equity going up, the PE still cheap. It wasn't paying a dividend, but this was a growth story and, you know, a positive trend with oil, you know, also following the oil chart, trending up as well. And that went up to about $10 from here. So that was the previous, those are just some examples, but more importantly, here are 3 examples of stocks in a growth sector that I certainly like today. And I've been talking about this on TV at least for the past year. So anybody who's been listening to me will know what I've been saying about gold. And so here's gold. And last night, like I said, this closed above, this is in US dollars, above 3,400 US. So you can see this is a chart. I've got a moving average crossover indicator here, which is a 20-day moving average, simple moving average. This is on a weekly chart. That's the yellow line, and the blue line is a 50-day or 50-week, I should say, simple moving average. So you can see when there's a crossing up, the yellow crosses above the blue. It's a very simple moving average, and that's what I love about moving averages, is you don't have to draw trend lines in. You just use this as the blue line as your trend line. But you can see from 2019, when the gold price got up to just above 2,000 US an ounce, in 2020, it was going sideways, and then we had the breakout last year in about March 2024. The gold price broke out to the upside, and that was clearly a good entry. So here are the strong fundamentals supporting gold. Right now, it's definitely a lot of investor fear. The trend obviously is very bullish, and the prospect of, and the probability, I should say, not just the prospect, but the high probability of further US dollar weakness is a strong factor as well for driving the gold price, and the US debt and deficit problem that the US is dealing with at the moment, and especially now on the back of tariffs, which you know, will cause inflation. That's also got a lot of people concerned right now about the rise in inflation, and again, how that translates to the bond market, the long-dated US Treasury bonds, with the yield moving higher. So it's a perfect scenario, again, for, you know, why people are rushing into gold as a safe haven. China has been one of the biggest central banks also buying gold. And behind all of that, of course, you've got the geopolitical tensions, and that Australian gold shares are still undervalued, grossly undervalued, compared to where the gold price is and the profit margin that Australian gold companies are making right now. So here's one. This is right up to date. It's called Evolution. It's the second biggest gold producer in Australia. It produces 770,000 ounces of gold per annum. You can see that in December 23, it's an $8 billion market cap. Share price, I talked about this on TV, was $3. The earnings per share growth was 38%. So this is before the gold price broke out. Return on equity is quite low, 8%, and the PE was still relatively high. So it wasn't a screaming buy at that stage. But if you look at the following year, so this is when sorry, 6 months later, I should say, June. Now the market cap is 11 billion because the share price is $4. The earnings per share grew another 56% because the gold price moving up. And this is an unhedged gold producer, which is very important to know when you're buying into a gold producer, whether they're hedged or unhedged on the price. And you can see the return on equity moving up. The PE came down slightly, and this paid a paltry dividend of 7 cents. And now, after the December reporting period, you can see the share price jumped to $6. So it's doubled in 2 years. Another 36% earnings growth. Return on equity is now moving up to 17, and still relatively, to me, still undervalued given where the gold price is. That's still trading on a low multiple, and it's still paying a 2% dividend. And here's the share price. So you can see those 3 circles, they're the reporting periods. So the time to really get into this was the second part, the breakout circle there in August. After that reporting period was an excellent time to buy the stock, and that's when I talked about it on TV. And you can see today, it's actually up at $8. Well, actually, I don't know the exact price today, but it's at least $8.50. But you can see the growth from just last year, from it's about $3.50 to where it is right now, and I see this trend continuing. Now, this is another one of the top ASX gold producers called Westgold Resources, and I still see a lot of value in this particular one. I think this one's lagged the other gold producers in Australia. You could see the market cap here in December was $2 at 1.2 billion, 89% earnings growth. Went to $3 in June last year, and now what's interesting is it pulled back to $2.50 after December reporting because the earnings were slightly down because of a production hiccup they had. But that was no concern as far as I'm concerned, because it's trading at a low PE of 15 for a gold producer. And they came out, this is well, first of all, you can see where the share price fell based on that earnings report on the third circle, but also breaking back up to the upside. And the reason, you can see, this is just at the beginning of this month, the company came out with an update, a trading update on their production. And I was showing this slide at the beginning of this month, showing in the dark blue line there is the company relative to all the other major gold producers in Australia is still relatively undervalued. And especially on an enterprise, that middle column, you'll see where it is on an enterprise value per gold reserve. Westgold is way down near the bottom of that middle column. So there's a lot of scope for upside re-rating here. And this is their guidance. You know, they produce between 330, 350,000 ounces, to say 340,000. The all-in sustaining costs is 2.5 to 2,400. Let's just say 2,500 per ounce. So they're getting right now on 350 or 340,000 ounces they're producing, they're getting more than 100% profit margin. That's massive. So if you extrapolate that, that's nearly $1 billion in earnings. So again, this is one of the top 5 ASX producers. It's also listed in the Canadian Stock Exchange. It's one of the top 10 Canadian gold producers. It's got a 2.7 billion market cap, unhedged. And, yeah, I can see the scalability. So this is one of the ones that I particularly like right now in the sector that I see has still a lot of catch up to the other ones. And lastly, I just thought I'd show you this one. This is the junior sector of the market, Explorers. This is a company called Petronas. PTN is their ASX code. This was 40 cents back in 2017 when the gold price in Australian dollars was only 1,600 Aussie. And like I said, today it's 5,300. But this company today has 2.3 million ounces. You can see that's just trading at a paltry price of 6.1. I see an extraordinary opportunity here. With this company, it's building a diversified resource a company. It's got not only gold, but uranium and also base metals. But this is what they showed in their presentation in February, towards the end of February. There's shares on issue 1.6 billion, share price is 6.3, which has got a market cap of 98 million only, but they've got cash and investments of 79 million. In fact, that's gone up. So the enterprise value, when you take the cash and investments from 98 million, there's only got an enterprise value of 19 million, which means they've got 2.3 million ounces discovered. It's being priced at $8 Aussie per ounce of gold. So it's significantly undervalued relative, especially to where the gold price is. And there's a lot of junior companies like this, explorers, that have a very good resource. And this is where there's going to be a lot of M&A activity happening in this junior end of the market. And this one is a really great example. And we've got a very strong shareholder base. Delphi, which is a big German fund, has 42%, and another fund, another company, gold company called St. Barbara's, got 10% in this high net worth. So I'm really surprised this is still languishing at the moment, but I don't expect that to last for long. But these are their projects. You can see that they've got this also high quality uranium deposit in Northern Territory. It's trading at a significant discount, and there'll be some really great news flow coming soon on the company. But again, I just wanted to show you this chart, like showing the huge discount to the gold price. These are like, this was when it was 20% discount. It's now bigger than that, where these explorers, the one that I just showed you, is now at least 30% or more discount relative to where the actual gold price is right now. So there's a big catch up here is what I'm saying. And these are the kind of opportunities that I look for, you know, not necessarily just because they're a producer, but because they've got a very strong underlying asset. And how they got the 80 million or 79 million cash before was they're right next door to a producer called Genesis, and they sold 600,000 ounces beginning of last year when the gold price was 50% lower. So they'll get a lot more premium for their gold. Finally, I just want to add this word of wisdom from Warren Buffett. You know, if the markets were rational, I'd be sitting in a gutter with a tin cup in my hand. Ain't that the truth? And the markets are not rational, and I've been around long enough to know that. When I see CBA people buying Commonwealth Bank, our biggest bank in the market, and paying ridiculous multiples and taking huge risks, given the macro picture that's going on at the moment, it's a massive risk to be buying the stock up here. So that's, you know, an example of being irrational, and just showing you a company that's discovered a very good resource. Then they've also got shares, like Petronas have got shares in other listed gold companies that they bought in cheaply. So they've got multiple million ounces of gold in other companies as well. So that's, again, just distinguishes how irrational the market can be until the market wakes up to the relative value that's there. So again, getting back to the analogy of instead of having a single hammer, having a complete toolbox with a lot of different tools at your disposal is what makes a good investor or trader. You know, using different techniques, but honing in to the ones that work best for you, and testing, you know, whatever's comfortable for you. And back testing is the other thing that I find is very useful, whatever methodology you use. So that's what we offer in our courses. I mean, here in Sydney, it's face-to-face. We do travel if there's a big enough group. But like I said, our courses that we've got coming up next is an options course for success. It's on a Saturday, the 3rd, and Sunday, the 4th of May in Sydney, from 10 a.m. to 6 p.m. on both days. And then also this Invest for Success, which is getting into more about combining the technicals and fundamentals and how to find undervalued companies. That's coming up on Saturday, the 14th and 15th of June, from 10 a.m. to 6 p.m. on both days. And there's also, after the course, 4 one-hour individual coaching support sessions to make sure that you're set up properly and know how to use the tools to actually identify undervalued stocks, and using the right technical analysis timing tools that I use as well. So that's coming up in June. So just to finish this off, this presentation, because I'm just right on 3 o'clock here, which I know is very late for those of you if you're still awake overseas, especially if you're in New York. It'd be just 1 a.m. at the moment, but there's this is a psychology test. Just pick a symbol. Don't think too hard. Which symbol? Just pick one. Hopefully everybody's got a symbol. If you pick the rectangle, you're a conservative investor, likely or interested in dividends, likely to invest in quality, you know, blue chip or big cap shares. If you pick the triangle, you're moderate risk takers, investors looking for growth rather than dividends, likely to invest in growing companies. And if you're a Z, then you're a visionary, open to new concepts, willing to take high risks and hope for high returns, are likely to invest in speculative stocks. And if you pick the circle, well, these are party people, party first investors. I don't care where they invest, and they're happy if they have enough for a good time. So I hope you had a chuckle about that, a bit of fun. Anyway, if you want more information, you can contact me, contact my office, or email info@Wealthwise Education for further information, or go to my website. But that concludes my presentation, unless there's some questions. I haven't looked to see if there's any questions at this stage.
All right. Great. Thanks, David. Yeah, good presentation. It was fantastic having you on. Thanks for sharing all of your details so people can reach out, because I know a lot of people also come back to watch the recording afterwards. I'm not seeing any questions on YouTube. It looks like inside of GoToWebinar, Gary says, great presentation, David. There's some other good jobs as well. So yeah, I think you kind of handled everything there. I'll go ahead and just take
There's a lot of, I was just to say, Bo, there's a lot of information there to absorb. So, it's great that it's recorded so people can replay it. But I think the most important thing at the moment is be cautious, especially with what's going on with tariffs and inflation and in the bond market. That's the key market to watch right now.
Yep. All right. Thank you. I'm going to go ahead and just share a couple of slides here.
And they're great to see you, Bobby.
Oh, there you are. Yeah, great to see you as well. Looking good. And yeah, it was great having you on. I'm really glad that ended up working out. So I'll actually be in touch with you in the very near future. I'll be following up about some of the things with the event, and then also to look at what other further business we can continue to do together.
My pleasure, Bobby, and thank you for having me on, and thanks for everybody attending this session. So all the best.
Okay, yeah, cheers for now.
Bye.
All right, so I just want to give a final shout out to our sponsors for today's event. We had Stocks and Commodities Magazine, who has rated Metastock as the best analysis software for over 30 years in a row. We also had the ATAA sponsor this event, and they are doing a limited time offer where you can sign up and get a membership starting for just $1 for the first 3 months. We've shared some links in chat for you guys to be able to take advantage of that. Also, as you've seen throughout all of today, everyone that spoke has been utilizing Metastock for their charting analytics. And so if you're interested in a trial, or if you want to look into some of the different options that are available to you, we do have Dave available right now in chat. That's metastock.com/sales chat. He'll probably be getting out of here if you don't come into the chat room within the next couple of minutes. So I jump in there to ask him any questions, and he'll stay and answer anything that you need help with. You can also sign up for our offers at metastock.com/summit-savings. Two of the presenters today, Daniel Sinnig, Daniel Sinnig has SuperTrend Bullseye inside of Metastock, and then we also had one of our speakers show some of the late Steve Bigelow's Candle Profit System 3.0, and we are doing a special offer where you can get those trading systems plus 3 months access to special training from Bigelow in the Traders Forum, as well as our Unleash the Power of Metastock ebook and videos normally valued at about $2,200. You can get that for just $1,144. Or if you're interested in just the Candle Profit System or just SuperTrend Bullseye, you can get those as well. Visit us at metastock.com/summit-savings. Or if you're watching right now, or even in the future, feel free to jump into our chat room, metastock.com/sales chat. If someone's not available there, you can send us a message and we'll get back to you as soon as we can. But we do have Dave waiting in there now. If you have any questions, you can also give us a call at +1 801 506 And Greg is helping share a lot of links with you guys as well. I want to give a big shout out to both Greg and David, who have been working and helping behind the scenes all day today, or all night for us. I know for most of you it's about midday. For us, we're about 11 or 12 p.m. Well, 11 p.m. or 12 a.m. for Greg. So thank you, Greg. Thank you, Dave. Thank you, everyone else that watched today or that is watching in the future. Be sure to check our website for future events. We do pretty much weekly webinars, monthly summits, and like quarterly conferences. So you're always welcome to check out our website and go to our events section. And you can find all of our recordings on our YouTube channel, which is just youtube.com/Metastock. And I think that's going to do it for today. So thank you one final time, and we'll see you all next time. Bye for now.